Please like, share, and subscribe. Wishing you happiness and good luck every day.
When you hear the name Warren Buffett, you probably think of just staggering success, right? Genius insights and this almost mythical talent for picking winners. But today, we're going to flip that script. We're not here to study his home runs. We're going to dive deep into his strikeouts to find out what they can teach us. And who better to start with than the man himself? Buffett has always been shockingly open about his blunders, and this quote really sets the tone for everything. He truly believes the smartest path to wisdom is paved with other people's errors. And lucky for us, he's left a pretty detailed map of his own. So yeah, that's the big question for us today. By looking at where the Oracle of Omaha actually went wrong, can we find a kind of roadmap for making better decisions ourselves, not just in investing, but in, well, anything? I think the answer is a definite yes. Now, just so you know where we're getting this from, our guide on this journey is the fantastic research put together in Balaji Kasal's book, The Intelligent Investor's Mistakes. We're pulling these stories right from its pages to really understand the anatomy of a top-level failure. All right, here's our game plan. First, we're going to tackle this idea of the perfect, flawless investor. Spoiler alert, it's a myth. Then we'll get into two very different kinds of errors, what are called mistakes of commission, where he actually did the wrong thing, and mistakes of omission, where he failed to do the right thing. And finally, we'll wrap it all up with some truly billion-dollar lessons. Okay, first things first. Let's just bust a huge myth right out of the gate. We have this tendency to put icons like Buffett on a pedestal, right? As if they have some kind of crystal ball. The truth, though, is way more human and, frankly, way more interesting. And look, there's no question, his record is absolutely legendary. Taking Berkshire Hathaway from a failing textile mill and turning it into a corporate giant, the 8th most valuable company in the world, it's one of the greatest stories in business history. That unbelievable success is exactly what makes studying his failures so powerful. But here's the thing, and this is really the key to his whole philosophy. Buffett's real superpower isn't that he avoids making mistakes, it's his incredible ability to own them, to look at them without blinking, and to use them as fuel to get smarter. He doesn't bury his errors, he literally publishes them in his annual letters for the whole world to learn from. So let's dive into our first category, mistakes of commission. Now, these are the errors that are usually the easiest to see. These are the active decisions, the big purchases, the deals that just went completely, horribly wrong. So think of a mistake of commission like this. You decided to take a swing, you pulled the trigger, and you missed. Badly. You actively chose a path, and it just turned out to be the absolute wrong one. Let's look at a couple of Buffett's most infamous examples. Now, here's the ultimate irony. Buffett's greatest triumph actually started as his first major, emotion-fueled mistake. The very company that became his legendary empire was, in his own words, a terrible business that he bought purely out of spite. The human element here is just fascinating. See, Buffett bought into Berkshire because it was a cheap cigar butt stock. The plan was simple, make a small profit and get out. But when the CEO tried to chisel him out of $0.01 on the share price, we're talking pennies, Buffett got mad. Instead of just taking his profits and walking away, he let his anger take the wheel, bought control of the company, and in doing so, chained himself to a dying business that burned through cash for the next 20 years. And this quote just captures the lesson so perfectly. He spent 2 decades trying to patch the holes in that leaky boat before finally admitting it was time to just get in a new boat. It was a very, very expensive lesson, all sparked by a moment of pure emotion. So if buying Berkshire Hathaway was his original sin, then Dexter Shoe was what he himself calls his worst deal ever. And this wasn't just a mistake, it was an absolute financial catastrophe that he made infinitely worse by how he structured the deal. Okay, so how did a $433 million mistake balloon into a $3.5 billion disaster? Well, it all came down to how he paid for it. He didn't use cash. No, he used Berkshire Hathaway stock. He essentially traded a piece of his phenomenal, world-beating company for a shoe business whose competitive edge was about to completely vanish. The lessons here are just brutal, but they're crystal clear. First, what looks like a strong competitive advantage, a moat, can dry up way faster than you think. But the bigger lesson, paying with your own company's stock is like making a double-or-nothing bet. He traded a winning lottery ticket, Berkshire shares that would keep soaring in value, for a losing one, and the cost just kept compounding year after year. A truly painful mistake. All right, so as bad as those active mistakes were, Buffett argues that his biggest blunders were actually the ones you can't even see on a spreadsheet. These are the mistakes of inaction, the ghosts of opportunities he saw, he understood, and then did nothing. This is a much trickier kind of error, right? It's not about buying the wrong company. It's about not buying the right one when you had the perfect shot. And Buffett gave it this classic, folksy name, thumb-sucking. Just sitting there, paralyzed by inaction, while a golden opportunity just sails on by. And this comparison, wow, this just tells the whole story. He made an active $10 billion bet on IBM, an old guard tech company whose best days were clearly behind it. It ended up being a pretty mediocre investment. But at the same time, he fully admitted he understood Google's business model. It was basically an advertising agency, something he knew inside and out, but he just watched from the sidelines. The cost of that inaction, it was astronomical. Easily hundreds of billions of dollars left on the table. So why? Why did they miss it? Well, this quote from his longtime partner, the late, great Charlie Munger, explains everything. Their famous principle of sticking to their circle of competence, the very thing that made them so successful, also became a massive blind spot. By being so rigid about what they knew, they completely missed one of the biggest business shifts in modern history. So after all that, let's bring it all together. How can we take these epic mistakes, both the ones he made and the ones he failed to make, and turn them into a practical framework that we can actually use? This little table really boils it all down, doesn't it? You've got two fundamental ways to mess up. You can either do the wrong thing, like buying Dexter Shoe with your amazing stock, or you can fail to do the right thing, like taking a pass on Google. Just figuring out which kind of mistake you're more prone to is a huge step forward. And this gives us a simple but really powerful 3-step playbook. Step 1, you gotta own it. No excuses, no blaming anyone else. Just own the mistake like Buffett does in public. Step 2, analyze it. Get to the root cause. Was it emotion, like with Berkshire? Was it overconfidence, like with Dexter Shoe? Or was it just plain old procrastination, that thumb-sucking, like with Google? And finally, step 3, use that analysis to better understand your own limits, your own circle of competence, so you don't make the same kind of error again. And that really is the whole point. We study Buffett not to learn how to be perfect, but to learn how to be resilient. His incredible career teaches us that failure isn't the opposite of success. It's an essential ingredient. The wisdom you get from a mistake becomes a permanent asset, something no one can ever take away from you. So I'll leave you with this question to think about. We've spent this time looking at the Oracle's errors, but now let's turn the lens on ourselves. Think about one of your past failures, big or small. If you were to analyze it the way Buffett does, no blame, just curiosity, what's the valuable, maybe even billion-dollar lesson that's just sitting there, waiting for you to learn it? All right, let's get into one of the most incredible stories in business history. We're going to talk about how a single, angry, purely emotional decision, what Warren Buffett himself calls a colossal mistake, somehow accidentally created Berkshire Hathaway, one of the most successful companies the world has ever seen. It's a wild story about a truly terrible deal that became the best thing that ever happened to him. And this quote, well, it absolutely nails the heart of this entire story. It's all about that battle that happens inside every single one of us, right? That clash between our rational, planning brain and our gut-level, spontaneous emotions, especially when the pressure is on and the stakes are high. So here's how we're going to break this down. First, we'll look at the initial, very logical investment. Then we'll get to the emotional slip-up that just changed everything. We're going to walk through the 2-decade-long struggle that came next, see the brilliant pivot that saved everything, and then finally pull out the key lessons we can all learn from this whole ordeal. Okay, so our story kicks off back in the early 1960s. And you've got two main characters here. On one side, you have a young, incredibly disciplined Warren Buffett who's already building a reputation. And on the other side, Berkshire Hathaway, this once great textile company that was, to put it mildly, on its last legs. It was slowly dying. Now, you really have to understand Buffett's thinking at the time. He was a student of his mentor, Benjamin Graham, and he practiced what they called cigar butt investing. The idea is kind of gross, but it's a great metaphor. Imagine finding a soggy, discarded cigar butt on the sidewalk. But hey, it's got one free puff left in it. So you pick it up, take that last puff, and toss it away. You got something for nothing. For investing, this means you buy a truly terrible company, but you buy it so ridiculously cheap that you're guaranteed to squeeze one last little bit of profit out of it. You're not buying quality, you're buying a bargain. And Berkshire Hathaway was the perfect cigar butt. I mean, look at these numbers. The stock was trading for $7.50, but just its working capital, the easy-to-sell stuff, was worth over $10 a share. Its total book value, over $20. So Buffett sees this and thinks, wow, I can buy this thing for way, way less than it would be worth if they just shut it down and sold off the parts. So let's be clear. Buffett had absolutely zero interest in making textiles. His plan was a cold, simple, calculated trade. He'd buy up a bunch of shares on the cheap, then just wait. He knew management would keep closing down mills and use the cash to buy back stock. He'd sell his shares back to them for a bit more than he paid and walk away with an easy profit. It was supposed to be simple, logical, and totally unemotional. But that perfect, rational plan, it was about to get completely derailed. This is the part of the story where human emotion just kicks down the door and flips the whole table over. So in 1964, things are going exactly to plan. The company president, a guy named Seabury Stanton, reaches out to Buffett and asks him, "At what price will you sell us your shares?" Buffett gives him the number, $11.50 per share. Stanton looks him in the eye, they shake hands, it's a deal. But then, when the official paperwork shows up in the mail, the number isn't the same. It was off by an eighth of a dollar, just 12.5 cents per share. I mean, on paper, it's practically nothing, a rounding error. But for Buffett, this wasn't about the money anymore, not at all. It was the principle of the thing. He felt like Stanton was trying to chisel him. He felt cheated, and he got mad, really mad. And this is the exact moment where the entire future changes. The logical thing to do would be to just take the slightly lower price, make its profit, and move on. That was the whole point of the cigar butt strategy. But no, his anger completely took over. He later said he thought to himself, I'm going to buy enough of this company to get control, and then I'm going to fire Seabury Stanton. And that is exactly what he did. He threw his entire rational plan in the garbage out of pure, raw emotion. Now, there's a really important piece of context here that might explain why he reacted so strongly. This wasn't just some random Tuesday for Warren Buffett. His father, Howard, who he absolutely idolized, had died less than a week before he got that letter from Stanton. So you have to imagine he was grieving, he was emotionally raw, and probably not in the best headspace to make a clear-headed, multi-million-dollar decision. So in that fit of anger, Buffett got his revenge. He fired Stanton. But in winning that battle, he was now stuck. He was the proud new owner of a dying textile business in a terrible industry, a business he never, ever wanted to run. And that one emotional decision kicked off a 20-year-long headache. And man, it was a long and painful period. He took over in '65. There was this one tiny bright spot in 1967 where the business actually made a little money. But it didn't last. For pretty much the next 2 decades, it was just this brutal, grinding fight against horrible economics. It was always 1 step forward, 2 steps back, until he finally pulled the plug and shut the whole textile operation down for good in 1985. So what made it so impossible? Well, for starters, the business was a total money pit. It was always demanding more and more cash for new machines just to keep up. Plus, they were making a commodity. Cloth is cloth. So foreign competition with cheaper labor was killing them. They had no real advantage. On top of that, high costs for everything from electricity to labor just ate up any profit they might have made. It was just a fundamentally terrible business. Years later, Buffett himself put it perfectly. He said that all the time, energy, and money they poured into trying to save the textile business, it was like paying for a largely wasted education. A very, very expensive lesson. But here's where the story takes this incredible, almost unbelievable turn. The very mistake that trapped Buffett in this awful business also gave him the tool he needed to escape it. His discipline in one area ended up saving him from his emotional blunder in another. His true genius wasn't in fixing the textile mills. It was realizing they couldn't be fixed. So he did something brilliant. First, he starved the bad business. He refused to throw good money after bad, investing the bare minimum to keep the lights on. Second, he extracted the cash. Any little profit the mills coughed up, he took it. And third, and this is the masterstroke, he reallocated that cash into completely different, wonderful businesses. And this was the big move. Remember that one good year, 1967? Buffett took the cash that the textile business had generated and used it to buy an insurance company in Omaha called National Indemnity. He literally used the cash flow from a terrible business to buy a fantastic one. This one purchase was the seed that the modern Berkshire Hathaway grew from. So why was buying an insurance company so smart? It all comes down to a magical concept called float. See, insurance companies collect all our premium payments up front, but they only pay out claims later, sometimes many, many years later. All that time in between, they're sitting on this enormous pile of cash, the float, that they can invest for their own profit. Buffett realized that owning an insurance company was like having access to a constantly replenishing river of capital that he could use to buy more great businesses. It turned his mistake into an unstoppable money machine. Okay, so let's step back. After a 20-year struggle that started with a moment of anger and ended in incredible success, what are the big lessons here? What can we all learn from this unbelievably expensive but ultimately priceless mistake?
This quote right here is probably the most famous piece of wisdom to come out of this whole saga. It's just classic Buffett. Sometimes it doesn't matter how smart you are or how hard you work. If you're in a situation that's fundamentally broken, a leaking boat, the smartest thing to do isn't to frantically patch the holes. It's to put all your energy into finding a new boat. So what does changing vessels actually mean for the rest of us? Well, it means keeping your emotions in check, because this whole mess started with a fit of anger. It means you have to understand why something is cheap, not just that it is. It's about recognizing that even a genius manager can't save a business that's in a terrible industry. And maybe most importantly, it's about having the guts to admit when you're wrong, cut your losses, and move on. This right here is the ultimate lesson of the story. You could be the most brilliant person on the planet, but if you put that brilliance to work on a fundamentally flawed business, the business is going to win every time. The quality of the boat you're in matters far, far more than how well you can row. You know, when you think about it, that tiny 12.5-cent grudge cost Warren Buffett millions of dollars and 20 years of misery. But that wasted education, as he called it, gave him the wisdom he needed to build a $500 billion empire. It kind of makes you look at your own mistakes differently, doesn't it? It makes you wonder what incredible opportunity, what life-changing lesson is hiding inside our own worst decisions.
You know, we're always obsessed with the big wins of legendary investors. But honestly, the real lessons, the ones that truly shape a great mind, they almost always come from the failures. So today, we're going to dig into a rare and pretty spectacular mistake by one of the absolute best, Warren Buffett. And look, this isn't just about some bad stock pick. This was a multi-million-dollar, decade-long disaster that completely reshaped his entire way of thinking about investing.
So yeah, this is not one of those brilliant stock pick stories. Nope, this is a cautionary tale. It's about a deal that looked like a surefire home run on paper, but quickly turned into a 10-year nightmare. And the source of all this pain? A little company called Wambex Textiles, a name that would become a very, very painful lesson for everyone at Berkshire Hathaway.
Yeah, you can't really get more blunt than that, can you? Straight from the man himself, writing in his 2014 annual report. Buffett is not trying to spin this one. So it just begs the question, how does a financial genius, someone known for his incredible research, walk straight into what he himself calls a disaster? Well, to figure that out, we've got to rewind the clock a bit.
To really understand the mistake, first we have to understand the logic behind it. Because back in 1975, this didn't look like some wild, crazy gamble. Actually, it was the opposite. It seems like a really smart, calculated move. A classic Warren Buffett bargain hunt.
Okay, so here's the setup. It's April 1975, and Berkshire Hathaway buys Wambeck Mills. But look closely at that key detail, loss-making. They weren't buying a booming, successful company, they were intentionally buying a struggling textile mill. And believe it or not, that was a huge part of the appeal.
The price tag, at least up front, seems almost tiny by today's standards. Just $1.6 million in cash. Now that's still a lot of money, of course, but for an entire manufacturing company, with all the buildings, the land, the equipment, it looked like an absolute steal.
But that cash payment wasn't the whole story. Not even close. Berkshire also took on over $1 million in debt, with an 8% interest rate. So before they could even think about making a profit, they had this big, recurring cost they had to cover every year. The real commitment was way bigger than that initial price tag.
Right, so this is the big question, isn't it? Why on earth would the famously careful Warren Buffett go out and buy a company that was already losing money? It just seems to go against everything we know about him. But there was a very clear three-part strategy behind the whole thing.
The thinking came down to three main things. First, the physical stuff. the land and the machines. They believed it was all worth more than what they paid. Second, they saw this powerful synergy by combining Wambach with Berkshire's other textile businesses. And third, because the company had lost money in the past, there was a nice little tax benefit. On paper, it really did look like a no-brainer.
So let's just dig into that synergy idea for a second, because it was key. The plan was basically twofold. Berkshire, with all its know-how, would come in and make Wambach's operations way more productive. And in return, Wambach's products, which fit nicely with what Berkshire already sold, could be pushed through Berkshire's huge sales network. It seemed like a perfect win-win.
But you know how it goes? The best-laid plans, that perfect synergy on paper, it's smashed right into a very, very harsh reality. And that brilliant bargain very quickly turned into a massive financial anchor, dragging the whole company down.
I mean, just look at this timeline. It really tells you everything you need to know. The journey from that hopeful acquisition in 1975 to the final, painful decision to shut it all down in 1985 took 10 years. An entire decade of bad performance, of money being tied up, and of non-stop headaches for management. A full 10 years.
And we're not talking about some tiny little problem in a forgotten corner of the company. No way. The textile division, weighed down by Wambach, was a constant, heavy anchor on Berkshire's overall performance. It got so bad that shareholders at the annual meeting started to stand up and openly challenge Buffett on why he was keeping this failing business alive.
But sometimes the biggest failures teach the biggest lessons. And decades later, Buffett looked back on this whole mess, not with excuses, but with one of the most powerful insights about investing he has ever shared. An insight that was born directly from the pain of the Wambach experience.
And this is it. This is the entire lesson boiled down to one perfect sentence. Time is the friend of the wonderful business, the enemy of the mediocre. Wambach was a mediocre business, and the more time and money Berkshire threw at it, the more value it just destroyed. See, for a truly great company, time is your best friend. It compounds your success. But for a bad one, time just highlights the flaws and bleeds you dry. All right, so what are the big takeaways we can pull from this decade-long disaster? Well, the failure of Wambach ended up creating 3 timeless principles that are just as important for any of us today, whether we're investors or running a business. First up, the synergy myth. You know the hope, right? You take one business, you combine it with another, and boom, 1 + 1 = 3. But as Wambach's proved, when you combine a struggling business with another struggling business, you don't magically get a strong one, you often get something even weaker. 1 + 1 can actually end up being a lot less than 2.
The second lesson is all about avoiding what Buffett famously calls the cigar butt trap. The image is just perfect. Imagine finding this soggy, half-smoked cigar butt on the street. It's got one last puff left in it, so you can pick it up, get that final puff for free, and feel like you got a deal. But that's it. That's all you get. It's a cheap, one-time thing, not a real long-term investment.
And this is exactly why that approach is so dangerous in the long run. First, these mediocre businesses just suck up your cash that could be growing in a really great business. Second, you have no idea when or even if you'll ever get a return. And third, and this is so important, they just drain your mental energy and distract you from finding the truly amazing opportunities out there.
And finally, we get to what might be the hardest lesson of all. It is just human nature to hold on to a mistake, right? We keep hoping things will somehow get better. But the smartest and, the most difficult thing to do is to just admit the mistake and cut your losses as early as you can. Every single day you spend just hoping and waiting is another day you let time be your enemy.
So that leaves us with one final, pretty challenging thought. A question to think about, not just for stocks, but for our careers, our projects, anything. After seeing how a certified genius wasted an entire decade on a bad idea, it's really worth asking ourselves, which mediocre project are you holding on to? What are you just hoping will improve while time is quietly, steadily working against you?
We usually talk about the big wins, the legendary investments. But today, we're going to flip the script. We're digging into a story that's not about a massive success, but about a really critical failure. This is the story of a deal that went completely sideways for Warren Buffett and Charlie Munger, and in the process, taught them a lesson that would quite literally be worth billions. Let's get into it.
This quote right here from Walmart founder Sam Walton, it just perfectly captures the hard lesson at the very heart of our story. It's all about the massive difference between a business that looks good on a spreadsheet and one that's actually good in the real world. Buffett and Munger? Well, they were about to learn that difference the hard way. Okay, let's set the scene. The year is 1966. Warren Buffett isn't the global icon we know today. Not even close. He's running his investment partnership, and he's just taken control of this struggling little textile mill called Berkshire Hathaway. He teams up with his partner, Charlie Munger, for what would be their first major acquisition together. And their target? A department store that looked like the absolute perfect bargain. The company was Hochschild, Kohn and Company. It was a private, family-owned department store chain based in Baltimore. Now, this wasn't some flashy, high-growth tech company or anything like that. No, it was a very traditional brick-and-mortar retailer. And for the Buffett of that era, who was a die-hard student of Ben Graham, that was the entire appeal. It was a simple business with real, tangible assets you could see and count. No, this is what's really fascinating. Look at how they structured this deal. Buffett's partnership, yeah, it took the lion's share at 80%. But look closer. Munger and another key partner, David Gottesman, they each put their own money on the line for a 10% stake. This wasn't just Buffett's deal. It was a shared bet with some serious skin in the game from everyone involved. So the pain, and of course the lessons, were going to be felt personally. To really get why they bought Hochschild Kohn, you have to understand Buffett's early philosophy. It's famously called cigar butt investing. The idea, which he learned from his mentor Ben Graham, is actually pretty simple. You find a company that's so discarded and cheap, kind of like an old cigar butt somebody threw on the street, that you can pick it up and get one last free puff of profit out of it. It's an investment style that is all about the price, not about the quality of the business. And Hochschild Kohn looked like the absolute perfect cigar butt. The company was being sold for a massive discount to its book value. What that means is, if you added up the value of its inventory, its cash, and especially its real estate, it was worth way more than the price they were paying. So from a purely numbers-based, statistical point of view, it seemed like a mathematical can't-lose bet. But as you know, a cheap price tag can often hide some really deep problems. The numbers on their spreadsheets back in Omaha, they looked fantastic. But the reality of the business on the ground in Baltimore, that was something else entirely. And the cracks in this so-called bargain started to show up almost right away. So, in a move that seems almost crazy today, these future titans of finance literally had to walk into a local Baltimore bank to ask for a loan to help close the deal. And the conversation they had with a very skeptical bank manager, well, it turned out to be the first major red flag, a warning they probably should have listened to. Just try to imagine being that bank manager for a second. These two brilliant but not yet famous investors walk in, and you just hit them with this. $6 million for a small and old store? That one simple, blunt question just captured the on-the-ground reality that all their calculations had completely missed. It was the perfect dose of real-world common sense fighting against their quantitative analysis. But they were convinced they had a deal, so they pushed ahead anyway. And here's the thing. The bank manager was right. The business itself was just troubled. As you can see here, there were major underlying problems across the board. The retail market in Baltimore was brutally competitive, which just meant endless price wars. The store's profit margins were razor thin, so there was zero room for error and no extra cash to reinvest. And even worse, the business came with these really challenging and costly expansion plans that were almost guaranteed to fail. They were buying a cheap asset, sure, but it was attached to a fundamentally broken business engine. So here's the crucial point. What they thought was going to be an easy, passive puff of profit turned into 3 long, grinding years of operational headaches. The reality of actually owning a struggling retailer finally set in. This wasn't just a stock certificate anymore. It was a complex, low-margin business that needed constant management attention, constant capital, and constant worry. It was a total grind. I mean, this timeline really tells the whole story, with just stark simplicity. They bought the business in '66, full of optimism about how cheap it was. Just 3 years later, in 1969, they were desperate to get out. For investors who are now famous for their forever holding period, 3 years was a shockingly clear admission that they had messed up.
So what did they get for all that trouble? This slide just perfectly illustrates the disconnect. The goal was simple, a quick, easy profit based on a cheap price. A classic cigar butt win. And the result? After 3 years of work and worry, they were lucky to sell it for roughly what they paid. They barely even broke even.
But here's why this story is so important. While the financial loss itself was pretty minimal, the opportunity cost was huge.
Just think of the capital, the time, and the mental energy they wasted on this problem for 3 years. Munger and Buffett eventually started calling this their billion-dollar mistake because the lesson it taught them would prevent them from making far bigger, more catastrophic errors down the road.
Years later, Buffett didn't mince words. He openly admitted it. He said, "We were wrong on the economics of the business." He wasn't blaming the people or making excuses. He understood that their core analysis, focusing only on the price while completely ignoring the quality of the actual business, was just fundamentally flawed. And of course, Charlie Munger summed it all up with his signature classic wit. This quote is just perfect. It captures that initial excitement of finding a deal, followed by the immense, liberating relief of finally getting rid of a terrible, headache-inducing asset. You can practically feel the pain in his humor. So what was the billion-dollar lesson? Well, this whole painful episode became the catalyst for one of the most important shifts in modern investing history. It was the moment that Buffett and Munger began to pivot away from the quantitative world of cigar butts and toward the qualitative world of finding truly great quality companies. This slide basically lays out the new philosophy that was born from the ashes of Hochschild Kohn, a philosophy that would go on to generate hundreds of billions in wealth. First, they learned to stop looking just at the assets and instead start evaluating a business's actual, sustainable competitive strength, what they call its moat. Second, they truly internalized that the quality of the business is far, far more important than how cheap the price is. And this all led to their legendary mantra, which is the exact opposite of cigar butt investing. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This thinking is what led them directly to See's Candies just a few years later, a business with a great brand, pricing power, and loyal customers, the complete opposite of Hochschild Kohn. And that brings us right to the final, critical question that this entire experience really answers. The Hochschild Kohn mistake taught them that chasing a wonderful price for a mediocre or fair business is just a recipe for headaches and terrible returns. The real path to compounding wealth is finding a wonderful business and being willing to pay a fair price for it. And that is the billion-dollar lesson that turned a Baltimore department store failure into the foundation of an empire.
You know, what if I told you that one of the absolute greatest investors in history, a name that's basically synonymous with financial genius, made one single mistake that ended up costing his original partners over $100 billion? Yeah, this isn't some hypothetical classroom example. This is the real, true story of Warren Buffett's biggest self-admitted financial blunder.
$100 billion. Just let that number sink in for a second. It's a figure so huge, it's almost impossible to wrap your head around. And all of it, every single dollar, was diverted away from his closest partners because of one decision he made decades and decades ago.
And hey, don't take my word for it. That's a direct quote from the man himself. In 2014, he looked back on a choice he made almost 50 years earlier and flat out called it a colossal mistake. I mean, that's just a stunning admission. So the question is, how on earth did this happen? How did the undisputed master of capital allocation make an error this big?
So, in this explainer, we're going to unpack that exact question. We're going to start with the mistake itself, then we'll travel back to this critical crossroads in 1967. We'll solve the ownership puzzle that Buffett was facing, explore the accidental empire that was born from this decision, and finally, figure out the incredibly powerful lesson this whole story holds for all of us.
Okay, so let's get right into it. The $100 billion mistake. And let's be super clear about what this was. This was not a series of bad bets. It wasn't a stock market crash. Nope. This was the direct result of one single choice. A fork in the road that had a $100 billion consequence.
See, the central question here wasn't about what to buy. Buffett knew what he wanted. It was about how to buy it. It's all about the vehicle you choose for the journey. And to really truly get the choice he made, we have to jump in our time machine and head all the way back to Omaha, Nebraska in 1967.
All right, let's set the scene. The year is 1967, and we're looking at a much younger Warren Buffett. Now, he's already a brilliant investor, for sure, but he is not yet the global icon that we all know today. So at this point in his career, he's kind of juggling these two very different business vehicles. And this absolutely fantastic new investment opportunity has just landed right on his desk. And this is where that fateful choice begins.
So there are three key players you got to know for this story. First, there's BPL. That's Buffett's private investment partnership, the main ride for him and his original, trusted partners. Then you've got Berkshire Hathaway, which at the time was a dying textile mill up in New England that Buffett had taken control of. He'd later call it a terrible business. And finally, you have the prize, National Indemnity, or NICO for short. Now, NICO was exactly the kind of business Buffett loved. It was this small but wonderful insurance company right there in his hometown of Omaha. And here's the kicker. The owner was a friend of his, Jack Ringwalt, and Jack made it crystal clear he would only sell the company to Warren Buffett. This wasn't just a good opportunity, it was a golden one.
And this brings us right to the heart of the story, the ownership puzzle. Buffett had this incredible prize in his sights, but now he faced a structural question. What's the best way to actually buy it? He had two paths he could take, and the one he chose, well, it would change absolutely everything.
You know, on the surface, the question seems pretty simple. Should he use his private partnership, BPL, the vehicle he set up specifically for his partners, or should he use this other thing he controlled, this publicly traded but totally struggling textile company? Okay, let's break down these two paths because this is so important. Path A was the clean, straightforward option. If he bought NICO using his partnership, BPL, then he and his partners get 100% ownership of this fantastic business. All of its future profits, all of that value belongs to them. Path B was totally different. If he used Berkshire Hathaway to buy NICO, his partnership would only indirectly own 61% of it. The other 39%, that would belong to the old-school shareholders of the failing textile mill, basically a collection of strangers.
And I mean, just look at this chart. It visualizes that consequence perfectly. By choosing Path B, nearly 40 cents of every single future dollar of profit from this incredible business would just be diverted away from his partners. It would be handed over to people who had absolutely nothing to do with finding the deal, analyzing it, or funding it.
And remember, the price tag for this gem of a business? Just $8.6 million. Seems like a tiny sum now, right? But that small transaction would have $100 billion ripple effects that would stretch on for decades.
So, against all what seems like obvious financial logic, Buffett chose Path B. He decided to buy the excellent insurance business using the capital of the terrible textile mill. He literally married a gem to a dud.
So, what happened next? This is where the story gets really, really fascinating. The fallout from this one decision was obviously massive, but weirdly enough, it also led to an entirely unexpected and legendary outcome. Let's just look at this trade-off here. On the cost side, it was a financial disaster for his partners. It was a colossal mistake in capital allocation that diverted a massive fortune. But the unexpected gain was just immense. Using the public company Berkshire Hathaway gave Buffett a permanent public platform. It let him share his investment philosophy with the entire world, turning him from just an investor into a teacher and a public figure. It was the seed that grew, completely by accident, into the Berkshire Hathaway that we all know today.
And this, right here, is the central irony of the whole story. One of the greatest corporate empires in modern history, a company that is the global symbol of rational, smart capital allocation, was actually built on what its own architect called an accident. It was founded on a huge structural mistake.
So, okay, it's an incredible story, but what can we actually take away from it? Why does a decision that somebody made over 50 years ago matter to any of us today? Well, because it contains two absolutely timeless rules for investing and for building anything, really.
The first rule this story teaches us is that ownership is destiny. It's that simple. The percentage you own of any asset is ultimately what determines your economic benefit, your piece of the pie. A 39% diversion is a 39% diversion forever. And the second rule is that your first choice of structure, it's sticky. Once you put an asset inside a certain legal or corporate vehicle, it is incredibly difficult and expensive to change it later. You really have to try to get it right from the very beginning.
And you know, the true power of this lesson is really hammered home by Buffett himself. When someone asked him almost 5 decades later why he made that choice, he admitted he still didn't have a good answer. Just think about that for a second. The greatest financial mind of our time made a decision that even he couldn't rationally defend, and it accidentally created a global empire. And that leaves us with a final, really powerful question to think about. It's easy for us to look back at Buffett's choice and analyze it, right? But what about our own choices? What crucial assets, maybe it's a business idea, an investment, a side project, are we potentially placing in the wrong vehicle today, setting in motion consequences that we can't even see yet? You know, when we talk about Warren Buffett, we usually talk about his genius moves, his legendary investments. But what about his mistakes? Well, today we're diving into one of the biggest screw-ups of his career. A decision that involved the Walt Disney Company and came with a price tag that is just staggered.
All right, so here's how we're going to break this all down. We'll start at the very beginning, with Buffett's first encounter with the Magic Kingdom. Then we'll look at the two separate times he sold his stake way too early. We're going to calculate the mind-boggling cost of that mistake, and then hear what Buffett and his partner Charlie Munger have to say about it. And we'll wrap it all up with the real lesson here, how this story can help us all with the toughest question in investing: when should you actually sell?
So let's turn back the clock. The year is 1965. Warren Buffett is 35 years old, and he's already making a name for himself. He gets curious about this entertainment company, Disney, and decides to investigate using his famous scuttlebutt method. Now that's just a fancy word for doing old-school, on-the-ground detective work, not just sitting in an office reading reports.
Now you have to remember, even back in the mid-60s, Disney wasn't some little startup. It was already a cultural giant. Founded by Walt and Roy Disney, it was this powerhouse of animation, movies, TV, and of course the revolutionary idea of a theme park. The brand was everywhere, and it had what investors call mindshare. Basically, it lived inside the heads of pretty much every family in America.
So Buffett, being Buffett, doesn't just look at the balance sheet. No, he gets on a plane, flies out to California, and gets a meeting with the man himself, Walt Disney. And Walt personally walks him through the whole business plan. After that, Buffett goes and visits Disneyland, just to see with his own eyes how incredibly popular this place really was.
And this quote right here, it tells you everything you need to know. Buffett looked at the numbers and saw that the entire company was valued at about $80 million, but Disneyland alone was a gold mine. He basically said it was a joke. You could buy the theme park and you'd get the entire movie studio with Mickey Mouse, Snow White, all of it thrown in for free. It was an absolute no-brainer.
So Buffett sees this joke of a valuation and decides to act. He buys in. But what happens next is what turned this from a great investment into a legendary cautionary tale. Okay, so Buffett puts his money where his mouth is. He invests $4 million, which was a pretty big chunk of change for his partnership back then, and he buys a 5% stake in the Walt Disney Company. He knew he was getting an incredible deal, sitting on a pile of untapped value. But then, just 1 year later, in 1966, he sells everything. The whole stake, gone. He sold it for $6 million. Now look, on paper, that sounds amazing, right? A $2 million profit. A 50% return in just 1 year. That's a home run by almost any standard. But this is where the story of a massive, multi-billion-dollar mistake really begins. So you've got to be asking, why on earth would he sell such a fantastic business? Well, the answer comes from a philosophy he learned from his hero and mentor, Benjamin Graham. It's called cigar butt investing. And the idea is pretty simple, actually. Imagine you're walking down the street and you find a cigar butt that someone's thrown away, but it's still got one good puff left in it. It's not a great cigar, but hey, that last puff is free. You pick it up, take the puff, and toss it. That's the strategy. Buy a junky company for super cheap, get one last little puff of profit out of it, and then get rid of it.
And here is the absolute key to this whole story. Disney was not a discarded cigar butt. It was what Buffett would later call a wonderful business, a company with a powerful brand, the ability to raise prices, and a competitive advantage that would last for decades. So, by using this cigar butt strategy on a truly great company, he made a quick buck, but he gave up on a lifetime of growth. This mistake was actually a huge turning point for him as an investor, pushing him to stop looking for just cheap businesses and start looking for wonderful businesses.
Now you'd think, okay, lesson learned, that's the end of the story. But you'd be wrong. Incredibly, the universe gave Buffett a second chance at this, a do-over. Let's fast forward about 30 years and see how history repeated itself in a big way. You can really see the whole saga play out here. You've got Act 1, the sale in 1966. Then there's this huge gap, almost 30 years. But then in 1995, a completely different deal drops Disney right back into his lap, only for him to sell it all over again just a few years later. It's unbelievable.
So how did this happen? Well, Buffett's company, Berkshire Hathaway, was a huge shareholder in a media company called Capital Cities/ABC. In '95, Disney swooped in and bought them. And as part of that deal, Berkshire got a ton of cash, $1.4 billion. And, almost by accident, they once again owned a huge piece of Disney, a 3.6% stake.
So here it is, the billion-dollar question. He knew the first sale was a mistake. Why would he turn around and make the same decision again, selling this even bigger stake in 2001?
The key here is probably the timing. This was 2001, right as the dot-com bubble was bursting, and Disney was talking about making these big moves into the internet business. For Buffett, who famously stays within his circle of competence and avoided tech stocks, this was probably pretty uncomfortable. This new direction, in a world he didn't fully understand, likely spooked him into selling this wonderful business for a second time.
Okay, so we've talked about these two sales, these two mistakes, but what's the actual price tag? Let's try to wrap our heads around the real dollar cost of these decisions.
$8 billion. Let that sink in. That's the estimated value of what those two chunks of Disney stock would be worth today if Berkshire Hathaway had just done nothing. If they had just held on. And get this, that number doesn't even include the decades and decades of dividends they would have collected along the way. It's just a truly mind-blowing amount of money left on the table.
Now, to be fair, Buffett does have a counterargument. He sometimes points out that the money from selling Disney wasn't just hidden under a mattress. It was put to work. It was redeployed into other amazing investments like Coca-Cola. So, yeah, it was a mistake, but the capital was used to create other fortunes.
One of the best things about listening to Buffett and his partner Charlie Munger is how honest they are. They openly talk about their biggest blunders so that the rest of us can learn from them. So let's hear what they had to say about the Disney fiasco.
I mean, Buffett does not pull any punches here. He flat out calls it a huge mistake. And then he uses it to teach his most important lesson. It's way cheaper to learn from someone else's mistakes than your own. He's literally turning his own multi-billion-dollar error into a free education for all of us.
And then there's Charlie Munger, who in his classic way just cuts through all the financial jargon and gets right to the heart of it. He's saying, look, my grandkids don't ask to go see a movie made by some studio executive. They ask for Disney over and over and over again. That incredible, unbreakable bond with customers, that's the real magic. That's the source of the company's value.
So what's the big takeaway here? How can we take this incredible story and actually apply it? What does this massive mistake teach us about that really, really tough question in investing? Well, the biggest lesson is pretty clear. Selling a truly great company should be an incredibly rare event. You should only think about it if something fundamental has changed. Is your original reason for buying the stock completely gone? Is the business facing some massive, permanent problem? Has the price gone so high it's just completely disconnected from reality? Or have you found another investment that is just clearly, demonstrably better? Notice what isn't on that list. Selling just to lock in a quick profit. That's the mistake Buffett made.
And really, that's what this all boils down to. The lesson from Buffett's $8 billion mistake isn't just about stocks. It's about recognizing true long-term value in anything. So just think about it for a second. In your own life, your investments, your career, whatever it is, are you holding on to a wonderful business that you're getting tempted to cash in for a short-term win? After hearing this story, it's a question worth taking very seriously.
Let me ask you something. Have you ever been so completely, utterly sure about an investment that you thought, I'm holding this one forever? Well, Warren Buffett did with one of his most famous deals ever. But this is the story of how forever came to an end, much sooner than anyone expected. And it holds one of the most powerful lessons in all of investing, the dangerous illusion of permanence. So you got to hear this. These were the exact words of Warren Buffett back in 1986. Now, this wasn't just him being optimistic. Oh, no. This was a declaration. It was pure, supreme confidence. He was basically planting his flag for the whole world to see, saying that Capital City/ABC was a cornerstone of his empire, a business so fantastic he would never, ever sell it. But as we're about to find out, even for the Oracle of Omaha, the future always has a few surprises up its sleeve. All right, so to really get how Buffett's forever investment came apart, we're going to walk through 5 key parts of this story. First, we'll see how this permanent holding was even built. Then we'll meet the dream team that made it seem totally invincible. After that, we'll pinpoint the exact moment Buffett started looking in the rearview mirror. We'll watch him become a self-proclaimed repeat offender. And finally, we'll pull out the one lesson from all of this that really, truly is constant.
Okay, let's dive right into this. To get why Buffett's change of heart was such a big deal, you first have to understand the massive scale of the transaction that started it all. I mean, this wasn't just him buying another stock. This was a tectonic shift in the entire media landscape.
Picture this. The year is 1985. A company called Capital Cities, which was actually kind of the smaller player, does the unthinkable. It goes out and buys the broadcast giant ABC. The new company, Capital Cities/ABC Inc., instantly becomes a media titan. And at the time, this was the biggest merger in business history outside of the oil industry. It was a massive, headline-grabbing event.
And the price tag? A cool $3.5 billion. In today's money, that's well over $10 billion. Now, to pull off a deal that huge, you need a partner. Not just any partner, but one with incredibly deep pockets and an unshakable reputation. Yeah, they needed Warren Buffett. So Buffett steps up and provides the crucial piece of the puzzle, a massive investment of $515 million. This wasn't just a casual bet. It was a huge capital injection that made the whole deal possible. And for that, he got a very, very significant piece of the action.
So how much of the company did that $500 million check buy him? A full 25%. 1/4 of the entire merged company. Just like that, Warren Buffett became a part owner of one of the most powerful media conglomerates in America. So when Buffett called this a permanent holding, he really, truly meant it. He wrote that even if the stock price went through the roof and became wildly overvalued, he still wouldn't sell. He saw it the same way he saw businesses he owned outright, like See's Candies. This wasn't a stock you trade, it was a piece of a business you own forever.
So what on earth gave him that level of absolute, unshakable conviction? You might think it was all about the assets, right? The TV stations, the big brands, and yeah, those were great. But for Buffett, the real, irreplaceable value was in the people who were running the show.
First, let's just look at the assets. I mean, the company was a media fortress. It owned this huge network of TV and radio stations, plus major newspapers and magazines. You have to remember, in a pre-internet world, controlling these channels was like owning a toll booth on the information superhighway. It was a business with a giant competitive moat.
But the crown jewels, at least in Buffett's eyes, were these two men, Tom Murphy and Daniel Burke. They were the executives in charge, the brilliant operators and capital allocators who had built capital cities into a powerhouse to begin with, and Buffett's admiration for them was, well, it was completely off the charts.
I mean, just listen to that praise. That's not just a nice compliment. It is arguably the highest praise one of the world's greatest investors has ever given any management team. He believed in Murphy and Burke so completely that their leadership, on top of those great assets, made the business seem truly invincible. This was the rock-solid foundation of his permanent thesis.
And for years, that thesis held up perfectly. The company performed brilliantly. But then, the world started to change. It started changing in ways that maybe even Buffett hadn't fully anticipated. And that unshakable foundation began to show some cracks.
You can actually see the shift in Buffett's thinking just by reading his own words. In 1986, he makes that ironclad promise of permanence. But fast forward just 5 years to 1991, and he's admitting something really profound. In business, the rear-view mirror is always clearer than the windshield. In other words, looking back, the past successes were obvious. But looking ahead, the future was getting dangerously cloudy. So what was fogging up the view? Well, the answer was the dawn of the internet. This brand new platform threatened to completely flip the entire media landscape on its head. See, for decades, companies like ABC controlled what you saw and when you saw it. They had a captive audience. But the internet promised a world of infinite choice, and that would shatter those audiences into a million little pieces, eroding the massive advertising power that was the heart of the whole business. Buffett saw this long-term threat starting to form on the horizon.
And this timeline just shows you how fast everything happened. 1985, the deal gets done. A year later, in 86, Buffett declares it permanent. But just 5 years after that, in 1901, he's already publicly warning about problems in the industry. By 93, he actually starts selling, cutting a stake. And by 1995, only 9 years after his permanent promise, the company is sold to Disney. It was the end of an era.
So once Buffett saw that the industry was fundamentally changing, he didn't just stubbornly cling to his old idea, he adapted. And this led to him unwinding his permanent investment, a move that of course came with a healthy dose of his famous humor and humility.
So here's how it all went down. In 1993, he sold about a third of Berkshire's huge stake, and he booked a nearly $300 million profit after taxes. Then, in 1995, the final chapter. Capital Cities/ABC gets acquired by the Walt Disney Company. Berkshire's remaining shares were then converted into Disney stock, and that was the end of the original holding.
But here's the part that really sets Buffett apart from almost everyone else: radical transparency. See, after he sold some shares in 1993, the stock kept going up. So what did he do? He calculated the exact amount of money he left on the table by selling too early, down to the dollar, $222.5 million. And then he published that number for the entire world to see in his annual letter. Incredible.
And he didn't stop there. He wrapped his mistake in this amazing quote. See, he'd actually sold some Cap City stock too early once before, way back in the late 70s. So by doing it again, he joked that he was a repeat offender and maybe needed someone to manage his money for him. It's just a masterclass in owning your decisions, even the ones that aren't perfect.
So a permanent holding lasted less than a decade. What can we all learn from this incredible story? Well, it really boils down to two crucial, timeless lessons about investing and, frankly, about the nature of business itself. The lessons here are just so powerful. First, buying a stock is the start of the work, not the end. You have to constantly be reevaluating not just your company, but the entire industry it operates in. And second, this story really teaches us that the idea of a permanent holding is a dangerous myth. In business, the only thing that's truly permanent is change. You know, this story from the 90s is maybe more relevant today than it has ever been. Technological disruption, shifting consumer tastes, it's all happening at a blistering pace. The protective moats that kept businesses safe yesterday can just evaporate tomorrow. In this environment, being adaptable is so much more valuable than having rigid conviction. And that brings us to the final question, and this one is for you. Think about your own portfolio for a second, your own deeply held beliefs about certain companies or industries. Which of those permanent ideas deserves a fresh look? Are you driving forward by looking through the windshield? Or are you basing your big decisions on that clear, comfortable, but ultimately outdated view in the rearview mirror?
Today, we're going to get into a business story that is just wild. It's one Warren Buffett himself loves to tell, and it's got everything. A deal done on a handshake, a multi-million-dollar mistake, and maybe the most surprising rival you could ever imagine. I mean, really think about that for a second. When you picture a tough competitor, you're probably thinking about some slick executive or a giant corporation, right? But what if the person absolutely wrecking your profits was a 96-year-old? It sounds made up, but for one of the sharpest investors on the planet, it was very, very real. So to understand how this was even possible, you have to meet the woman at the center of it all. Her name was Rose Blumkin, but literally everyone just called her Mrs. B. And she was, without a doubt, the most unlikely retail mogul you've ever heard of. Mrs. B's backstory is just incredible. She came to America as a migrant, couldn't read or write English, and had zero formal schooling. But what she did have was this unstoppable drive and a ridiculously simple business plan: sell cheap. Her whole strategy was built on one thing: giving customers a better deal than anyone else. That's it. And that simple idea, it became the foundation of an empire. This whole thing started in 1937 with this much money, $500. That's all she had. And get this, it wasn't even her money. It was a loan from her brother. From just $500? Now, let's fast forward from that $500 to 1983. That little loan had exploded into this: a single store in Omaha that was 200,000 square feet. To put that in perspective, that is a massive space, like 4 football fields big. She didn't build a chain, she built a destination. And the amount of business that one store was doing, just as big. By 1983, it was pulling in $100 million in sales every single year. From a $500 loan to a 9-figure business, all driven by one woman's vision. You can see why this kind of success might have caught the attention of a pretty famous neighbor. And yep, that neighbor was Warren Buffett. This is where our two main characters finally cross paths. And their whole partnership started not with a bunch of lawyers in a boardroom, but with a simple handshake. So, in 1983, when Mrs. B was 89 years old, Warren Buffett's company, Berkshire Hathaway, bought 80% of her business for $60 million. But the craziest part of the whole thing was how they did it. It was basically a one-page contract sealed with a handshake. No armies of auditors, no months of due diligence, none of that. This really tells you everything about how much Buffett respected her. He was so blown away by Mrs. B and the business she'd built that he just tossed the usual corporate playbook out the window. He trusted her. He trusted her numbers. And that was that.
That foundation of trust was about to be tested in a way that neither of them ever saw coming. So you have this amazing partnership built on respect. How does it go so wrong? Well, this is where the story takes a wild turn. The celebrated deal led to a rivalry that is just, well, you couldn't make it up. Okay, so it all went down in 1989. After a big disagreement with her family and the management team, Mrs. B, who's now 95, by the way, up and quits. But she doesn't retire. Oh no. A few months later, she opens a brand new furniture store, literally right across the street from the one she just sold. And by 1991, this new store wasn't just some small project, it was the third biggest furniture store in the whole city. And her old store, Nebraska Furniture Mart, the one now mostly owned by Warren Buffett, oh, it was feeling it. While her new business was booming, NFM's pre-tax profit fell from $17.1 million down to $14.4 million in just 2 years. She, personally, was costing them almost $3 million in profit.
And there was no mystery about why this was happening. Suddenly, Warren Buffett was in direct competition with the woman who created the very company he just bought. His toughest opponent, the one taking millions off his bottom line, was the company's 96-year-old founder. He was getting completely outplayed by Mrs. B.
So what do you do in a situation like that? I mean, it's just bizarre. Well, if you're Warren Buffett, you admit you made a mistake, and you fix it. And that brings us to the second deal, and a very important lesson learned. So in 1991, Buffett went back to Mrs. B and bought her new store too, bringing it back into the NFM family. But this deal had one absolutely crucial difference. The first deal in 1983 had no non-compete clause. I mean, why would it? He never dreamed an 89-year-old would start a new company. This time, with Mrs. B now 97, you better believe that deal had a signed non-compete agreement. He was not making that same mistake twice.
And you can just hear the mix of respect and pure, hard-won experience in Buffett's own words. He wrote this in his 1992 letter to shareholders. He flat out admits his mistake, calling himself incautious, and then praises her spirit, saying, "Partner is better than a competitor." It just shows you, even after she cost his company millions, he still had immense respect for her. So what happened once he bought her out and brought her back? The results were immediate. I mean, look at this. The year after Buffett bought that second store, NFM's profit shot right back up to $17.1 million, exactly where it was before she left. That proves it, right? It was all her. She was the one driving all that competition.
So after all that, what can we pull from this incredible story? It's so much more than just a funny business anecdote. There are some really powerful lessons here about business and maybe more importantly, about people.
For me, two big things really jump out. First, yeah, contracts matter. But Buffett's real mistake wasn't just a missing clause. It was underestimating the pure, fundamental drive of a founder. You have to know who you're getting into business with. And second, never, ever underestimate family dynamics. The whole reason she left wasn't about some grand business strategy, it was personal. And that one disagreement completely changed the furniture market in Omaha.
And what about Mrs. B? You think she slowed down? Not a chance. After signing that non-compete at age 99, she kept right on working. She ran her store as part of NFM until she was 103 years old. She passed away in 1998 at the age of 104, leaving behind this incredible legacy of just pure, unstoppable determination. Which kind of leaves us with one final thing to think about. What was the real engine of this story? Was it the legendary business smarts of Warren Buffett, who saw a mistake and fixed it? Or was it the singular, unbreakable entrepreneurial spirit of Rose Blumkin, a woman who proved that age is just a number and that your toughest competitor can come from somewhere you never, ever expected? Warren Buffett is a legend for finding businesses with these incredible, long-lasting competitive advantages, what he calls moats. But what happens when one of his absolute favorite investments, a brand he truly loved, runs smack into a technological tidal wave it never saw coming? Well, that's what we're here to talk about. This is the story of World Book Inc., and it's a powerful cautionary tale from the man himself. I mean, just let that sink in for a second. This is Warren Buffett in his 1995 annual report admitting that World Book was his single most difficult problem. He wasn't talking about some minor business. He was talking about what was supposed to be a crown jewel. This one sentence right here really sets the stage for the absolute free fall that was about to happen. So that's the big question, right? How on earth did this happen? How did a product that seemed totally unbeatable, with the backing of the smartest investor on the planet, suddenly find itself fighting for its life? The answer, as we're about to see, is a huge lesson for anyone trying to understand business today. Okay, so before we get to the collapse, you have to understand just how high this company flew. We've got to go back to the beginning, when Buffett first saw World Book and decided he just had to own it. The story really kicks off in 1986. Berkshire Hathaway buys this holding company called Scott and Fetzer, which owned a bunch of different businesses, 17 of them in fact. But let's be real, Buffett wasn't just collecting companies. He had his eye on one specific prize, World Book Inc. And he was definitely willing to open up the checkbook for it. The whole deal for Scott and Fetzer was $315 million. Now, you have to remember, for Berkshire back in '86, this was a major acquisition. This was a big, serious bet on the future of how people get information. Now, here's where it gets really telling. Look at the numbers. Berkshire paid $315 million for a company whose assets were only valued at $173 million. So what about that huge gap, that extra $142 million? Well, in accounting terms, that's called goodwill. But for Buffett, it was way more than that. It was the price he was willing to pay for what he saw as a totally dominant brand with an unstoppable business model. And this chart shows you exactly why he was willing to pay up. Of all 17 businesses that came in the deal, World Book was the absolute engine. It was bringing in a massive 40% of the entire group's revenue. There was no question. It was the crown jewel of the whole operation. But you know, this wasn't just some cold, calculated numbers game for Buffett and his partner Charlie Munger. They had a real personal connection here. They viewed the World Book Encyclopedia as this special thing, a tool for education that they really genuinely admired. And that emotional attachment makes what happened next all the more interesting. And hey, for a couple of years, Buffett's bet looked absolutely brilliant. World Book was just humming along, making money hand over fist. This was truly its golden era. By 1991, things were looking incredible. World Book's pre-tax earnings hit an all-time high of $31.8 million. At this point, it seemed like the perfect investment, a fantastic business with a moat that looked a mile wide and completely unbreachable. But right as World Book was at the absolute top of its game, the world was quietly changing underneath it. A technological revolution was starting to bubble up, and it was about to become a digital tsunami that would sweep everything away. So, in the early 90s, personal computers start showing up in everyone's homes. And then, in 1993, Microsoft drops a bombshell. It's called Encarta. It's an entire encyclopedia, not in 22 heavy books, but on one single shiny little CD-ROM. And just like that, the game changed. Okay, this is probably the most important slide in the whole story, because it shows how different their business models were. World Book relied on this giant army of door-to-door salespeople to sell their beautiful, expensive printed sets. Microsoft? They just bundled Encarta for free or for next to nothing with every new PC they sold. The competition wasn't just a better product, it was a completely different, almost frictionless distribution model. All of a sudden, World Book's biggest strength, that sales force, looked ancient. And the effect wasn't gradual, it was like a light switch flipped. This new digital challenger delivered a knockout punch almost immediately, and World Book began this steep, painful journey of facing a reality it was not prepared for. I mean, just look at these numbers. From that peak of nearly $32 million in 1991, their earnings absolutely cratered to just $8.8 million only 4 years later. We're talking about a drop of more than 70%. The sheer speed of that collapse is just breathtaking. It really shows you the raw power of technological disruption. And this table really just spells it all out. You see the peak in 91, that catastrophic fall to 8.8 million by 95, and then a tiny little bounce in 96. But don't be fooled by that little uptick. The trend was clear and it was irreversible. The old, incredibly profitable business model was completely and totally broken. Now, to be fair, the folks running World Book didn't just sit there and watch the ship sink. They absolutely scrambled. They poured money into developing their own electronic products. They cut costs like crazy. They really tried to adapt. But here's the brutal new reality they faced. Information was becoming free, and you just can't compete with free when your whole business is built on selling something for a premium. It was an impossible fight. And this is Buffett in 1996, basically admitting it's over. He's not promising a big turnaround. He's not telling everyone to hang on. He's just stating the facts, telling his shareholders the world has changed. This is the moment a legendary investor has to look everyone in the eye and say that technology just destroyed one of his best businesses. The magic was gone and it wasn't coming back.
But you know what they say? Failure is often the best teacher. And the spectacular collapse of World Book taught Buffett, and by extension all of us, some incredibly important lessons about investing in a world that changes in the blink of an eye. So what do we take away from all this? First, you have to be able to spot these titanic shifts. The CD-ROM wasn't just a new product. It completely rewrote the rules for an entire industry. Second, it forces you to ask what a lasting competitive advantage really is. World Book had a killer brand, but that was no defense against a new distribution model. And finally, and this is maybe the biggest one for Buffett himself, you simply cannot afford to ignore technology anymore. Pretending you don't need to understand it just isn't a winning strategy. When you boil it all down, the story of World Book is this stark reminder that no business is invincible. No moat is so deep that it can't be crossed. Even the most loved products, run by the smartest people in the world, can become obsolete almost overnight when technology makes a major leap forward. And that really leaves us with one final crucial question for today. As we're standing here looking at this massive new wave of change with artificial intelligence, what are the dominant, seemingly untouchable companies right now that could be the World Books of tomorrow? What seems invincible today, but might just be one big innovation away from a sudden, dramatic fall? It's definitely something to think about.
You know, even the legends get it wrong sometimes. And today, we're going to talk about a really big one. This is the story of how Warren Buffett, that Warren Buffett, made a huge, and he'll be the first to tell you, self-admitted mistake with the airline industry. It's this incredible story of flawed analysis, some really hard lessons, and, believe it or not, a surprising second act.
And look, he's not trying to make any excuses here. In his 1994 annual report, Buffett straight up called his U.S. Air investment an unforced error. He didn't blame the market, he didn't blame his team, he blamed himself. He pointed right to his own sloppy analysis and even admitted to a bit of hubris. I mean, just stop and think about that for a second. How often do you hear that kind of raw honesty from someone at that level? It's exactly why this story is so compelling.
And yeah, we're not talking about some small miscalculation here. This was a $358 million mistake. That's the amount of cash Berkshire Hathaway put on the table way back in 1989. And just to put that into perspective for you, this was an absolutely massive bet, even for a company the size of Berkshire back then.
All right, so here's our game plan for today. First up, we'll look at the unforced error itself. Then, we'll get into why the airline business is what you might call an unregulated commodity. After that, we've got the surprising second flight. And finally, we'll pull it all together with some lessons from the legends.
Okay, so let's get right into it. Part 1, the unforced error. We're going back to 1989, and the deal is with a company called U.S. Air Group. And you know, if you looked at it from the outside, it seemed like a classic textbook Buffett investment.
And it's not hard to see why the deal looks so attractive, right? Berkshire wasn't just buying regular old stock. Nope. They bought what are called preferential shares. This meant they were guaranteed a really nice 9.25% annual dividend. On top of that, they got an option to convert those shares into common stock down the road if the company took off. So it really looked like the perfect setup, a super safe bet with this massive potential upside.
So the thesis was pretty straightforward, right? Lend U.S. Air some money, sit back and collect those juicy dividends, and then, if all goes well, cash in on the equity. Simple. But the reality? Well, it was a completely different story. Almost right away, the airline went into what's been described as an uncontrolled descent. A really messy merger with another airline, Piedmont, just created total chaos. And all those fundamental, deep-rooted problems with the airline industry started bubbling to the surface fast.
And that really brings us right to the heart of the issue, doesn't it? The airline business is basically an unregulated commodity. This is the key to understanding why this investment went south. That sloppy analysis Buffett talked about, it was really a failure to fully appreciate just how brutal the economics of this industry truly are.
Okay, so here's the big idea. Think about an airline seat. Is a seat on airline A from New York to LA really that different from a seat on airline B? Not really. It's a commodity. It's like selling wheat or oil. And when your product is a commodity, when you can't really stand out from the competition, what's the only way you can compete? Price. You're forced to compete on price. And that, my friends, is a brutal race to the bottom. It's an absolute disaster for long-term profits.
And if you look closer, you see all these traps built into the industry. First, it is ridiculously capital intensive. You are constantly having to spend billions on new airplanes. Then you've got your costs, which are all over the place. Fuel prices go up, crew salaries go up, it's super volatile. Meanwhile, you've got fierce price competition with other airlines always trying to undercut you just to fill a seat. And on top of all that, your fixed costs, things like bidding for routes and gate space, are just enormous. It's like a perfect storm designed to just incinerate cash.
And wow, the financial hit was real. Just look at these numbers. By 1995, only 6 years after they put the money in, Berkshire's $358 million investment had shrunk to just $215 million. Ouch. That is a painful, painful lesson in what happens when you bet on a business with a fundamentally broken model. But here's the thing, the story doesn't end in total disaster. Luckily for them, a new CEO named Stephen Wolf came in and somehow managed to pull the company back from the absolute brink. He stabilized things just long enough for Berkshire to get out. They managed to recover their principal investment and all the dividends they were owed, so they narrowly, and I mean narrowly, avoided a complete catastrophe.
Okay, and now for the part of the story that makes you go, wait, what? You would think after getting burned that badly, Warren Buffett would swear off airline stocks for the rest of his life, right? Well, that's what makes this next part so interesting, our surprising second flight, because decades later, he jumped right back into the fire.
So, this second journey starts in 2016, and this time the strategy was completely different. And for a while it actually worked. By 2019, the holdings were up in value, they were paying dividends, things were looking good. And then 2020 happened. The COVID-19 pandemic brought the entire industry to a screeching halt, and just like that, Berkshire sold everything.
So what was the big change in strategy? Well, this time, instead of picking one single airline, they used a basket approach. They didn't just bet on one horse. They basically bought the 4 biggest horses in the race. We're talking Delta, Southwest, United, and American. The idea was to stop betting on a single company and instead make a broad bet on the U.S. airline industry as a whole.
So there you have it. Even with a brand new, seemingly smarter strategy, the second attempt also ended pretty badly, thanks to a completely unforeseen event. And that brings us to our final, and maybe most important section, lessons from the legends. After watching all this play out, what are the big takeaways for us? And this quote from Buffett himself just sums it all up perfectly. He says, "The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money." And what example does he use? Think airlines. It's just brutal. They're constantly growing, constantly needing to pour more and more money into the business, but at the end of the day, they just can't seem to make any real lasting money.
So what are the big lessons we can all pull from this? Well, there are 4 big ones. Number 1 is insight. Before you even think about investing, do you truly understand the nuts and bolts of the business? 2 is finding the edge. What is this company's durable, lasting competitive advantage? What makes them special? 3 is focusing on earnings. Don't get distracted by flashy sales growth. Are they actually retaining earnings? And finally, number 4, analyze capital needs. Be ruthless in figuring out how much cash this business needs just to survive and grow.
And, it wasn't just Buffett who felt this way. His legendary partner, the late, great Charlie Munger, was, as always, a little more blunt. He just called the whole thing very unpleasant and quipped that when it comes to airlines, they are very slow learners. It's just such a great, humble reminder that even the absolute sharpest minds on the planet can get tripped up by a really, really tough business.
So when you boil it all down, this is about so much more than just one bad investment. It's really a story about the power of clear thinking, and maybe even more importantly, the humility to look at your own mistakes, own them, and learn from them. And that really just leaves us with one final question to think about. What unforced error in your own thinking might be worth revisiting?
Let's talk about one of Wall Street's most powerful firms, a real titan, brought to its knees by one trader's mistake. It was a high-stakes crisis that honestly threatened to spiral completely out of control. And at the center of it all was a legendary investor who had to risk his own reputation to save it. This is the incredible story of Salomon Brothers and what turned out to be the ultimate test of integrity.
This quote from Benjamin Franklin, it absolutely nails the heart of this story. It's such a powerful reminder of how incredibly valuable and yet how fragile a good reputation can be. So keep this quote in the back of your mind because it is the central theme of literally everything that's about to unfold.
All right, so how in the world did one of the most cautious investors on the planet get tangled up in such a crazy drama? Well, our story kicks off in 1987. The markets were booming, and Warren Buffett made a move that surprised a lot of people. He made a massive investment in one of Wall Street's biggest players, Salomon Brothers. $700 million. I mean, just think about that number for a second. This wasn't him just buying some stock on the open market. Oh no, this was a major negotiated deal for his company, Berkshire Hathaway. It was a huge vote of confidence. And the way he structured the deal, well, that tells you a lot about his thinking.
See, Buffett didn't just buy regular old stock. He bought something called preferred shares, which was one of his favorite ways to invest back then. You can think of it as a kind of hybrid. It gave him a nice, steady, fixed income, kind of like a bond. But, and this is the good part, it also came with the option to convert those shares into common stock down the road, hopefully at a fantastic price. It was designed for safety, but with a really big potential upside.
So why Salomon of all places? Well, on paper, they were an absolute powerhouse. I mean, they were the most profitable investment bank on Wall Street, and they were literally minting money. With their strong returns and the potential of those preferred shares, it looked like a brilliant, almost can't-miss investment.
But here's the thing about Buffett. It was never, ever just about the numbers. A huge piece of the puzzle for him was trust. He and his partner, Charlie Munger, had a long history with Salomon's CEO, a guy named John Gutfreund. Gutfreund had actually been a key player in helping Buffett rescue Geico from near bankruptcy years before. So they really believed in his honesty and his ability to run the show. And yet, despite all these green lights, Buffett himself later admitted he lacked insight into how it would all turn out. Wow, that's a pretty fascinating bit of foreshadowing, right? It's a little hint that even for one of the greatest investors of all time, the complex world of Wall Street held some serious unpredictability, which was about to become dangerously clear.
Okay, let's jump forward to 1991, 4 years after that big investment. This is where the story takes a sharp, and I mean sharp and dangerous turn. A seemingly small screw-up by a single trader is about to light a match that will threaten to burn the whole firm to the ground.
And here's how fast it all went down. It started with one trader breaking the rules in a U.S. Treasury bond auction. Now that's a big deal on its own, but the real problem was what happened next. Management, including the CEO, John Gutfreund, found out about it and did nothing. They just swept it under the rug. Incredibly, the same trader then did the exact same thing again. So by the time the Treasury Department discovered what was going on, they weren't just angry about the rule breaking, they were absolutely furious about the cover-up.
And the fallout was immediate and just brutal. Salomon was prosecuted by the U.S. government. They got slammed with massive fines. But the most devastating blow, the one that could have killed them, was this. They were suspended from participating in government bond auctions. For a firm like Salomon, that was a death sentence. It was like telling a grocery store they weren't allowed to buy food anymore. The firm was pushed right to the very edge of collapse.
So, with Salomon on the brink and all of Wall Street just watching in horror, Buffett realized this was way bigger than just his investment. The collapse of a giant like Salomon could have triggered a systemic crisis, a domino effect across the whole financial system. As a major investor and board member, he knew he had no choice. He had to step in.
And what he did next was just a masterclass in crisis management. I mean, zero hesitation. First, he took command, becoming the interim chairman. Second, he signaled complete transparency, immediately handing over every single document the SEC needed. And third, and this was the game-winning move, he made a personal appeal directly to the U.S. Treasury to reverse the ban. The fate of the entire firm was hanging on that one conversation.
So, why on earth did the Treasury change its mind? Well, this quote from Charlie Munger tells you everything you need to know. It wasn't about some fancy legal argument or financial gymnastics. The U.S. Treasurer, a man named Nick Brady, trusted Warren Buffett personally. In that one critical moment, it was Buffett's lifelong reputation for integrity, not Salomon's, that saved the company. It was the ultimate proof of that Franklin quote we started with.
So, in the end, Buffett's reputation worked. The firm was saved. In 1992, Salomon paid a massive $290 million fine to settle all the charges. It was a steep price, but it let them live to fight another day. The immediate crisis was over. But the story?
oh, it was far from finished. So the company survived, and Buffett even made a profit in the end. Case closed, all good, right? Well, not quite. Now we have to look at the real bottom line of this whole thing, because the financial numbers, they only tell a tiny part of the story.
Let's start with the financials, though. In 1997, Salomon was eventually sold to another company, the Travelers Group. And when that happened, Berkshire Hathaway doubled its initial investment. So, from a purely numerical point of view, the investment was a success. They put in $700 million, they got back about $1.4 billion.
But how do you weigh that profit against the true cost? On one side of the scale, you've got the financial gain. Okay, but on the other side, you have the immense stress, the time, the agitation, as Buffett and Munger called it. And most importantly, Buffett's own non-reversible reputation was put on the line. I think the conclusion is pretty clear. The indirect cost was so much greater than any financial profit.
This whole experience really solidified Buffett's core philosophy. He actually delivered this line in testimony during the investigation, and it became his clear, unmistakable message to all of his employees. It just draws such a powerful line in the sand. Money can be lost and made again, but reputation, once you tarnish that, it's nearly impossible to get back.
You know, looking back on it all, both Buffett and Munger would later admit that, yeah, the investment in Salomon was at the end of the day a mistake. But it was a mistake that gave them some of the most powerful and lasting lessons of their entire careers.
So what are the big lessons we can all take away from this? First, trust is the ultimate currency. It was Buffett's personal credibility, not Salomon's balance sheet that saved the firm. Second, it shows the danger of investing where you don't have deep insight. Buffett himself said he didn't fully understand the business, and it nearly cost him everything. And finally, that even when you trust people based on past experiences, like Buffett trusted Gutfriend, you still have to be vigilant. Sometimes, the culture of a company can just swallow up the character of its leaders.
The Salomon Brothers saga really forced one of the world's best investors to confront what his reputation was truly worth. It kind of makes you think, doesn't it? So I'll leave you with this to ponder. For you, personally, what is the one thing you would never be willing to risk, no matter how big the potential financial reward?
You know, when you think of Warren Buffett, words like genius and legend probably come to mind, right? But what about his mistakes? I mean, his really big mistakes. Well, today we're going to pull back the curtain on the one deal that Buffett himself calls his absolute worst. We're talking about a mistake of such epic proportions that it actually teaches us more than a lot of his successes. This is the story of the Dexter Shoe disaster.
Look at that. Those are not my words. That's a direct quote from the man himself. He doesn't just call it a mistake. He says it deserves a spot in the Guinness Book of World Records for financial disasters. Wow. That is an incredibly dramatic thing to say, and it perfectly sets the stage for how a deal that looks so good on paper just completely unraveled into a legendary catastrophe.
So what does a world record disaster look like in cold, hard cash? $3.5 billion. That is the final price tag Buffett eventually put on this one single error. Now, you have to remember, the initial deal was for about $433 million. So the big question we're going to unpack here is, how on earth did a $433 million deal end up costing Berkshire Hathaway shareholders billions? The answer, it turns out, is a masterclass in what not to do.
Okay, so to really get this, we have to kind of hop in a time machine and go all the way back to 1993. Because at the time, buying the Dexter Shoe Company didn't look like a disaster waiting to happen at all. Actually, it was the total opposite. On paper, this thing looked like a classic, can't-miss, slam-dunk Buffett investment. It had all the hallmarks of a business he absolutely loved.
I mean, on the surface, what wasn't to love? Dexter was a super popular, American-made brand pumping out millions and millions of pairs of shoes every year. It was run by its founder, a guy named Harold Alfond, who Buffett really trusted. And here's the kicker. Both Buffett and his legendary partner Charlie Munger gave it their full stamp of approval. Plus, Buffett wasn't new to this space. He'd already made good money with other shoe companies. He was so into it, he apparently used to sing, "There's no business like the shoe business."
So at the very core of his thinking, Buffett was convinced that Dexter had what he famously calls a durable competitive advantage, or a moat. Now for Buffett, this is the holy grail. It's like a castle having a giant moat around it protecting it from invaders. It's that unique strength that protects a business from its competitors and lets it just rake in profits for years, or even decades. He looked at Dexter's brand, its U.S. factories, its management, and he thought that moat was deep, wide, and filled with crocodiles.
And, well, this is where the story takes a hard right turn. That moat, the very thing the whole investment was built on, it didn't just get a little smaller,
It basically evaporated. Poof, gone, almost overnight. That durable competitive advantage turned out to be anything but. Let's dig into what went so wrong.
The killer was globalization. Simple as that. A massive flood of low-cost shoes started pouring in from other countries. Now, to be fair, Buffett and Munger weren't totally naive about this. They knew it was a risk, but they made a huge miscalculation. They completely overestimated Dexter's ability to fight off this new wave of competition. They thought the brand was strong enough, the quality high enough to withstand the pressure on price. They were dead wrong.
And the scale of this disruption was just staggering. Check this out. By 1999, only 6 years after Buffett bought the company, the U.S. shoe market had been totally conquered. An absolutely mind-blowing 93% of all shoes sold in the United States were imported. That left American producers like Dexter fighting for the scraps in just 7% of the market. The game hadn't just changed, a whole new game had started, and they weren't even on the field.
So as the profits started to tank, even Buffett fell into a really common mental trap. Let's call it denial bias. He actually told his shareholders that this was just a temporary dip, a cyclical problem, he called it, and that things would bounce back. He didn't see it as a secular problem, which is a fancy way of saying a permanent, fundamental change in the entire industry. He still had hope. It's a pretty powerful reminder that even the smartest people can have a hard time admitting when a core belief is wrong.
Okay, but here's the thing. Buying a failing business, that was only mistake number one. The second mistake, how he paid for it, is what turned a pretty bad investment into a multi-billion-dollar catastrophe. And honestly, this is where the biggest lesson is.
Buffett himself breaks his failure down into these two distinct layers. First, the initial mistake. He bought a business whose special advantage, its moat, was about to disappear. That was just a bad call. But the compounding mistake, the one that just multiplied the financial pain like crazy, was paying for Dexter not with cash, but with shares of his own amazing company, Berkshire Hathaway.
So he paid with a little over 25,000 shares of Berkshire stock, which were worth $433 million back then. What he was really doing was trading 1.6% of his incredible fast-growing company for Dexter, a business that would soon be totally worthless. And as Berkshire's value just went to the moon over the next decade, the value of those shares he gave away exploded to $3.5 billion by 2007. I mean, today it would be tens of billions. It's just brutal.
This is a perfect, and I mean textbook example of something called opportunity cost. By using Berkshire stock, the true cost wasn't the $433 million. Oh no. The true cost was what those shares would have been worth if he had just kept them. He traded a world-class appreciating asset for what turned out to be a melting ice cube. See, if he had just paid cash, it would have been a $433 million mistake. Bad, but it's over. By using stock, it became a mistake that just kept getting bigger and bigger and bigger.
So after all that, what can we learn from a mistake this huge? Well, Buffett's failure with Dexter Shoe gives us some of the most valuable, hard-won wisdom you can find anywhere in the business world. Let's break down the billion-dollar takeaways.
Okay, here are the three big ones. First, you have to beware of globalization, especially in a business where the product is kind of a commodity, like a basic shoe. The lowest cost producer is almost always going to win. A moat built on where something is made is just super fragile. Second, you have to guard against overconfidence. Buffett's past success in shoes kind of blinded him to what was coming. And third, and this might be the most important one, your own company's stock, your equity, is incredibly precious and expensive. Using it to buy something else is like paying with a winning lottery ticket. You know what I love most about this whole story, though? It's Buffett's complete ownership of it. There's no ego, no trying to spin it. This quote right here shows incredible humility. He just flat out admits he messed up and says, you know what, I'm not perfect and I'm going to fail again. It's such a powerful reminder that learning never stops, and sometimes the biggest screw-ups are actually the best teachers.
And that really brings us to the final thought here. The story of Dexter Shoe isn't just about Warren Buffett. It is a cautionary tale for every single one of us. Overconfidence, born from past success, led one of the sharpest minds on the planet to make a multi-billion-dollar blunder. And it just forces us to ask ourselves, what assumptions are we making? What huge shift in our world might we be underestimating? Ultimately, it forces us all to ask that really tough question, what is my biggest blind spot?
All right, let's talk about one of the greatest investors in history, the one and only Warren Buffett. Now, we could talk all day about his incredible successes, but today we're doing something different. We're diving into one of his blunders, and not just any blunder, a self-admitted billion-dollar mistake that involves a brand pretty much everyone on Earth knows, McDonald's.
And to really get our heads around this story, we have to start right here, with this absolutely mind-bending quote from Ray Kroc, the guy who basically built the McDonald's we know today. We are not in the food business, we are in the real estate business. I mean, just let that sink in for a second. This one idea, this is the key to the entire puzzle, and it's what makes Buffett's decision so fascinating.
Exactly. So before we can even get to Buffett's big investment, we first have to understand what McDonald's really is. It's a business model that was kind of hiding in plain sight, built on a foundation of something way more solid than just burgers and fries.
I mean, the scale of this company is it's staggering. We're talking about the world's biggest fast food chain, over 40,000 restaurants in more than 100 countries. It's got the 6th highest brand valuation on the entire planet. This thing isn't just a company, it's a global institution, a true titan of industry.
And you know who is a huge fan? Warren Buffett himself. He was a regular customer, often grabbing breakfast there on his way to work. In fact, get this, he has a McDonald's Gold Card. Yeah, that's a real thing. It gets him free food for life. So this wasn't some company he was just looking at on a spreadsheet. He was a loyal customer. He knew the brand inside and out, or so he thought.
So given how well he knew the brand and its massive global reach, it really seemed like a perfect match when his company, Berkshire Hathaway, decided it was time to take a very, very big bite of the Golden Arches.
Let's set the scene. The year is 1996. McDonald's is expanding like crazy all over the world. And this is when Buffett's firm makes its move, officially putting its money into the McDonald's Corporation. Everything was lined up for what looked like another classic long-term Buffett home run.
And we're not talking about a small casual investment here. He committed a whopping $1.3 billion. That just shows you the level of conviction he had. This wasn't a test run. It was a major, major investment in a brand he knew and loved. So that $1.3 billion bought Berkshire Hathaway 4.3% of all of McDonald's common stock. I mean, to own over 4% of a company that massive is a huge statement. So at this point, everything looks like a textbook Buffett play, right? But then, in a move that honestly shocked a lot of people, things took a very sharp, very unexpected turn.
Because almost as quickly as he bought it, he sold it. All of it. The conviction just vanished. And Buffett himself would later call this decision a very big mistake. So, what on earth happened? What went wrong? Okay, so here was the core of his doubt. Buffett felt that customer loyalty to McDonald's was, well, kinda weak. You might eat there today, sure, but you could just as easily go to Burger King or a taco place tomorrow. He compared that to his other huge investments, like Coca-Cola and Gillette. Think about it. You don't just switch your favorite soda or your razor on a whim. He saw that loyalty as a powerful, durable, competitive advantage, his famous moat, and he just didn't see that same deep moat around the Golden Arches.
And it wasn't only that. Remember that quote about the real estate business? Well, he found it incredibly tricky to untangle the food side from that massive property empire. Plus, you had this ridiculously complex web of franchise deals in all those countries. And then, and this is very un-Buffett-like, he admitted he got too caught up watching the daily wiggles of the stock price. The whole thing just started to feel wrong to him.
But you don't have to take my word for it. In his 1998 letter to his shareholders, Buffett was brutally honest. He flat out called the sale a very big mistake. And then he added this classic line, saying his investors would have been better off if he'd just gone to the movies instead of making that trade. You gotta love that kind of honesty.
Okay, so he called it a very big mistake. But how big are we talking, really? Let's actually quantify this blunder. Because this is where the story goes from being just a bad call to a truly mind-boggling, multi-billion-dollar what-if scenario. So let's play that what-if game. Had Buffett just held on to that $1.3 billion investment from 1996, by March of 2024, it would have grown tenfold, 10 times. That position would have been worth around $13 billion. That is a staggering amount of money just left on the table.
And wait, it gets even more painful. On top of that huge increase in value, Berkshire Hathaway would have also collected over $2 billion in dividends. That's just pure cash flowing into the bank account. So the total opportunity cost here was way, way north of $13 billion, all because he sold too early.
So what can we all learn from this incredibly expensive error? Well, believe it or not, it actually gives us some of the most powerful investment advice you can get. And it all kind of boils down to mastering what you could call the art of inactivity.
Let's break down the playbook here. First, find brands that can go global, brands that travel well. McDonald's was a perfect example. Second, when you find one, be prepared to hold it for the long haul to really capture that growth in those dividends. Third, and this is the big one from this story, learn to do nothing. So much of successful investing is just sitting tight and letting your great companies do their thing. And that leads to the last point, avoid making hyperactive mistakes. Constantly tinkering and second-guessing yourself is often what gets you into trouble.
And that leaves us with one last big question to think about. If even Warren Buffett, the Oracle of Omaha, can admit one of his biggest mistakes came from being too active, it really forces you to ask yourself, in a world that is always screaming at you to do something, is it possible that your best financial move is no move at all?
When you think Warren Buffett, you think stocks, right? Buying great companies, holding them forever. But what if I told you one of his most fascinating moves ever had nothing to do with any of that? It was a huge billion-dollar scale bet on a physical commodity. Today, we're unpacking Buffett's incredible silver trade.
All right, let's get into it. Here's how we're going to break this whole thing down. First, we'll look at just how big this trade was. Then we'll dig into the logic behind it. We'll even hear from the men themselves who made the call. Analyze whether it was a smart move or distraction. And finally, pull out some key lessons for all of us. Okay, first up, to really get why this was so out of character, we need to understand the sheer scale of it. I mean, this was not Buffett just dipping a toe in the water. This was a move that made the entire commodities world sit up and take notice. So let's set the scene. The year is 1996. Everybody's going nuts over the dot-com boom, right? Well, behind the scenes, Berkshire Hathaway was quietly starting to buy up a massive, and I mean massive, amount of physical silver. And how massive are we talking? 111 million ounces of silver. Just let that number sink in. That's not a typo. 111 million. To put that into perspective, this wasn't just buying some silver. This was basically an attempt to corner a giant piece of the global market. Think about it. One company bought almost a quarter of what the entire planet produced in a year. The price tag for all this? Over $650 million. Now, to be fair, for a giant like Berkshire, that was only about 2% of their capital. So it was a big bet, but it wasn't going to sink the company. And the result of this huge, unusual bet? A cool $97 million profit. So yeah, it definitely paid off. But for a guy who buys businesses, not metals, it was a really weird move. Which brings us to the big question. Why on earth did he do it? So what was going through his head? This was no random gamble, believe me. It was a super calculated trade, and it was all built on a classic economic idea that Buffett had apparently been watching for decades. Get this was not some sudden whim. Buffett had been keeping an eye on the silver market for more than 30 years. Can you imagine that kind of patience? 30 years of just watching and waiting for the perfect set of conditions to line up. And when they finally did, he pounced. Now, this slide right here basically explains his entire thinking. It's beautiful in its simplicity. On one side, you had demand that was just exploding. It was being used more and more in photography, in all sorts of industries, in jewelry. But on the other side, you had a really tight supply. So you can't just decide to mine more silver. Most of it comes out of the ground when you're digging for other metals like copper or gold. Buffett saw this perfect storm brewing, a classic squeeze, where demand was just bound to run away from supply. But, don't just take my word for it. Let's actually hear from the two guys at the top, Warren Buffett and his legendary partner, Charlie Munger. What they said about it at their 1998 annual meeting is just, well, it's incredibly telling. So when somebody asked Buffett about this huge silver purchase, he didn't start talking like a Wall Street trader. Nope. He talked about fundamental value and how the market was just plain wrong. What he's basically saying here is, look, the price tag on silver when we bought it, it was broken. It was just too low to make supply and demand work in the long run. He wasn't speculating. He was making a bet that basic economics would have to kick in and push the price up. And this is where it gets really fun. Because, of course, Charlie Munger had a very different and very blunt way of looking at the whole thing. That is classic Munger right there. He just brilliantly downplays this entire $650 million operation, basically calling it a harmless little hobby to keep Warren busy, like playing cards. He wasn't saying it was a bad idea, just that in the grand scheme of things for Berkshire, it was a tiny little sideshow.
Munger's comment really just tees up the whole debate perfectly, doesn't it? Was this just a profitable hobby, like he so politely put it, or was it something more problematic? A strategic mistake, even a distraction from what they do best? I mean, look, you can't really argue with a $97 million profit. On paper, it was a total success. But for an investor who is laser-focused on buying businesses, the argument goes that any time, any energy, any capital you spend on something else, well, that's capital you can't spend on your main goal. It's a diversion. And from that point of view, you could actually call it a mistake. And this right here just lays out that tension perfectly. The case for the trade is easy. It made a ton of money based on solid, simple economics. The case against it is all about principle. It pulled focus, time, and money away from their real game, which is buying great companies. It wasn't investing, it was trading. So, after all that, what are we supposed to take away from this wild chapter in financial history? Well, the lessons are actually totally different depending on what kind of investor you see yourself as. Let's break it down into two separate paths. First, the path of the commodity trader, and second, the path of the equity investor, the path that Buffett himself usually walks. Okay, so if you're a commodity trader, Buffett's silver play is basically a masterclass. It just hammers home that you have to know your market cold. You need a deep, deep understanding of supply and demand, and you need the unbelievable discipline to wait, sometimes for decades, for that perfect moment. And then you have to act decisively. But, and this is probably the lesson for most of us, if you're an equity investor, the takeaway is all about caution and focus. This kind of thing should be an extreme rarity. Think of it like Munger did. It's a hobby, not your main strategy. It's something you might do once in a blue moon when a market is so obviously out of whack that it's screaming at you. And even then, it should only ever be with a tiny sliver of your capital. And that leaves us with this one last really big question. Buffett won this game. He made the right call on silver. But his legend, his entire empire, was built in the world of stocks. This whole story forces us to ask, is it better to become a master of one single game, or is it sometimes smart to step onto a totally different playing field? It's a huge question of focus versus opportunism, and as Buffett's big silver bet shows, there's just no easy answer. All right, let's dive into one of the great puzzles in modern investing. It's a fascinating story about Warren Buffett, Charlie Munger, and a multi-billion-dollar decision that seems to break every single one of their own rules. And this, right here, is the question at the heart of it all. We are talking about Costco, a company that Buffett and Munger publicly raved about for decades. So why on earth, after all that time, would they sell every single share? It doesn't make any sense on the surface. So, let's set the scene. The moment came in 2020. Berkshire Hathaway sold out completely, every last share of Costco. Poof, gone. At the time, the stock was hovering around $350 a share, and they cashed out for about $1.3 billion. Okay, but here's the real kicker. Fast forward just a few years to March 2024, and that exact same stock is trading for $736. They sold at $350, and it more than doubled. That's not just a little bit of missed upside. We're talking about over $1 billion in profit just left on the table. So what in the world was going on? To really understand why this sale was such a shocker, you have to get the history here. This wasn't just another stock ticker in their massive portfolio. No. This one was personal. First off, let's just remember who we're dealing with. Costco is a global retail powerhouse. Their whole model is beautifully simple. Use a membership fee to deliver absolutely incredible value to their customers. And it has made them an absolute titan in the industry. And the connection between Berkshire and Costco goes way, way back. Buffett first bought shares in 1998. That same year, he helped get his partner, the legendary Charlie Munger, a seat on Costco's board. And Munger stayed on that board right up until he passed away in 2023. You see, this wasn't just a passive investment. It was a decades-long, deeply personal relationship. And that is the key here. This was never just about the money for them. It was a business they genuinely, truly admired. They didn't just like the balance sheet. They respected the culture, they loved the business model, and they trusted the people running the show. And hey, don't just take my word for it. Listen to Buffett himself talking way back in the year 2000. That's a full 20 years before they sold the thing. He's on record calling Costco an absolutely fabulous organization, and his one regret? That he blew it by not buying a whole lot more. And that just makes this whole puzzle even weirder. Despite Buffett openly saying he blew it by not buying more, and with Munger having the ultimate insider's view as a board member, they never actually did buy much more. The position always stayed relatively small in the grand scheme of Berkshire's portfolio. Why?
So, all of this history, all this deep admiration, it all brings us to the main event, that completely baffling decision to sell it all in 2020.
And then, boom, they pulled the trigger. The entire position, a relationship built over more than 2 decades, was sold for $1.3 billion. Just like that, it was over.
Which brings us right back to that big burning question. Why would they do it?
You know, the investment world went into an absolute frenzy trying to figure it out. So let's walk through some of the most common theories and see if any of them actually hold water.
Okay, so 2 main theories popped up right away. First, was Buffett just scared of e-commerce? You know, the rise of Amazon? Well, that's unlikely. Costco's model was proving to be incredibly resilient to online competition. So theory 2, did they need the cash for big opportunities that popped up during COVID? Come on, for a company as massive as Berkshire Hathaway, $1.3 billion is a drop in the bucket. It wouldn't even move the needle. So yeah, neither of those easy explanations really works.
And it definitely wasn't because the business was struggling. I mean, just look at these numbers from 2023, well after the sale. Revenue growth of 6%, profit growth of 9%. The company was firing on all cylinders. The business itself was clearly not the problem here.
Now, to get closer to a real answer, I think we have to look at this story through the eyes of Charlie Munger. For him, the connection to Costco wasn't just about business. It was almost philosophical.
Just think about how Munger described Costco. He didn't just talk about profit margins. He talked about an extreme ethical duty. For him, the genius of Costco was its absolute, relentless obsession with passing every little saving onto its customers. He believed that's what created that ferocious loyalty he talked about. He saw Costco as more than just a store. He saw it as a model for how capitalism should work.
So the exact, specific reason for the sale, it remains a mystery, probably locked away inside Berkshire headquarters. But instead of getting stuck on the why, we can pivot to something much more useful for all of us. What can we actually learn from this incredible story?
Well, 2 really powerful lessons just jump right out. First, you have to act decisively. Buffett's own regret teaches us that when you find one of those truly phenomenal companies that you really understand, you have to go big. You have to load up. And second, you have to invest, not just trade. Selling a wonderful business just because the price seems a little high can be a massive mistake. That's trading the stock, not owning the business for the long haul.
And that's really the takeaway, isn't it? It's so easy to sit on the sidelines and second-guess Warren Buffett, but it's way more productive to learn from him. This whole story forces us to confront that constant battle between a company's day-to-day stock price and its true long-term value, and it shows just how incredibly hard it is to hold on to a big winner, even for the best in the world. So I'll just leave you with this. If Warren Buffett himself can make a multi-billion-dollar mistake on a company he knew and loved for 20 years, what does that say about our own convictions? How do we find the strength and the discipline to hold on to our best ideas when even the masters can get shaken out? That right there, that's the real billion-dollar question. You know, we all make mistakes, but what if one of the greatest investors of all time admitted to a terrible mistake that cost his shareholders billions? Well, this isn't just some story about a bad deal. We're going to do a deep dive into hidden problems, a really grueling recovery, and the timeless lessons that Warren Buffett himself learned about what not to do. Yeah, we have to start right here with Buffett's own words. This isn't some analyst's hot take, no. This is the man himself calling one of his biggest ever acquisitions a terrible mistake. I mean, when the Oracle of Omaha is that blunt about an error, you really need to stop and listen because you know there's a powerful lesson buried in there somewhere. All right, so here's our game plan. First, we're going to look at why Buffett made this enormous bet in the first place. Then, we'll watch as it all starts to unravel. After that, we'll follow the long, tough road to recovery. And finally, we'll pull out the key lessons that you can actually apply to your own decisions.
Okay, so let's set the scene. The year is 1998. The dot-com bubble is inflating like crazy. There's this feeling of mania in the air, and Berkshire Hathaway, this bastion of old-school value, is about to make one of the biggest bets in its entire history.
So, the company in Buffett's sights was General Reinsurance, or Gen Re for short. Just think of them as an insurance company for other insurance companies. And look, this wasn't some minor player. We're talking about the largest of its kind in the US, with a global reach and this absolute blue-chip, gold-plated reputation. On paper, it looked like a perfect fit for the Berkshire family. The price tag? A staggering $15.9 billion. But to really get your head around the cost, just think about this. The Berkshire shares that were used to buy Gen Re, well, today they'd be worth over $175 billion. That is the monumental price Berkshire paid to get this deal done. And here is the real kicker. This wasn't a cash deal. Berkshire paid for Gen Re by basically printing new stock, which increased its total shares by a massive 21.8%. That meant that every single Berkshire shareholder, overnight, suddenly owned a smaller slice of the pie. It's called dilution, and it's a huge price for existing owners to pay. So you gotta ask, why pay such a steep price? Well, strategically, Buffett wanted to grow his insurance empire and really boost Berkshire's float. You know, that's the huge pile of cash that insurers collect in premiums that they then get to invest for their own profit before they have to pay out claims. But there might have been other pressures too. The absolute frenzy of the dot-com boom and maybe, just maybe, a feeling that Berkshire's own shares were a bit pricey, which made them pretty good currency to go out and buy something else. All right, so the deal was done, the ink was dry. But what looked like a masterpiece on paper was about to reveal some pretty serious cracks. You know, like the saying goes, you don't really know how deep the water is until you jump in. And Berkshire was about to find out they were in way over their heads. And this wasn't some overnight disaster. Nope, this was a slow, painful burn. The deal closes in '98. By 2001, the alarm bells are just blaring. Buffett himself calls the operations dangerously weak. But it wasn't until 2009, more than a decade later, that he finally stood up and admitted the whole thing was a mistake from the start. So what was actually hiding under the hood? Well, it was a hot mess. You had regulatory landmines just waiting to go off. Their core business of underwriting, you know, the actual skill of pricing risk correctly, was completely broken. They had this tangled, complex mess of derivatives that was basically a ticking time bomb. And to top it all off, the profits they've been reporting weren't even real. Let's just pause on that phrase for a second. Dangerously weak. This wasn't some off-the-cuff remark in an interview. This is Warren Buffett in his official annual report describing the core operations of a company that everyone thought was the gold standard. It was a massive signal that this wasn't just a numbers problem. The very foundation of the business was rotten. The problems were so bad that they forced Buffett to do something he almost never, ever does: replace the management. I mean, his whole philosophy is to buy great businesses that are already run by passionate, talented people. The fact that he had to step in and totally clean house was a clear sign of just how deep the rot really went. You can really boil all these failures down to two main categories. Financially, those bogus profits meant that Berkshire just flat out paid way too much. But the operational failure was arguably even worse. Their sloppy, foolish approach to risk left them dangerously exposed, a vulnerability that became tragically clear during the September 11th attacks, which just hammered the company with losses. But look, this isn't just a story about a mistake. It's also a story of a pretty remarkable comeback. So how did Berkshire take this billion-dollar lemon and somehow turn it into lemonade? Let's take a look at the turnaround playbook. I mean, the transformation was just absolute. The company went from dangerously weak to what Buffett now calls a fine insurance operation. It went from being a source of major, constant problems to a key contributor to Berkshire's success. The terrible mistake was over many, many years molded into an asset that Berkshire now prizes. So what was the playbook? Well, first, new leadership. Joe Brandon and Tad Monrose came in and took control. Their team spent years painstakingly untangling that complex web of derivatives. They went back to basics, forcing discipline in pricing and risk. And finally, they fully integrated Gen Re into the powerhouse of Berkshire's other insurance operations. And here's the ultimate payoff. After all the pain, all the hard work, that original goal was finally achieved. The fixed-up Gen Re became a powerful engine for growing Berkshire's insurance flow, which, by early 2024, had swelled to a jaw-dropping $169 billion. That's the cash that fuels the entire Berkshire investment machine. So what's the big takeaway for the rest of us? Well, this incredible story offers 4 timeless lessons for any investor, and believe me, they're just as critical today as they were back then. The first, and maybe the most powerful lesson, giving away a piece of your company is a permanent decision. You can pay back cash, you can pay back debt, but you can't easily get back stock once it's out there. That 21.8% of Berkshire was gone forever. The lesson? Your equity is precious. Treat it that way. Lesson 2 is all about fighting your own instincts. You know, even a guy like Buffett may have felt the pressure of the dot-com bubble, that fear of missing out while everyone else was getting rich. That desperation to just do something is an investor's absolute worst enemy. It makes you blind to red flags. Sometimes, the most profitable move you can make is to do nothing at all. Lesson 3 is a timeless reminder. Trust, but you have to verify. Genray had a stellar A-plus reputation. That was the tip of the iceberg, the part everyone could see. But lurking right below the surface were completely broken operations. A great reputation is a starting point for your investigation, not a substitute for deep, thorough homework. And the final lesson is maybe the trickiest of all. You're not just investing in a business, you're investing in people. Judging a management team's character and competence, well, that's not something you can find on a balance sheet. It takes careful observation, over time. And as this whole story proves, even the best judge of character in the world can sometimes be fooled. So, in the end, the General Re saga is just this incredibly powerful story. Yeah, it's a story of a massive public mistake made by an absolute icon. But more importantly, it's a masterclass in acknowledging that mistake, dedicating years of hard work to fixing it, and ultimately turning a colossal failure into a source of enduring, long-term value. This whole story leaves us with one critical question. It's often the obvious details, right? The unchecked assumptions. Those are the things that cause the biggest problems. So as you face your next big decision, whatever it is, just ask yourself, what am I taking for granted here? What's the one simple thing that really deserves a much closer look? Thanks for tuning in. All right, let's get right into it. How on earth can a move that makes you billions of dollars be considered one of your biggest mistakes? Well, today we're unpacking the incredible, almost paradoxical story of Warren Buffett's investment in PetroChina. It's a real masterclass in foresight, huge profits, and, well, what might have been. And, this quote from Charlie Munger, Buffett's right-hand man, just sets the stage perfectly. This is the core philosophy that drove the whole thing. It's simple, right? If something is an absolute, undeniable bargain, you can stomach a few extra risks. And for them, back in the early 2000s, PetroChina was exactly that, the bargain of a lifetime. And this is the big question we're tackling today. A $4 billion profit. I mean, for pretty much anyone else on Earth, that's the win of a lifetime. But for Warren Buffett, it's become this fascinating case study that gets at one of the hardest questions in investing. When do you actually sell? So, here's how we're going to break it all down. We'll start with the incredible bargain Buffett found, move to the moral and political test it created, talk about the massive payout, and then get to the shocking twist that changes everything. And of course, we'll wrap up with the lessons we can all take away. Okay, so let's rewind the clock. It's the early 2000s, and Warren Buffett is doing what he does best, hunting for value. And he finds it in a place a lot of other investors were kind of nervous about, China's massive, state-controlled energy industry. The star of our show is PetroChina. Now, this isn't just any oil company. It's the publicly traded piece of the China National Petroleum Corporation, a true behemoth in the global energy market. And that state-owned part, yeah, you're going to want to remember that. It becomes pretty important later on. Okay, now look at this. This is just mind-boggling. Back in 2002, the entire market, all of Wall Street, said PetroChina was worth about $37 billion. But Buffett and Munger, after doing their homework, which was literally just reading the company's annual report, came to a completely different conclusion. They figured it was worth at least $100 billion. That's not a rounding error, folks. That is a gigantic gap in perception. And you better believe they didn't just sit on that analysis. Berkshire Hathaway went in, and they went in big, dropping nearly $500 million to scoop up a piece of the company. For Buffett, this was his first major foray into China, and boy, was it a confident one. So, what was the secret sauce? What did they see that everyone else was missing? Well, it was classic value investing. First off, the price was just dirt cheap compared to its assets. Second, the company was sitting on a mountain of valuable oil and gas reserves. Third, they saw a fire hose of cash flow coming in the future. And the cherry on top? A plan to pay out 45% of its earnings as dividends. It was a no-brainer for them. But, just as the investment started proving them right, a huge wrench got thrown into the works. This wasn't a financial problem, it was an ethical one. Picture this. It's the 2007 Berkshire Hathaway annual meeting, the Woodstock for capitalists, and a formal resolution is brought to the floor. Activist shareholders are demanding that Berkshire sell every single share of PetroChina. Why? Because PetroChina's parent company was operated in Sudan during the horrific humanitarian crisis in Darfur. The activists wanted Buffett to use his influence to send a message. Buffett's response? It was pure unfiltered pragmatism. He basically said, look, us selling our small stake isn't going to punish anyone. It's not going to change Chinese foreign policy. All it's going to do is let someone else buy our shares at a good price. He argued that his primary duty was to his own shareholders, and that meant making decisions based on business value, not on making political statements. In the end, the resolution failed. But here's the kicker. Not long after that whole public debate, Buffett did sell. But it wasn't for the reasons the activists wanted. He sold because, in his mind, the job was done. The investment had played out exactly as he'd hoped. So just look at this timeline. The investment is made back in 2002, the public pressure comes to a head in 2006, and then bam! Just a year later, in 2007, he's out completely. The timing is just fascinating, coming so soon after he'd publicly defended holding onto the stock. Now, Buffett laid out his thinking, and it was all business, plain and simple. First and foremost, he said the company was no longer a bargain. Its price had finally caught up to what he thought it was actually worth. He also mentioned some practical issues, like the fact that he couldn't really buy much more of it, and he was getting a little worried about the future of U.S.-China relations and potential policy changes. And the result of that disciplined business-first decision? A cool $4 billion in profit on an investment of under $500 million. We're talking about a massive home run, the perfect end to a brilliant investment story, right? And folks, this is where a great story turns into a legendary one. This is where the so-called mistake comes into play. I mean, come on, you'd have to think so. A 700+% return? That's the kind of thing investors can only dream of. It's almost impossible to look at a $4 billion gain and see anything other than a massive, unqualified win. But this is the twist. Buffett sold because his math told him the company was fairly priced. The market, however, went absolutely bananas. Almost as soon as he was out, the stock didn't just climb, it went parabolic. We're talking a nearly vertical line on the chart, fueled by pure wild speculation. And this is the punchline. Shortly after Buffett cashed in his chips, PetroChina's value soared past $1 trillion. It became the very first company in history to hit that milestone. Suddenly, that huge $4 billion profit looked, well, kind of small compared to the tens of billions he'd left on the table. So what in the world can we learn from this? From a mistake that was still more profitable than most people's biggest successes? Turns out there are some really powerful takeaways. First, it just goes to show that selling is often way harder than buying. It's a psychological battle against greed and the fear of missing out. Second, it highlights why having a clear framework is so important. Buffett sold because the stock hit his target. He stuck to his process, which took the emotion out of it. And finally, it shows the unique problem that giants like Berkshire face. When you're that big, you need to find elephant-sized opportunities to make a real difference, and those are few and far between. And, it's really important to hear what Buffett himself had to say about it later. He said that if he found the same exact setup today, he'd make the purchase all over again, no question. That tells you everything. He never regretted buying PetroChina. The whole debate is purely about the timing of the sell. Which brings us right back to where we started. Can you call something a mistake when it makes you $4 billion richer? The story of PetroChina doesn't really give us a simple yes or no. Instead, it's just this incredible reminder that even for the absolute legends of investing, massive success and a little bit of regret can go hand in hand. What do you think? Let's dive into one of the biggest investment blunders ever made by arguably the greatest investor of all time. It's a wild story about a massive bet, a single, fatally flawed assumption, and a nearly billion-dollar lesson in what not to do. So let's just start with the number, the big one.
$873 million. That's the staggering pre-tax loss Warren Buffett's company, Berkshire Hathaway, had to swallow on a single investment. It's a pretty powerful reminder that, even the absolute titans of finance can get it spectacularly wrong. And hey, you don't have to take my word for it. This is straight from the man himself. In his 2013 letter to shareholders, Warren Buffett didn't try to hide it or spin it. He just owned it. And I love this quote because he jokes that next time he'll call his legendary partner Charlie Munger. It's just this incredible moment of honesty that really sets the stage for the whole story.
All right, so to really understand how this colossal loss even happened, we've got to rewind the clock. We need to look at the deal itself, which was, at the time, the single largest leveraged buyout in history. Let's set the scene for what I'm calling the Great Texas Gamble. I mean, just look at the scale of this thing. You had absolute giants of the private equity world. We're talking KKR, TPG, Goldman Sachs, all teaming up. And what were they buying? A Texas utility called TXU Corp. The year was 2007, and the price tag was a jaw-dropping $45 billion. This wasn't just a big deal. It was truly monumental.
Now, the whole deal was built using a specific financial tool, a leveraged buyout, or an LBO. It sounds complicated, but think of it this way. Imagine you want to buy a $45 billion house, but, you don't have the cash. So you go to the bank and get a massive mortgage. That's basically what an LBO is. The buyers borrowed a ton of money, using the company's own future profits to pay it all back. And that's the big risk right there. The company you just bought is now on the hook for paying for its own purchase.
And for a deal like this, there was a pretty standard playbook. Kind of like a 3-step recipe. Step 1, buy the company using all that debt we just talked about. Step 2, spend the next few years trying to make it run better and improve the finances. And then step 3, you exit, either by selling the company to someone else or by taking it public, hopefully for a huge profit. That was the game plan for the new company they formed called Energy Future Holdings. To really get why this even happened, you have to picture the mood back in 2007. It was the peak of a roaring bull market. It felt like an economic party that would never end. Money was cheap, banks were lending to just about anyone, and optimism was just off the charts. And in that kind of frenzy, investors take on way more risk, and they pay higher and higher prices for things. This deal was the poster child for that whole era.
Okay, so we've got the players, the price, the plan, the whole shebang. But the success of this entire $45 billion enterprise was basically teetering on one single critical assumption. This was the bet that was so convincing it even lured in Warren Buffett himself. So what was it? And this is where our story really takes a turn. Because Warren Buffett, acting on his own without consulting Charlie Munger, decides to jump in. Now, Berkshire didn't buy stock in the company. They bought its debt. They bought $2 billion worth of its bonds. So, in effect, Buffett became a major lender, betting that this new company would be a safe bet to pay back its loans. And right here, this chart, this is the whole bet in a nutshell. The entire deal was built on one simple idea, that natural gas prices, which were already really high in 2007, were going to stay high and probably climb even higher. And the logic seems sound, right? The company sold electricity, and higher natural gas prices usually meant higher electricity prices. That would create a river of cash to pay off that mountain of debt. Simple. So you can probably guess what's coming next, can't you? The bet failed. And oh man, it didn't just fail a little bit. It was completely shattered by a perfect storm of a global financial crisis and a new technology that almost nobody saw coming. I mean, just look at this timeline. It's like watching a car crash in slow motion. The deal closes in late 2007. Less than a year later, the whole global financial system melts down, crushing the demand for energy. By 2011, natural gas prices had been cut almost in half. The company tried to hang on, but the damage was just too severe. By 2014, it was over. Bankruptcy. So let's just put it side by side. The assumption was a one-way street. Gas prices were only going up. But the reality? A complete and total collapse. The market crash killed demand, and then at the exact same time, this new fracking technology, the whole shale gas revolution, unlocked huge new supplies. It was a brutal double whammy that just blew the core of the investment to pieces. And the result for the company was just a death spiral. As gas prices crashed, so did the company's income. But those massive debt payments? Oh, they didn't go anywhere. They just kept coming, month after month. You had falling income and rising debt. The business model became completely, utterly unviable.
You know, a story like this is painful, for sure, especially for the folks who lost money. But for us, the real value is in the lessons we can pull from the wreckage. This billion-dollar mistake offers some truly timeless wisdom that any of us can use. Okay, lesson number 1 is what I call the commodity trap. Energy prices, like prices for gold or corn, are set by incredibly complex global supply and demand. They are just fundamentally unpredictable. Believing a commodity price will only go in one direction isn't really investing for the long term. It's speculating. It's a short-term trade. And that's a much, much riskier game to play. And the second big lesson is about something we could call bull market blindness. That feeling of euphoria back in 2007 made this whole $45 billion deal feel perfectly reasonable. But that's the trap. When money is cheap and everyone is optimistic, that is precisely the time you need to be the most careful. It's when we're most likely to get swept up in the excitement and just plain overpay for things. So, how could they have avoided this whole disaster? Well, there's a powerful mental tool that could have changed everything. And it all starts with asking one simple but very different question. And the answer is right here. It's this fantastic idea from Charlie Munger. Invert, always invert. See, instead of spending all their brainpower trying to prove their idea right, asking how high can gas prices go, they should have inverted the problem. They should have asked what could possibly cause gas prices to fall. And if they'd done that, they might have thought about a financial crisis or maybe even new technology. It's a simple flip that instantly exposes the hidden risks. And we'll end on this simple but really profound German proverb: trees don't grow to the sky. It's just a beautiful metaphor for markets, for economies, for everything. Periods of crazy growth, of super high prices and unstoppable optimism, they never last forever. It's a crucial reminder that eventually everything faces the force of gravity. A lesson that, in this particular case, came with an $873 million price tag.
So how does the world's greatest investor end up losing billions of dollars? Well, today we're going to deconstruct one of the biggest self-admitted mistakes ever made by Warren Buffett. A huge bet on oil at the absolute worst possible time. We're going to see what timeless lessons this really expensive error can teach every single one of us.
You know, it all really boils down to this. These two words. This simple phrase is the key to understanding this entire story. It's a psychological trap that, as we'll see, even the sharpest minds can fall into. When it comes to investing, this feeling, this is the real enemy. All right, let's set the scene. To really get why this mistake happened, we need to jump in our time machine and go back to the mid-2000s. The feeling in the air back then, the investment climate, it made this bet feel not just possible, but, totally logical. So this whole thing doesn't kick off with some crazy, wild gamble. Nope. It starts with a pretty measured, careful investment. Berkshire Hathaway starts building a position in ConocoPhillips, a giant in the oil and gas world. On the surface, it all seems pretty standard.
By the end of 2006, everything was kind of calm. Berkshire held a respectable but not huge 1.1% stake in the company. And the oil market, it was steady, predictable even. Prices were just moving in a nice, normal range. Nothing at all suggested a storm was brewing.
But then things started to change. That quiet sense of optimism began to swell into this full-blown euphoria. It just felt like there was easy money everywhere, and all you had to do was jump in. And wow, did things take off. I mean, just look at this. Starting in early 2007, oil prices went on this absolutely incredible surge. They just kept climbing and climbing for over a year, hitting an all-time high of $147 a barrel in July of 2008. The market was in a total frenzy.
And this is the crazy part. This is where you see how even the most disciplined investor on the planet can get swept up in the moment. Buffett himself later admitted he got carried away. Instead of getting cautious, he did the opposite. He leaned in and decided to go even bigger on ConocoPhillips.
And we're not talking about just adding a little to his position. He went all in, buying shares aggressively and increasing Berkshire's stake more than 5 times over. His holding just ballooned from a tiny 1.1% to a really substantial 5.7% of the entire company. All that buying added up to a cool $7 billion. He was trying to capitalize on high oil prices, but in his excitement, he was actually locking the company into those prices at their absolute historical peak. The timing just couldn't have been worse. So the huge bet is made. Billions are on the table. And then, bam! The ground just shifts from under everyone's feet. The 2008 financial crisis hits, shaking the entire global economy, and the consequences? Well, they were about to become very, very clear.
It was just total panic. Global markets went into a nosedive. And look at what happened to the price of oil. That rocket ship that had soared to $147 a barrel, it fell right back down to earth, crashing all the way down to $40.
And the financial fallout was just immediate and brutal. I mean, look at these numbers. The $7 billion investment was suddenly worth just $4.4 billion by the end of the year. That's a paper loss of $2.6 billion in just a matter of months. Staggering.
So yeah, the financial damage was massive. But what really separates the legends from everyone else isn't just making good calls. It's how they handled the bad ones. And this is where the story takes this fascinating turn towards real accountability.
Think about it. He could have easily buried this, blamed the market, made excuses, but he didn't. Instead, right there in his famous annual letter to shareholders, he put it front and center for the entire world to see. Just read the words he uses here. There are zero excuses. He doesn't say, the market was crazy. He says, I made a major mistake. He admits the terrible timing cost his company billions. This is a masterclass in taking responsibility.
So this is the really important part. What can we all learn from this? Because this story isn't just about losing a bunch of money. It's about the invaluable wisdom that was gained from that experience. This mistake literally became a teaching moment for millions.
So what are the actual key lessons here? Let's break down the wisdom from this billion-dollar error and figure out how we can apply it to our own decisions.
It really boils down to 4 big ideas, and every single one is a direct result of this mistake. We're going to talk about the danger of euphoria, the trap of trying to time the market, the hidden cost of bad decisions, and a really powerful mental trick to help you stay grounded.
This quote right here just nails it. See, euphoria feels amazing, right? It makes you feel like a genius, like you can't lose. It's that feeling that triggers things like herd mentality, where you just follow the crowd. The problem is, it's a blindfold. It completely hides all the risk. A healthy dose of pessimism, on the other hand, that's your friend. It's that little voice that forces you to ask the hard questions.
And you've got to understand, the damage wasn't just the $2.6 billion they lost on paper. The opportunity cost was maybe even bigger. See, that $7 billion was now trapped in ConocoPhillips. It couldn't be used to scoop up the incredible bargains that were suddenly everywhere when the rest of the market crashed.
And this brings us to a super useful mental tool to fight that euphoria. It's called inversion. Basically, instead of only thinking about all the ways something could go right, you flip it. You force yourself to ask, okay, how could this completely blow up in my face? If Buffett had done that, he might have asked, what if oil prices collapse right after I invest? It's a simple question that changes everything. So here's what you should really take away. Number 1, nobody, not even the best in the world, is immune to emotion. 2, the true cost of a bad choice includes all the opportunities you miss out on. 3, owning your failures builds trust and is a sign of true leadership. And finally, being just a little bit of a pessimist can save you a fortune.
So we'll leave you with this question to think about. In your own decisions, big or small, what's the more expensive mistake? Acting out of fear or acting out of euphoria? You know, fear can make you miss out on an opportunity, but euphoria can lead to a complete disaster. It's a crucial question, not just for investing, but for life.
You know, when you think of investing success, you probably think of Warren Buffett. His name is synonymous with discipline, patience, and just making these brilliant, brilliant decisions. But here's the thing, even the masters get it wrong sometimes. And today, we're going to break down one of his biggest public mistakes, an investment failure so huge, it's basically a masterclass in what not to do. Let's just rip the Band-Aid off and get right to the bottom line. Look at that number, a $444 million after-tax loss for Berkshire Hathaway. Whoa. I mean, this wasn't some small miscalculation. This was a massive error that Buffett himself had to confess to his shareholders. A loss this big just makes you ask one really simple question. How on earth did this happen? How did an investment that on the surface looked so solid just completely crumble? That's the real mystery we're going to unpack here. And to find the answer, we've got to go all the way back to the beginning, when the story looked a whole lot different. Okay, so to really understand the mistake, we have to rewind the clock. You see, every big investment starts with what's called a bull thesis. Basically, it's the whole set of reasons why you think it's going to be a winner.
And for Buffett, the case for this British supermarket giant, Tesco, it looked incredibly strong at the time. So first, let's just set the stage. Who are we talking about? Tesco wasn't just some corner grocery store. No, this was a dominant food retailer in the UK, with a huge and growing global footprint. Think of it like a powerhouse in the European grocery world, and it had these really big ambitions to expand all over the place.
And this wasn't just a one-time bet for Buffett. His conviction in the company actually grew over time. He started off in 2006 with a big $1.3 billion investment, but he kept on buying more shares. Even after a really key leadership change in 2010, he kept going. By 2012, he had poured a grand total of $2.3 billion into Tesco. He wasn't just testing the waters here, he was all in.
And his confidence was really built on these 4 solid pillars. First, Tesco had these ambitious plans for global expansion, including a huge move into the US market. It had what looked like really impressive growth prospects. And, crucially, Buffett deeply admired its CEO, a guy named Terry Loughy. He saw him as a world-class manager in a really tough industry. So on paper, this just ticked all the boxes for a classic Buffett bet. But, as we already know, that is not how this story ends. That perfect-looking investment thesis, well, the foundation started to crack. It happened slowly at first, and then it happened all at once. Let's dig into how this promising bet started to completely unravel. The very first domino to fall was a big one. In 2010, Terry Loughy, that star CEO that Buffett admired so much, he retired. Now remember, Leahy's leadership was a central pillar of the whole investment idea. When you pull that pillar out, the entire structure starts to get pretty wobbly. And right after that leadership change, the numbers started telling a really troubling story. Profitability just took a nosedive. In 2013, their pre-tax profit fell by almost 15%, and it dropped again the next year. The financial engine of this business was clearly sputtering. Then came the bombshell. An internal investigation revealed a massive accounting scandal. Tesco had overstated its accounts by £246 million. Basically, it had been improperly pulling forward income from its suppliers to make its performance look way better than it actually was. This wasn't just a bad business decision. This was straight-up malpractice. It was truly a cascade of crises, just one thing after another. Their revenue and their profit margins were shrinking. The accounting scandal completely destroyed trust in the company. Oh, and that ambitious U.S. expansion, it ended in a Chapter 11 bankruptcy. With every single piece of bad news, the stock price just kept tumbling, erasing value day after day after day. So with everything just falling apart, the company in a free fall, and the original reasons for investing completely shattered, the big question is, what did the world's most disciplined investor do? His reaction is maybe the most important part of this entire story. Right. This is the crucial question, because when the facts change, a great investor is supposed to change their mind and act decisively. But what happened here is such a powerful lesson in how even the absolute best can fall into these psychological traps. Instead of a quick, decisive exit, Buffett hesitated. In early 2013, he saw the initial problems and sold a small part of his shares, actually making a small profit. But then, as more and more bad news piled up, he just paused. He waited. And that delay proved to be fatal for the investment, as the stock's value completely collapsed, turning what could have been a manageable situation into an absolute disaster. And in his 2014 annual letter, Buffett owned the mistake completely. He didn't make excuses. He admitted his leisurely pace was expensive, and he shared this term from his partner Charlie Munger, thumb-sucking. It's the perfect description for just sitting there, inactive, paralyzed, when you know you should be taking action. This entire saga, from the promising beginning to the disastrous end, it gives us this powerful set of lessons that really go way beyond just investing. So let's try to distill the key takeaways that any of us can apply in our own lives. I mean, just look at the contrast here between the original thesis and the brutal reality. It is so stark. On one side, you have the dream. This admired CEO, global growth, strong management, growing profits. And then, on the other side, the nightmare. New management, a U.S. bankruptcy, an accounting scandal, and shrinking margins. The thesis wasn't just wrong. It was completely turned on its head.
From this nearly $500 million mistake, we get 4 timeless lessons. Okay, lesson 1, and this is a big one. When your core reasons for making a decision are proven to be false, you have to act immediately. 2, a change in key leadership is a massive red flag that demands a complete reevaluation of everything. 3, making that decision to get out, to sell, is an emotional battle, and it requires immense discipline. And 4, it's a good reminder that some industries, like retail, are just brutally tough and competitive.
And this brings us to the final critical question that this story forces us to ask ourselves. Buffett's experience here, it's like a mirror for our own decisions. When you are faced with undeniable evidence that you were wrong about something important, what's your instinct? Do you act with discipline and cut your losses? Or do you hesitate, rationalize, and fall into that trap of thumb-sucking? It's a question worth asking because, as we've just seen, the answer can be very, very expensive.
You know, even the greatest investors on the planet get it wrong sometimes. Warren Buffett once called an investment a costly romantic affair. And no, it wasn't some small misstep. We're talking about $1 billion bet on a private jet company that almost brought his legendary company, Berkshire Hathaway, to its knees. It just goes to show you nobody's perfect. And today, we're diving deep into one of his biggest ever mistakes.
So, how on earth did this happen? How did a company that Buffett himself used and absolutely loved become this giant headache? A business that was just hemorrhaging cash, even though sales were booming and it had this 5-star reputation. That's the big question, and that's exactly what we're going to unravel right now. So, here's how we're going to break this story down. It's like a 5-act play. We'll start with that big, optimistic $1 billion bet. Then we'll fly straight into some serious turbulence. After that, we'll get to the stunning moment when Buffett himself admits he was wrong. We'll see how the company was saved from the brink, and then we'll wrap it all up with the critical lessons you can take away from this whole crazy ride. All right, let's get right into it. Act 1, the $1 billion bet. We're going to rewind the clock to 1998 to really understand why Berkshire Hathaway thought they'd found this golden opportunity flying high in the skies. Okay, first things first, what did NetJets even do? Well, they pretty much invented this brilliant concept called fractional jet ownership. The best way to think about it is like a super high-end timeshare, but for a private jet. Instead of forking over millions for your own plane, you could just buy a piece of one, say a 1/16th share. That got you access to a whole fleet of jets without any of the headaches of owning one. They made money on the sale, on monthly fees, and on every hour you flew. On the surface, it was an absolutely genius idea. And you can tell how much Buffett believed in it by the sheer size of the deal. In 1998, Berkshire shelled out a whopping $725 million for NetJets. Half in cash, half in Berkshire stock. I mean, that's a huge number, especially back then. And NetJets was already the biggest player in the US. This wasn't some small side project. This was a major acquisition that was supposed to be a money-making machine for Berkshire for years to come. So why was Buffett so sure about this? Well, when you look at it on paper, his reasoning was rock solid. He saw a company that was just best in class. The service was incredible, they were everywhere in the country, and their safety record was spotless. Because they were so big, they had this huge operational advantage. You know, a customer in the middle of nowhere could get a jet on a few hours' notice, something a smaller competitor just couldn't pull off. Plus, it fit perfectly with another company Berkshire owned, Flight Safety, which was already training their pilots. It all just seemed to fit. And here's the real kicker. This wasn't some deal they found by crunching numbers on a spreadsheet. Buffett and his right-hand man, Charlie Munger, were already loyal customers. They had used the service themselves, they loved it, and they believed in it. You know the old saying, invest in what you know? Well, this seemed like the perfect example. With everything lining up like this, it felt like there was no way it could fail. But as you've probably guessed, that's not where the story ends. For all that optimism at the start, the flight path was about to get seriously bumpy. We're now heading into some major turbulence, a time when the company's amazing growth started to look a lot more like a curse than a blessing. This is where things start to get really weird. A perfect storm started brewing. First, you had the 9/11 attacks and a bad economy, which hit the whole travel industry. But then something strange happened. By 2002, revenues were actually hitting record highs. But here's the paradox. The company was suddenly losing money. And it just got worse. A year later, that loss had exploded to $43 million, even while more and more customers were signing up. So here's the core problem that was sinking the company.
On one hand, you've got this incredible demand. Customers were flocking in, nearing 5,000 people. But on the other hand, the cost to actually serve all those customers was skyrocketing even faster. To keep everyone happy, NetJets had to buy brand new, very expensive planes, and when their own planes were all booked, they had to pay a fortune to charter jets from other companies. All that spending completely wiped out any profit they might have made.
And this is where it all comes to a head. All those simmering problems with costs are about to boil over into a full-blown crisis. And it led to one of the most shocking and public admissions of failure you will ever hear from a major CEO. By 2005, things had gone from bad to worse. The company reported a pre-tax loss of a staggering $80 million. I mean, just think about that. This isn't a small rounding error, it's a massive gaping wound in the financials. The dream was over. This growth had created a giant financial hole that nobody could ignore anymore. That huge loss is what led to this incredible quote. In Berkshire's annual report for everyone to see, Warren Buffett wrote, "I was dead wrong." Just pause on that for a second. How often do you see a CEO, let alone a living legend, just come out and say that in black and white? It's almost unheard of. And it sent a clear signal to the world that the problems at NetJets were incredibly serious. A little later, Buffett finally put his finger on the single biggest mistake. It was the whole business model. It was broken. They were buying these brand new multi-million-dollar jets at top dollar, right? But they were selling the shares to customers at a price that just didn't cover the true cost over the long run. It's like selling dollar bills for 90 cents. The more you sell, the more you lose. Eventually, this led to a massive $54 million write-down, and the company's founder and CEO had to resign. And if you want to see what that crisis really looked like, just look at this chart. It's just staggering. When Berkshire bought the company, the debt was a manageable $102 million. By 2009, it had exploded to $1.4 billion, with a B. And why? Well, to keep up with all that demand, they had to keep buying more and more planes, digging themselves into a deeper and deeper hole of debt with every single order. So the company is in a total nosedive. Losses are piling up, debt is out of control, and bankruptcy is looking like a real possibility. What happens next? Well, this is where having a parent company with really, really deep pockets comes in handy. And once again, there was no sugarcoating from Buffett. He wrote in his 2009 letter that if Berkshire hadn't stepped in to guarantee that massive $1.4 billion debt, NetJets would have gone out of business. Period. End of story. And he took full responsibility, telling his shareholders that he had failed them by letting things get so bad. It was a straight-up bailout. But then you've got his partner, Charlie Munger, who a year later had a totally different take on it. He was his usual pragmatic self. He basically said, hey, look, we buy businesses. Sometimes they stumble. As long as the brand itself is still good, losing some money for a while isn't the end of the world. It's just a classic long-term perspective. He wasn't panicking, he was looking at the big picture. So after going through all that chaos, what's the big takeaway? What are the key lessons that we, whether we're investors or business owners or just curious, can learn from this whole saga? This right here is the most important part. You can really boil this whole story down to 4 critical rules. First, be really careful with businesses that need tons and tons of cash just to grow, like an airline that's always got to buy new planes. Second, don't get fooled by big revenue numbers. Focus on what's called owner earnings, the actual cash that's left in the pocket after all the bills are paid. Third, a cool subscription model doesn't mean anything if the basic math is wrong. If your costs are higher than your price, you're going to fail. And finally, management is everything. You need people in charge who think like owners, not just managers who are obsessed with growth at any cost. So I'll leave you with this final thought. The NetJets affair cost Berkshire Hathaway a ton of money, hundreds of millions in losses, billions in debt. But the lessons that Buffett shared so openly about bad business models, about capital, and about having the guts to just admit when you are dead wrong, well, maybe for the rest of us, those hard-won lessons are absolutely priceless.
All right, today we're going to dig into a really fascinating story. It's a case study of a Titan's misstep. We're talking about the world's most celebrated investor, Warren Buffett, and a massive multi-billion-dollar bet on a tech giant, a bet that went against pretty much everything he was known for. We're talking about IBM.
And that really is the central question, isn't it?
I mean, this is Warren Buffett we're talking about, a legend known for his discipline, his patience, and his near-flawless track record. So how did he get this one so spectacularly wrong? Well, to answer that, we've got to unpack this story right from the very beginning.
So, here's our roadmap for today. First, we'll look at the shocking initial investment, this titan betting big on tech. Then, we'll see how that conviction led him to pour in even more capital. After that, we get to the turning point, when that famous moat starts to dry up. Then comes the moment the Oracle himself admits his error. And finally, we'll pull out all the invaluable lessons we can learn from this losing bet.
Okay, let's set the stage. The year is 2011. Warren Buffett, the guy who famously, for decades, said he avoided technology stocks because, he just couldn't understand them, he makes a move that sends absolute shockwaves through the entire investment world.
And look, this wasn't him just dipping his toe in the water. No. The initial investment was a staggering $10.9 billion. This was a full-throated, high-conviction, massive bet right from day one.
Just to put this into perspective for you, this single purchase instantly catapulted IBM into Berkshire Hathaway's absolute top tier of investments. It was suddenly sitting right alongside legendary names like American Express and Coca-Cola. For a self-proclaimed tech skeptic who'd studied IBM for over 50 years without ever buying a single share, this was a monumental shift. So you have to ask, what was he thinking? What was his logic? Well, it definitely wasn't a blind gamble. Buffett's whole thesis really rested on these four key pillars. He loved that IBM was aggressively buying back its own shares, which would automatically increase Berkshire's slice of the pie over time. He had a ton of confidence in the management, and crucially, he believed IBM's huge corporate customers were sticky, meaning the cost and the headache of switching to a competitor were just so high. They were basically locked in for good.
And right here, in Buffett's own words from 2012, we get this fascinating admission. He knew this was different. He's openly saying that IBM's competitive advantage, its moat, wasn't as clear-cut or as easy for him to understand as a global brand like Coke. Still, he felt good enough about it, good enough to make one of the biggest bets of his entire career.
So now we're moving into the second phase of this story. Because instead of maybe waiting to see if his thesis was playing out, Buffett's conviction just got stronger. And that led him to double down on his bet, even as some early warning signs started to pop up.
This timeline really tells the whole story, doesn't it? You see the big bet in 2011. Then, in 2013, he's out there publicly expressing his confidence. But then, look at 2014. The stock starts to slide. Now, for most of us, that's a red flag, right? But for Buffett, he saw it as a buying opportunity. He poured in even more money, boosting Berkshire's stake to over 8% by 2015. His total investment ballooned to $13.8 billion. At this point, his conviction was just absolute. He was convinced the market was just plain wrong, and he was getting a fantastic bargain on a great American company.
And this quote from 2013 just perfectly captures that peak confidence. There is zero hesitation here. He was all in. You could say this was the high water mark of the whole story, right before the tide began to turn in a very dramatic way.
And that brings us to the real turning point. The very foundations of Buffett's investment case, they just started to crumble. And not because of some market crash, but because the business itself was being fundamentally disrupted from the inside out. That famous moat, well, it was drying up. Okay, this slide right here, it just lays out the whole disconnect between perception and reality perfectly. On the left, you see the strong, impenetrable castle that Buffett thought he was buying. But on the right, you see what was really happening. Competitors like Amazon were building a bridge right over that moat with cheaper, faster, better cloud solutions. And those share buybacks, they started to look less like a smart return of value and more like, financial engineering, just using cash to prop up the stock price on paper while the actual business was getting weaker.
So what was really going on under the hood at IBM? Well, simply put, they were being outmaneuvered. They were losing the critical battle for the cloud. Their old-school legacy service contracts were drying up, and all these nimble, hungry competitors were just eating their lunch, stealing market share. And the numbers don't lie. Berkshire's holding was down 19%. The fundamental facts of the business had changed, and they changed for good.
Now, this might be the most important part of the entire story because it's not just about making a mistake. We all do that. It's about what you do next. And true to his character, Warren Buffett publicly reevaluated his own thinking, right out there in the open for everyone to see.
Wow, what a difference 4 years can make. Just compare this to that super confident statement from 2013. This is the Oracle of Omaha being incredibly direct, incredibly humble.
he's just admitting it. The investment, it has not turned out that well. He doesn't make excuses, he just states the facts.
And that same year, his longtime business partner, the famously blunt Charlie Munger, added this critical piece of insight. He brought it right back to their bedrock philosophy. Don't play in a game where you don't have an advantage. It was this stark reminder of the very discipline that had made them legends in the first place.
And that public reevaluation, it led to decisive action. Recognizing the mistake and recognizing that the competitive landscape had been permanently altered, Buffett didn't hang on hoping for a miracle. By the end of 2018, Berkshire had sold every single share of IBM, closing the book on this multi-billion-dollar chapter.
So why does this story matter so much? Why are we talking about it today? Because this very public, very high-profile mistake offers some of the most powerful investment lessons you could ever hope to find, coming straight from the best in the business.
You know, at the very heart of this entire story is a concept that is absolutely central to Buffett's whole philosophy, the circle of competence. It's this simple but profound idea that you have to have the discipline to only invest in what you truly deeply understand. With IBM, Buffett himself admitted he's straight outside that circle, and it cost him billions. This is, without a doubt, the single most important takeaway.
But beyond that core idea, this story teaches us a few other vital lessons. First, a real competitive edge, a deep, wide moat, is everything. Second, financial tactics like buybacks are useless. They can't save a business if its core performance is weak. Third, the relentless pace of technology can wash away even the most impressive-looking castles. And finally, maybe the ultimate lesson. You have to have the intellectual courage to admit you were wrong and change your mind when the facts change.
So, we'll leave you with this question to think about. Buffett's story is a masterclass, not just in investing, but in intellectual honesty. And it really forces all of us to ask ourselves, what do I really understand? And maybe more importantly, do I have the discipline to stay within those boundaries? In a world that's changing faster than ever, that just might be the most valuable question of all.
Welcome to The Explainer. You know, even the best of the best make mistakes. And today, we're digging into a really fascinating one from the world of legendary investor Warren Buffett. It's a story that's got everything: a billion-dollar deal, a shocking betrayal, and a very, very public admission that something went wrong.
Yeah, that's right. Buffett himself called it a big mistake. And we're going to start right there with that incredibly powerful admission. I mean, it just sets the stage perfectly, doesn't it? This is a story about high-stakes business, but it's also about human error and what we can all learn when things go completely off the rails.
But here's the thing, and this is really the key to the whole story. Was it just one mistake, or was it actually two? Because, you know, the Lubrizol acquisition, it's way more complicated than it looks on the surface. We're not talking about a single slip-up here. We're talking about two totally different kinds of failures, one right after the other.
Okay, so here's how we're going to break this down. First, we'll look at why Lubrizol seemed like such a perfect Berkshire-type company. Then, we'll get into the betrayal. After that, we'll uncover a second costly mistake. We'll hear what Buffett and Munger had to say about all this, and then, of course, we'll wrap up with the big lessons from the whole affair.
All right, let's jump in. Section 1, the Berkshire-type company. So, what was it about this company, Lubrizol, that caught Warren Buffett's eye? I mean, on the surface, this thing looked like a classic textbook Buffett investment.
So Lubrizol, they were pretty much exactly the kind of business Buffett loves to buy. You know, a solid, essential company that makes stuff the world can't really do without. They create these specialty chemicals and additives. Think of it as the secret sauce that goes into everything from your car's engine oil to everyday consumer products. They were global, they were essential, a perfect fit, right?
And look, they didn't just dip their toes in the water. Berkshire Hathaway went all in. We're talking about a massive commitment, an $8.7 billion acquisition back in March of 2011. This wasn't some small speculative play. This was a huge vote of confidence in the company.
Okay, so the deal itself looks good on paper. But how it got to Buffett's desk, that's where this story takes a really dramatic turn. This is where the first mistake comes into view.
You see, the guy who brought this deal to the table wasn't just some analyst. No way. This was a top-tier senior executive at Berkshire. He'd been with the company since 1999. Buffett called him a big asset, and the guy looked up to Buffett as a friend and a mentor. Honestly, everybody, and I mean everybody, thought this was the man who was going to take over the entire Berkshire empire one day.
So what happened? Well, here's the timeline, and it's pretty damning.
In early 2011, this executive goes and privately buys shares in Lubrizol. Then, shortly after that, he walks into Buffett's office and says, hey, you should take a look at this company. The deal gets announced, Lubrizol's stock, of course, goes through the roof, and then he sells his shares for a huge profit. It's just a classic textbook case of insider trading.
And this is what's just so mind-boggling about the whole thing. I mean, look at what was at stake. This guy had made $24 million in compensation the year before. $24 million! And he risked all of that, plus the trust of Warren Buffett, plus the keys to the entire Berkshire kingdom. For what? A $3 million legal profit? It makes no sense. The math is completely irrational. So of course, when all this came to light, the fallout was fast, and it was final. He resigned in disgrace. His reputation was just destroyed. And his career at Berkshire Hathaway? Over. Just like that.
Okay, so that's mistake number one. A huge ethical breach, a total disaster. And you might think, all right, that's the end of the drama. But nope, not even close. There was a completely separate and very, very costly problem bubbling up inside Lubrizol itself.
And to really get this second mistake, you have to remember what kind of business this is. I mean, specialty chemicals, it's a tough industry. It's super competitive. You're dealing with all kinds of complicated stuff, and you're wrapped up in strict environmental laws. It is exactly the kind of business where, anything can, and often does, go wrong.
And, well, something did go wrong. A few years later, in 2014, with Berkshire now in charge, Lubrizol decided to expand. They went out and bought an oilfield chemicals business, and they paid a pretty penny for it, $750 million.
Yeah, that expansion, it was a complete disaster, an absolute failure. They ended up having to shut the whole thing down, and it resulted in a pre-tax loss of, get this, $365 million. That's almost half of their initial investment just poof, gone.
So, let's recap. We've got two huge problems here. A massive betrayal that hurt their reputation, and a massive business failure that cost them hundreds of millions. So, what did the guys at the top, Buffett and Munger, have to say about all this?
Well, when it came to the insider trading, Buffett didn't try to sweep it under the rug. He came right out and admitted he'd made a mistake too. He said, I obviously made a big mistake by not asking a simple question. Hey, when did you buy the stock? He basically confessed that he trusted his guy too much and just didn't do that one last check.
And then, fast forward a few years. After that disastrous oil field business blew up and cost them $365 million, you know what Buffett said? He used the exact same phrase. He again publicly called the Lubrizol purchase a big mistake. This time, he was talking about the purely business side of the failure. And of course, Buffett's partner, the legendary Charlie Munger, he chimed in with his usual dose of wisdom. He basically said, look, it's a mistake to assume that rationality is going to be perfect, even in very able people. Which is just such a perfect Mungerism, right? It perfectly explains how that super smart executive could do something so incredibly dumb.
Okay, so we've walked through this whole mess. The betrayal, the business failure, the confessions. So what's the bottom line? What are the big lessons we can pull from all this? What does it mean for us?
I think the core lesson is this. You have to investigate both the business and the people running it. They're two sides of the same coin. Really digging into the risks of the chemical industry, that might have given them a heads up about the potential for that huge financial loss. But digging into the character of the people involved, that's what protects you from the kind of betrayal that kicked this whole thing off.
So you can almost boil it down to a simple three-step shield to protect yourself. Step 1, investigate the business itself. What are its real risks? In this case, it was the chemical industry's volatility. Step 2, scrutinize the management. This is the part Buffett owned up to, right? Not asking that one extra question. And step 3, assess their track record. How have they treated shareholders in the past? If you use this framework, you have a much better shot at avoiding both of the problems we saw here.
And that really leaves us with this final big question to think about. This whole Lubrizol mess, it just proves that even for Warren Buffett, maybe the greatest investor ever, finding that balance between trust and verification, it's one of the toughest things in business. You have to trust people to get anything done. But as we saw here, when you put that trust in the wrong place, the price can be incredibly high.
So what happens when you get two of the absolute smartest investors on the planet? I'm talking Warren Buffett and the master operators over at 3G Capital to team up and build a food empire. You'd expect a massive, massive success, right? Well, the Kraft Heinz deal, it became something else entirely. It's a multi-billion-dollar cautionary tale about just how much the modern economy is changing. So let's break down exactly what went wrong.
All right, here's our game plan. We're going to start with the deal of titans, then see how that led to the massive $49 billion merger. From there, we'll dig into the real heart of the issue, the brand power problem. Then we'll get to the juicy part, an investor's confession. And finally, we'll wrap it all up with what we can learn from this whole saga.
Okay, so our story actually kicks off back in 2013. And it doesn't even start with Kraft. Nope. It begins with another household name and a partnership between two absolute giants of the investment world, Warren Buffett's Berkshire Hathaway and those legendary efficiency experts at 3G Capital. The first big move came that year. Berkshire Hathaway dropped over $12 billion into a venture to take the iconic H.J. Heinz company private. But you have to understand, for Buffett, this was way more than just buying a ketchup company. He saw this deal as the perfect blueprint, a template for a whole new wave of megadeals. And the partnership itself? Oh, it was like a perfect marriage of skills, a straight 50-50 split. Berkshire brought the massive patient capital, the big money, and 3G Capital brought its famously aggressive approach to streamlining operations. It was basically a combination of financial muscle and operational know-how, and it was designed to take control and make that company run lean. So that first Heinz deal, it was a huge success, a total home run. So naturally, just 2 years later, the partners decided to go even bigger. They were ready to swing for the fences and create a true global food powerhouse. And that's exactly what they did in 2015. They merged Heinz with another American giant, Kraft Foods Group. The deal created the Kraft Heinz Company, and this new entity was valued at a jaw-dropping $49 billion. I mean, this was a monster of a deal, built to completely dominate grocery store aisles everywhere. After all the dust settled, Berkshire Hathaway ended up with over a quarter of the entire new company. This really solidified their position, right alongside 3G, as part of the controlling group. They had enormous influence over this new food giant. But, almost immediately, things started to look off. The cracks began to show. Despite its massive size and the supposed expertise of its owners, the company's revenue just went flat. It wouldn't grow. They were constantly trying to fix it, restructuring, selling off brands like Planters Nuts, buying smaller companies, but nothing seemed to work. It was like the engine had completely stalled. So what was really going on here? The problem wasn't about cost-cutting or small operational tweaks. No, the issue was something way, way deeper. It was a fundamental shift in the marketplace that this new behemoth was just not ready for. The real issue, the Achilles heel of this entire mega deal, was something called limited brand power. Basically, all those famous, iconic brands that Kraft Heinz owned were losing their clout. They just couldn't walk into a room with huge retailers anymore and dictate the terms like they used to. And this created a classic showdown, but with a modern twist. On one side, you've got the century-old brands from Kraft Heinz. But on the other side, you have the incredibly powerful private label brands that are owned by the retailers themselves. Think about Costco's Kirkland brand. And if you really want to understand the scale of this problem, just look at this number. Costco's one private brand, Kirkland, generates sales equal to more than half of the entire global revenue of Kraft Heinz. Think about that. All of Kraft Heinz's dozens of brands combined, and one store brand is doing more than half their business. That's not just competition, that's a seismic shift in who holds the power. And here's a perfect real-world example of what true brand power looks like. A while back, Costco actually tried to stop selling Coca-Cola. Well, the backlash from customers was so huge they had to bring it back. That is leverage. Kraft Heinz, on the other hand, was learning the hard way that it just didn't have that same kind of pull with shoppers. And because of that, it didn't have it with the retailers either. So with the company in trouble, everyone's eyes turned to the guys who put the whole deal together. The world wanted to hear from the masters themselves. What did Warren Buffett and his right-hand man, Charlie Munger, have to say about their blockbuster deal that had gone so wrong? By 2019, the writing was on the wall. The investment was a massive disappointment. The market knew it, the world knew it, and at the big Berkshire Hathaway annual meeting, Warren Buffett finally stood up and addressed the elephant in the room. And he was incredibly blunt about it. He admitted that the company's leadership, and that includes him,
had completely misjudged their position in the market. They went into negotiations thinking their famous brands made them strong, but they found out their bargaining power was way, way weaker than they ever imagined. And then he delivered the line that summed up the entire problem. Just a few simple words. But we paid too much. He basically said, look, the business itself is still a good business, but the price we paid for it was so high, it turned the whole thing into a bad investment right from the start. His partner, Charlie Munger, had a slightly different, more philosophical take. He basically said, hey, look, the first deal, Heinz, was a grand slam. The second one, Kraft, was a strikeout. His lesson was one of humility. Even for the best investors in the world, you're not going to win every single time. Sometimes you just get it wrong. As she put it, that happens. So, after all that, what are the big takeaways? I mean, this story is so much more than just a case study about one company. It's packed with some really timeless lessons about investing, business, and how the world works. Well, the source material really boils it down to 4 crucial lessons. First, you have to beware of private labels. They have totally changed the game. Second, you have to respect true brand power, the kind that lets a company call the shots. Third, even the biggest brands aren't immortal. Their power can fade over time. And finally, maybe the most important rule in all of investing, don't overpay. If there's only one thing you remember from this whole story, let it be this. You can buy the best, most amazing company in the world, but if you pay too much for it, you can still lose a ton of money. As Buffett's mistake proves, the price you pay is often the single most important factor that determines your success. And that leaves us with a really provocative question to chew on. The Kraft-Heinz saga isn't just about something that happened in the past. It forces us to look around at all the brands on the shelves today and ask ourselves a really critical question. Which of these famous brands still have that true Coca-Cola level power, and which ones might be a lot closer to the edge than any of us think?
When you hear the name Warren Buffett, you pretty much think investing genius, right? But even the absolute best in the world can make mistakes. And today, we're going to dive deep into one of his biggest, a multi-billion-dollar bet on a company called Precision Cast Parts Corp.
So that's the big question we're tackling. How does an investor who is literally famous for his discipline and his incredible foresight end up having to admit to a $10 billion error? You know, to really get a handle on the mistake, we first have to understand what made this company look so unbelievably attractive to begin with.
All right, let's back up a bit, because before this whole thing went south, it looked pretty much perfect on paper. So we're going to start by looking at what Precision Cast Parts, or PCC, actually did, and why it seemed like a textbook, can't-miss investment for Buffett's company, Berkshire Hathaway.
Okay, so what did PCC actually do? Well, at its core, this company was making these incredibly complex, highly engineered parts that are just super difficult to produce. We are not talking about simple nuts and bolts here. Think massive, intricate components for jet engines, for industrial gas turbines, for power plants. These are absolutely mission-critical parts where failure is just not an option. This wasn't some simple business. It was a high-tech, industrial powerhouse.
And when you look at this checklist, you can totally see why Buffett was so drawn to it. I mean, PCC was a dominant player, often the #1 or #2 supplier in all its little niche markets. It had loyal customers, we're talking giants like Boeing and Airbus, locked into these long-term contracts. And its technical skills in metallurgy and engineering, that created a huge barrier for anyone else trying to compete. This thing had all the classic signs of what Buffett loves to call a durable competitive advantage, basically a financial fortress he'd want to own forever.
So, completely convinced of PCC's quality, Berkshire Hathaway didn't just invest a little. Oh no, they went all in, making one of the largest acquisitions in their entire history. This was a massive vote of confidence, backed by a truly staggering amount of money. And it happened at a time when the aerospace industry was absolutely booming and looked like it was going to grow forever.
$32.7 billion. Just let that number sink in for a second. Back in 2016, this was a monumental deal. It was a clear signal that Buffett thought PC's future wasn't just bright, it was blinding. But believe it or not, that huge price tag, that's only part of the story.
And this is where things get really interesting. Out of that total price, $16 billion, that's nearly half, was for something called goodwill. Now, in simple terms, that's the extra amount you pay on top of the value of a company's physical stuff, its factories and equipment. It's the price you're paying for the brand name, the customer relationships, all that future potential. To pay that much for goodwill,
That shows an almost breathtaking level of optimism.
And to top it all off, the entire deal was done in cash. No stock swaps, no fancy, complex financing. Just a massive wire transfer from Berkshire's bank account. This was Berkshire pushing all its chips to the center of the table. It was a definitive statement of their absolute belief in PCC's long-term value.
But as we all know, even the most confident bets can run into problems you just didn't see coming. And this is where our story takes a sharp and, honestly, a pretty painful turn, as all that initial optimism collided with a very harsh new reality and a global crisis that almost nobody saw coming. You know, even right after the acquisition in 2016, the business wasn't exactly a smooth ride. Its performance was already kind of volatile, swinging up and down with its customers' fortunes. But the real catastrophe, that struck in 2020. Because PCC was so heavily tied to the aerospace industry, the COVID-19 pandemic, which basically grounded planes all over the world, was a direct, devastating hit to its core business. And the impact was just staggering. I mean, look at this. Revenue absolutely plummeted, from over $7 billion pre-pandemic all the way down to just $3 billion. The demand for their most important products, it just vanished, almost overnight, as airlines canceled or delayed orders for new planes and parts.
And the fallout from that was just brutal. We're not just talking about numbers on a page. Pre-tax earnings dropped by a jaw-dropping 64%. And behind that number is the real human cost. The company had to cut its global workforce by 40%. This was a business in deep, deep trouble.
So this leads us to the climax of the story. With the business basically cratering, it was time for a reckoning. It was time for one of the most respected figures in the entire world of finance to publicly admit that he had made a massive error in judgment. And there it is. In 2020, Berkshire officially wrote down the value of PCC by $10 billion. In accounting, that's just a formal way of admitting, on their books, that they had overpaid by at least that much. That $16 billion in goodwill they'd bought? Yeah, it just wasn't worth what they thought anymore.
But what's really remarkable here is the honesty. Buffett didn't blame the pandemic. He didn't make excuses. He didn't point fingers at anybody. He took full responsibility. In his annual letter to shareholders, he just stated it plainly. I was wrong. He admitted he was too optimistic about how much profit PCC could make and had simply miscalculated the right price. That level of accountability for a mistake of this size is just incredibly rare.
So what's the takeaway from all this, right? This story isn't just about a big, scary number on a balance sheet. It's a powerful case study, a masterclass, really, in a timeless investing lesson that applies to every single one of us, not just billionaires.
And it all comes down to this core idea, something Buffett himself has been preaching for decades. Price is what you pay, value is what you get. See, he was right that PCC was a high-quality company. That's the value. But his mistake, by his own admission, was all about the price. He simply paid way, way too much for that value.
You know, judging that value is the incredibly hard part, because even a great company like PCC was operating in a brutally tough environment. It had these incredibly powerful customers like Boeing and Airbus who could play their suppliers against each other to drive down prices. And at the same time, PCC was constantly getting squeezed by rising material and Libra costs. Buffett just misjudged how much of the company's profit these relentless pressures would eat away over time.
And that brings us to the final critical question, doesn't it? The PCC story is just this humbling reminder that figuring out a company's true value is maybe the hardest part of investing. It's not a perfect science. It's a mix of art and analysis. And if the most successful investor of our time can make a $10 billion miscalculation, well, it just highlights the constant need for caution, for humility, and for a deep understanding that no matter how great a business seems, the price you pay for it ultimately determines everything.
You know, when you think of Warren Buffett, you probably think of cold, hard, rational investing. But today, we're diving into one of his most personal stories, a 50-year-long love affair with an industry that, in the end, he just couldn't save. This is a story about passion, about massive disruption, a final, surprising gamble, and, of course, the tough lessons he learned when it was finally time to let go.
So here's how we're going to break down this incredible story. First, we'll look at the lifelong love affair. Then we'll see how the world completely changed around him. We'll get into that one last, frankly shocking bet he made. Then the final breakup. And to wrap it all up, we'll pull out the key lessons from this whole 50-year saga. All right, let's start at the beginning. this whole story doesn't begin in some fancy boardroom. Nope. It starts on the streets of Omaha. See, Buffett's connection to newspapers, it was personal. It started way, way before he was the Oracle of Omaha we all know today. I mean, this goes all the way back to his childhood. His very first business venture was delivering newspapers. He literally understood this industry from the ground up. So for him, this wasn't just some number on a balance sheet or another stock in the portfolio. It was, in a very real way, part of his own origin story.
So why did he love it so much? Well, back in the day, the business model was, well, it was perfect. Think about it. Your local paper was basically a monopoly. If you were a business, you had to advertise there. They had total pricing power. And they generated what Buffett loves most, float. That's the cash they'd collect from subscriptions up front, which he could then go and invest before they even had to print the paper. It was an absolute fortress. And believe me, he put his money where his mouth was. For over a decade, he just kept buying. He started local in '69. Then in '73, he made that legendary investment in the Washington Post, getting it for a steal. By '77, with the Buffalo News, it was crystal clear. This wasn't just a casual interest. He was all in. But, every great story needs a conflict. And for the newspaper business, that conflict wasn't just some small competitor. It was a tidal wave. That perfect fortress-like business model was about to face a rival that it simply could not beat, the internet. And what the internet did was just systematically take apart every single advantage newspapers had. Being the main source of news? Gone. Replaced by instant access online. Having limited competition? Nope. Now there were infinite choices. And that incredibly valuable ad space, it got totally crushed by cheaper, super targeted digital ads. It was a battle for eyeballs, and newspapers were losing on every single front. And don't just take my word for it. By 2006, Buffett himself was basically writing the industry's obituary. In his annual letter, he came right out and said it. The foundation of the business was broken. Its best days were long gone, and the future was just a slow, painful decline. Okay, so you think that's the end of it, right? He sees the writing on the wall, he cashes out. But this is where the story gets really wild. After telling the world that the business was in an unstoppable slide, he did the last thing anyone expected. He doubled down. And this is the billion-dollar question, isn't it? It just baffled everybody. Why on earth would one of the smartest, most rational investors on the planet pour hundreds of millions of dollars back into an industry that he himself had just said was toast?
And we are not talking about a small sentimental purchase here. Between 2011 and 2012, Berkshire Hathaway spent $344 million buying up a whole portfolio of 28 daily newspapers, including, and this is key, his old hometown paper, the Omaha World-Herald. He was making a huge, concentrated bet against the very trend he had identified. So what was going on in his head? Well, it seems to be a mix of things. Part of it was a bet that local news, covering City Hall, high school football, that had a staying power that national news didn't. There were also apparently some clever tax advantages in the deals. But you just can't ignore the personal side. That lifelong love for the business had to be a factor. But even a guy like Warren Buffett can't fight gravity forever. Even with this big final bet, the brutal economics of the industry just kept getting worse. The downward spiral continued, and that led, well, inevitably, to the final chapter in this 50-year romance. The end came in two parts. First, in 2014, he finally sold that legendary Washington Post stake. Then, in 2020, came the final move. He sold everything else. The entire collection of local papers he just bought a few years earlier, it was officially over. But now, check this out. Look at how he structured the final deal. He didn't just take the $140 million in cash and walk away. Oh no. Berkshire also loaned the buyer almost $600 million to make the purchase happen and charged them a hefty 9% interest rate. So in the end, Buffett got out of the newspaper business by becoming its new bank. Let that sink in. Even while admitting defeat and exiting a failing industry, he figured out a way to keep making money from it. He got the dying assets off his books, but created a brand new, high-interest income stream for Berkshire. It was an absolute masterclass in getting value out of a situation right up to the very end. So after this incredible 50-year journey of love, loss, and some really shrewd deal-making, what's the big takeaway for us? What are the lessons we can pull from this whole thing? Well, it really boils down to three huge lessons. First, nothing, and I mean nothing, is permanent. Even the strongest business moat can be destroyed by new technology. Second, you have to avoid denial. When the facts change, you have to change with them, no matter how much you love a business. And finally, don't let the tax tail wag the business dog. A tax break is great, but it can't save a broken business model. And that leaves us with one last, really big question to think about. When we look around at the huge, dominant, unsinkable industries of today, which one is tomorrow's newspaper? What massive change is happening right under our noses that we might be missing? That might just be the most important question any of us can ask.
When you hear the name Warren Buffett, you probably think investing genius, right? The Oracle of Omaha. But what happens when the master himself admits to making a colossal, multi-billion-dollar mistake? Well, today we're going to dig into one of the biggest and most insightful errors Buffett ever confessed to. This is going to be good.
I mean, it almost sounds like a trick question. For decades, the guy's been the gold standard. But the answer, as we're about to see, is a big, fat yes. And understanding how it happened, wow, that's a powerful lesson for literally everyone who invests.
Okay, so first, let's set the scene. When we think of Berkshire Hathaway, we picture this impenetrable fortress of value, right? It's a collection of some of the world's absolute best businesses, all hand-picked for success over the long haul. It's the benchmark.
Now, the secret sauce behind all this success has always been pretty simple, but totally profound. Berkshire doesn't just buy little pieces of paper or stocks. It buys wonderful, real-life businesses. Companies with fantastic economics that just gush cash year in and year out.
And this chart really just drives home what exceptional means in Buffett's world. See, a typical stock might get your returns in that 12 to 20% range, which is fine. But the crown jewels in Berkshire's portfolio, we're talking 25 to over 100%. After tax, that's a whole different ballgame, and it's the real magic behind Berkshire's legendary growth.
So, keeping that super high bar in mind, let's get to where the story takes a really fascinating turn. Back in his 2015 annual report, Buffett made this incredibly candid admission about a huge chunk of his empire, a segment that, well, just wasn't living up to that exceptional standard.
He had this massive collection of companies all lumped together under this one umbrella, and it was everything from See's Candies, lollipops, all the way to NetJets, the private jet company. On the surface, it looks like this powerhouse of American industry, but underneath all that, a problem was brewing.
And the scale here is just mind-boggling. By 2015, the total assets in this one segment had ballooned to nearly $80 billion. That is an enormous amount of capital at play, which made the stakes incredibly high.
And then, boom, the bombshell drops, straight from the man himself. He admitted that when he sized up the economics of many of these companies, he was, in his own words, simply wrong. He said he misjudged them, and now Berkshire was paying the price. You just don't see that kind of raw honesty from CEOs, and it pointed to a really deep issue in how they were putting their money to work.
So what exactly was this misjudgment? Well, the answer is hiding in plain sight on a single line item on the balance sheet that most people just gloss over: goodwill. Let's break down what that is and why it's so important to this whole story.
Okay, so think of it like this. When a company like Berkshire buys another business, they pay for all the stuff you can touch: the factories, the inventory, the cash in the bank. But they almost always pay a premium on top of that. That extra amount for all the stuff you can't touch, like a great brand reputation or loyal customers, that's called goodwill. It's basically the price you pay for the company's good name. And here's the number that should make you sit up. Of that $78.5 billion in assets in that segment in 2015, over $30 billion of it was goodwill and other intangible assets. Just let that sink in. A huge percentage of the value wasn't in physical stuff. It was in the premium Berkshire paid.
So here's the kicker. That $30 billion was essentially a giant bet. A bet that the future earnings of these companies would be so awesome that they'd justify paying that huge premium. It was a bet on performance. And as Buffett admitted, it was a bet that, in a lot of cases, just wasn't paying off like he'd hoped.
And this wasn't some one-time problem they just fixed. If we fast forward to 2023, the numbers tell us the issue has actually gotten bigger. Total assets in this segment shot up to over $191 billion, and that goodwill portion, it climbed right along with it to over $34 billion. So this is clearly an ongoing challenge for them.
Okay, so Berkshire paid a big premium for these companies. But you might be thinking, why is that a mistake if they're still making money? And that question gets right to the heart of what great investing is all about. It comes down to one thing: opportunity cost.
Let's make this real with an example. Take McLean Company, one of the businesses in this segment. They're a massive distributor for huge clients like Walmart and 7-Eleven. It's a really tough business. You have to move a ton of product, and you make just a tiny slice of profit on each item. It's a decent business for sure, but it's not one of those high-return cash printing machines.
And this, right here, this is the core of the problem. All those tens of billions of dollars tied up in these companies were earning decent, but let's be honest, mediocre returns. Now compare that to the 25, 50, even 100% returns that Berkshire's truly exceptional businesses can generate. Every single dollar earning a mediocre return here was a dollar that couldn't be deployed to earn an exceptional one somewhere else. That is the true cost of the mistake.
What makes this whole confession so valuable is that it isn't just a story about Berkshire. It's a masterclass for every single one of us, whether you're playing the stock market or thinking about buying a local business.
So, what are the big takeaways here? I think it boils down to 3 key things. First, you have to scrutinize the premium you pay. That goodwill number on a balance sheet isn't just accounting fluff. It's the price of your own optimism. You got to ask yourself, are the future profits really going to justify this extra cost? Second, focus on cash generating power. Is buying this company actually going to result in more cash in the bank? Or are you just getting bigger for the sake of getting bigger? And finally, you have to watch that goodwill number like a hawk. Because if the business starts to struggle, companies have to write it down. And that can absolutely hammer a stock price. It's a big red flag that past mistakes are coming back to bite.
And that leaves us with one last really crucial question to think about. See, anyone can buy a good business. The hard part is buying it at a price that gives you a great return. If the greatest investor of our time admits he can get this wrong on a massive scale, it forces all of us to look in the mirror and ask, what's the real engine driving the businesses I own? And is the price I paid for it truly worth it?
All right, let's dive into one of the most puzzling investment moves from the legendary Warren Buffett. We're talking about a multi-billion-dollar bet on a company that is, quite literally, changing the world. A bet that disappeared from his portfolio almost as fast as it showed up. And it left everyone in the investing world scratching their heads and asking one simple question: why? So, to get us started, just look at this number. $71.3 billion. That's not the company's value. That was the revenue in just 2023 for Taiwan Semiconductor Manufacturing Company, or as everyone calls it, TSMC. We are talking about an absolute global giant. And you know, TSMC isn't just big for the sake of being big. It's kind of like the invisible engine that powers almost everything in your life. Your phone, your computer, your car, you name it. It's the company at the very heart of our digital world. And for a very brief moment, it was a crown jewel in Warren Buffett's legendary portfolio. So, how did we go from what looked like a perfect match to a sudden breakup? Here's the game plan for our explainer. First, we'll look at why it seemed like such a dream investment. Then, we'll track that shocking billion-dollar U-turn. We'll try to decode Buffett's very cryptic warning, dig into the too-big-to-fail argument, and wrap it all up with some really powerful lessons on risk and reward. Okay, first things first. Let's really get into why this whole thing looked like such a classic, no-brainer Buffett move right from the start. I mean, on paper, this was a marriage of a perfect company and a perfect investor. To really get this story, you have to understand what makes TSMC so special. They're what's called a fab, which is short for a fabrication plant. Now, here's the interesting part. They don't design their own chips. Instead, you have brilliant companies like Apple, NVIDIA, and AMD who design these incredible, world-changing chips, and then they hand the blueprints over to TSMC to actually build them. You could say TSMC has the magic factory. And that business model, that's exactly why TSMC checked every single box for a classic Buffett investment. It's widely seen as one of the best-run companies on Earth and arguably one of the most important. Remember that crazy global chip shortage a few years back that brought car production to a grinding halt? Yeah, that showed you just how critical they are. Their dominance is what investors call a moat, and TSMC's moat looked absolutely unbeatable. So, everything's looking perfect, right? The stage is set for a long, happy, and very profitable relationship. But that's not what happened at all. What came next was one of the quickest and most surprising reversals we've seen from Berkshire Hathaway in a long, long time. And this just shows you the insane speed of this whole thing. In the third quarter of 2022, Berkshire drops a whopping $4.1 billion on 60 million shares, becoming a massive shareholder. And then, just a few months later, first quarter of 2023, poof, it's gone. They sold pretty much the entire thing. Now, this is what makes this story so compelling. This move just flies in the face of one of Buffett's most famous principles. This is a guy who says his favorite time to hold a stock is forever. He doesn't flip stocks. He buys wonderful businesses for the long haul. And this was the exact opposite of that. So here's the multi-billion-dollar question. What on earth could have changed so dramatically in just one quarter? Now, this is really important. Our source material makes it crystal clear that nothing fundamental changed about TSMC's business. The demand for chips didn't just vanish. In fact, if anything, people expected them to make even more money in the future. Nothing about the company itself went wrong. So, if the business was still fantastic, what was the problem? Well, the answer came from the man himself at his famous annual shareholder meeting, though it was kind of wrapped in a riddle. And there it is, at the 2023 Berkshire meeting, Buffett gives this very, very careful and super cryptic explanation. He basically says, yeah, TSMC is a fantastic company, but I reevaluated things because of certain events that were going on. He never says what those events were, but the implication was just hanging there in the air. Then his partner, the late, great Charlie Munger, chimed in with this. He said that Buffett should be able to feel comfortable with his investments. Now, our source suggests that this sounds less like a brilliant strategic move and more like an admission that, for whatever reason, a feeling of discomfort won out over the hard business facts. So if you read between the lines, the conclusion is pretty clear. The sale wasn't about the company's profits or its management or its stock price. It was about one thing: location. Those certain things Buffett was talking about, almost certainly the geopolitical tensions surrounding Taiwan. He was worried about risks that were totally outside of the company's control. So case closed, right? Buffett got nervous about geopolitics and cashed out. Well, not so fast, because our source material brings up a really compelling counter-argument, an argument that suggests this kind of risk might just be impossible to avoid. I mean, just look at this list. It's a who's who of the entire tech world. The author points out that TSMC is the manufacturing backbone for all of them. The chip in your Apple iPhone, the chips that power NVIDIA's AI revolution, the processors from AMD, they all come to life inside a TSMC factory. These companies are completely, fundamentally dependent on TSMC. And that leads to this incredibly powerful question that really gets to the core of it all. Can you, as an investor, really avoid this geopolitical risk just by selling your TSMC stock? Especially when other huge companies in your portfolio, like Apple for Buffett, would get absolutely hammered if anything happened to TSMC. The risk isn't just in one stock, it's systemic. It affects the entire ecosystem. This whole saga, the perfect company, the shocking sale, the systemic risk, it actually gives us some incredibly valuable lessons for any investor who's trying to figure out how to navigate this very uncertain world. At its heart, this whole case is about a fundamental trade-off. On one hand, TSMC concentrated all its operations in Taiwan, which led to unbelievable efficiency and expertise. That's a huge pro. But the downside is a massive single point of failure risk. The alternative is to spread your operations all over the world. That diversifies your risk, but it also creates a ton of new headaches. Different laws, different cultures, currency swings, finding enough skilled workers. There really is no easy answer. So what's the takeaway for our own strategies? Well, the author of our source material lays out a really clear 3-step framework. Step 1, find a truly wonderful business. That's the hard part. Step 2, don't stick your head in the sand. You have to acknowledge the known risks. But step 3, and this is the most important part, is what you do with that knowledge. And this just nails the main lesson. Maybe the answer wasn't as simple yes or no, all in or all out. The key takeaway here isn't that you should run away from great companies that have obvious risks. It's that you manage that risk through smart capital allocation. Maybe a smaller investment lets you ride the upside while protecting you from the worst of the downside. It's not just about if you bet, but how much you bet. In the end, this whole Buffett TSMC story doesn't give us a neat, tidy answer. Instead, it leaves us with what might be the most important question any investor has to ask themselves when they're staring at a fantastic opportunity that also comes with real, obvious risks. What do you do? There's no single right answer, but thinking through that very question, well, that's what investing is all about.
You know, for over a century, the name General Electric basically was American power. I mean, it wasn't just a company, right? It was an institution. But in 2008, this absolute titan came this close to a complete and total meltdown, and in the process revealed a secret identity that, honestly, nobody saw coming. So we're going to explore how a manufacturing giant secretly became one of the world's biggest banks, why it all nearly collapsed, and how the world's most famous investor had to step in at the very last second.
And really, this timeline just puts the whole thing in perspective. On one hand, you've got 1892, founded by the Thomas Edison, the absolute icon of American ingenuity. And then you fast forward to 2022, and you've got a company that's just struggling to stay relevant. So what happened in between? Well, that journey is one heck of a cautionary tale about ambition, about risk, and about a hidden identity. How did it all happen? Let's unpack it. All right, so to really get our heads around this epic story, we're going to break it down into 6 parts. First, we'll look at GE as an American icon. Then, the rise of its, let's call it a financial engine. We'll dive right into the 2008 catastrophe that blew the doors off everything. See Warren Buffett's dramatic rescue, and then we're going to ask, was it really a great deal? Finally, we'll pull out the key lessons from this titan's stumble.
Okay, first things first, let's set the stage, because you really can't overstate just how important GE was. I mean, look who founded it, a legit trio of giants. You had Thomas Edison, the ultimate innovator, J.P. Morgan, the master financier, and Charles Coffin, the business mastermind. Seriously, from day one, this company was practically destined for greatness.
And you know what? For decades, they absolutely delivered on that promise. I mean, just look at this stuff. This isn't just a list of products. We're talking about the building blocks of modern life. Light bulbs, X-ray machines, washing machines, stuff for aerospace and power. GE was the company that made real, tangible things that literally changed the world and pushed civilization forward.
Okay, but here's where the plot thickens. This brings us to the central problem. See, back in the 80s and 90s, under the legendary CEO Jack Welch, something fundamental started to shift. Think about it. Building jet engines is really hard. The profits are kind of lumpy, right? They're not perfectly predictable every single quarter. But Wall Street? Oh, Wall Street demands smooth, consistent growth. And it turned out, finance was the perfect tool to deliver that. So the company famous for making things started acting a lot less like a manufacturer and a whole lot more like a bank.
And this right here, this shows you just how massive that transformation was. By the time we get to 2008, GE Capital, that's their financing arm, was generating nearly 50% of the entire corporation's profits. Yeah, just let that sink in for a second. The company that Edison built was making almost as much money from financial engineering as it was from everything else combined, and it was all done to hit those nice, smooth, predictable quarterly numbers that investors just loved.
And when we say massive, we mean massive. Look at these numbers. By 2007, GE Capital had over $500 billion in debt. So this was not some little side hustle. It was a colossal, highly leveraged, and, here's the crucial part, unregulated bank hiding in plain sight. But here's the crazy part. Because it was all tucked away inside good old safe GE, the manufacturer, the rating agencies gave it a perfect AAA rating. The market was completely misjudging the risk. And then, 2008 happened. The whole world changed. The global financial markets just froze. The music stopped. Specifically, the short-term lending markets, the very markets GE Capital relied on every single day to roll over its massive debt, they just vanished. Poof, gone. Literally overnight, all their funding disappeared. And that's the moment that GE's secret identity turned into its fatal flaw.
This really gets to the heart of the problem, a complete identity crisis. The perception was that GE was a safe, steady, innovation-driven manufacturing company. But the reality, which the crash brutally exposed for everyone to see, was that it was actually a highly leveraged financial beast, every bit as vulnerable as the big Wall Street banks. And just like that, the company's very survival was on the line.
And this is where things got really, really scary. It was a total catch-22. Look, GE was arguably too big to fail. Its meltdown could have crippled an already wounded U.S. economy. But, and this is a huge but, because GE Capital wasn't technically a bank, it was not eligible for the government bailout programs from the Federal Reserve. You know, the ones that saved institutions like Goldman Sachs and Morgan Stanley? Yeah, GE couldn't get that help. They were on their own. So, with the company on the brink and no government bailout in sight, they made a desperate call to Omaha, Nebraska, to Warren Buffett, arguably the most respected investor alive, and he agreed to step in. Now, his investment wasn't just about the money. It was this powerful token of confidence that sent a clear signal to the panicked markets. Hey, everyone, GE is worth saving.
And the deal he struck, oh, it was classic Buffett. Okay, here's how it worked. His company, Berkshire Hathaway, put in $3 billion for what's called preferred stock. It's kind of like a hybrid of a stock and a loan, and it put him first in line to get paid. And check this out. It guaranteed him a massive 10% annual dividend. That's $300 million a year, no matter what. On top of that, he got a little sweetener, an option to buy GE's regular stock at a fixed low price for the next 5 years. For GE, it was a lifeline. For Buffett, it was an incredibly sweet deal.
And hey, the deal worked. GE survived. But looking back, a fascinating question comes up. Did the master negotiator Warren Buffett get the absolute best deal he possibly could have for his shareholders, or was something else at play here?
And here's the twist, and it comes straight from Buffett himself. He later admitted that with GE being so desperate, he could have gotten even better terms. He knew that if he just waited a few more days, as the market panic got even worse, he could have demanded a bigger dividend, a lower stock price, a much larger slice of the company. He left money on the table, and he knew it.
But let's put that quote into perspective with this number. Buffett called his own deal subdue, kind of meh. And yet his company still walked away with a $1.5 billion profit. That's a 50% return. So why the self-criticism? Well, it just tells you that his definition of a great deal operates on a completely different planet than for the rest of us.
This leads to a really compelling theory, emotional appeal. You know Buffett's famous mantra, right? To be greedy when others are fearful. Well, 2008 was the most fearful moment in generations, so why wasn't he greedier? Is it possible that the famously rational investor was influenced by the idea of saving a great American company? Did his desire to help stabilize the whole system cause him to pull his punch, just a little bit?
And this comparison pretty much sums up what happened next. The two companies went on totally different paths. General Electric? Yeah, they survived, but they were a wounded giant. Their stocks struggled for years after that. And Berkshire Hathaway? They just collected their massive dividends, sold all their shares by 2017 for a significant profit, and moved on.
So, what can we all learn from this incredible story? Well, the fall and rescue of GE offers at least 3 powerful lessons for anyone interested in business or investing.
The first one is a crucial warning. Whenever you hear a company's leadership start talking about diversification that takes them way outside their core business, like a manufacturer getting deep into high-risk finance, it's a signal to pay very close attention. A lot of the time, that kind of diversification just adds a ton of complexity that's really just hiding enormous risk.
The second lesson is even more blunt, especially when it comes to finance. The phrase innovation in financial products should be a major red flag. Seriously. More often than not, these complex new products don't create real value. They just obscure risk in new and dangerous ways. And GE Capital's balance sheet is the ultimate proof of that.
And the final lesson, and this one comes from Buffett's own reflection, is maybe the most profound. Investing isn't always a game of extracting every last possible dollar. Sometimes you have to consciously decide for yourself what good enough looks like. You have to decide when to act and what your ultimate goal really is, because it might not always be just about pure profit maximization. Which leaves us with a powerful final question to think about. When an entire system is on the brink, and you're one of the few people with the power to actually step in, the decision is no longer just about numbers on a spreadsheet, is it? Buffett got a fantastic deal, but he could have been more ruthless. He saved an American icon, but he left money on the table. It forces all of us to ask, where exactly is the line between a good deal and the right thing to do?
All right, today we are diving deep into one of the most audacious, most legendary deals in modern financial history. We're going to see how the Oracle of Omaha himself, Warren Buffett, looked at a moment of absolute global panic and saw a once-in-a-lifetime opportunity. So here's the big question we're tackling today. Just picture it. It's 2008. The financial world is literally on fire. Markets are in a total freefall, and fear is absolutely everywhere. And right then, in that moment, one investor makes a massive $5 billion bet on a Wall Street giant that looked like it was about to go under. How on earth did that happen? And what made it so brilliant?
So here's our game plan. First, we'll set the scene and look at this financial titan that was in some serious, serious trouble. Then we'll see how Warren Buffett threw them a dramatic lifeline. After that, we'll get into the nitty-gritty, the anatomy of the deal itself. Then we'll follow the money over a whole decade. And finally, we'll pull out the key lessons we can all learn from this masterclass.
Okay, to really get why this deal was pure genius, you have to transport yourself back to 2008. I mean, the global financial system was on the absolute brink of collapse. Even the biggest, most powerful names on Wall Street were feeling the pressure.
Now, right in the eye of this hurricane was Goldman Sachs. And look, this wasn't just some company. Goldman was, and still is, an absolute powerhouse in global finance. We're talking a top-tier firm in investment banking, wealth management, the whole shebang. They were seen as one of the unshakable pillars of the financial world. But as it turns out, even pillars can start to crumble. During the crash, Goldman's stock value was just in an absolute nosedive. Confidence in the market had completely vanished, and the firm was actually struggling to fund its day-to-day operations. They were bleeding cash, sure, but what they were really bleeding was credibility, and that was something money alone couldn't fix. And that is when the phone rang. On the other end, Warren Buffett. You see, his involvement wasn't just about cash. It was a signal, a massive vote of confidence to the entire world. While everybody else was sprinting away from the fire, the most famous investor on the planet was running straight toward it. And he did it with an absolutely jaw-dropping amount of money, $5 billion. Just let that number sink in for a second. In the middle of a historic crisis, this was so much more than an investment. It was Buffett basically telling the world that Goldman Sachs was not going to fail. He believed it would survive, and not just survive, but thrive. Now, here's a piece of the puzzle that is so important to understand. This was not some cold, faceless transaction. Not at all. Buffett had a long history with the leadership at Goldman. They'd helped each other out for decades. So this entire deal, it was really built on a foundation of personal trust. So how was this legendary deal actually structured? Well, it was a two-part masterpiece, really. It was designed to protect Buffett's investment if things went south, while giving him absolutely enormous potential if things went well. Let's break down the two key pieces. Okay, so the deal had two main parts. First, Buffett's company, Berkshire Hathaway, got what are called preferred shares. Think of these as a steady, high-interest income stream. The second part, and this is the exciting part, was warrants. These were basically a golden ticket to buy Goldman stock at a super cheap fixed price down the road. Let's look at each of them. All right, part one was all about safety. It was about getting a guaranteed paycheck. Buffett received these perpetual preferred shares, and the dividend they paid? A massive 10% annually. On a $5 billion investment, that's $500 million in cash, every single year, guaranteed. You have to remember, this was at a time when interest rates were being slashed to basically zero. A guaranteed 10% was, well, it was unheard of. Now, for part two, the warrants. This was the big bet on the future. This was the lottery ticket. Buffett got the right to buy over 43 million shares of Goldman stock for just $115 a pop, anytime he wanted before October 2013. So if Goldman recovered and its stock price soared past $115, these warrants would be worth an absolute fortune. This was the high-risk, high-reward part of the whole thing. So the deal was set. A safe, steady income stream from the preferred shares, plus a huge potential payday from the warrants. It looks brilliant on paper, right? But how did it actually play out in the real world over the next decade? Let's follow the timeline. So the journey starts in 2008, but listen, it was not a straight line up. Oh no. By 2009, Goldman stock had actually cratered to around $50 a share, less than half of Buffett's locked-in price. But he held on. By 2011, things had stabilized, and Goldman bought back those expensive preferred shares. Then in 2013, Berkshire cashed in its warrants, and finally, in 2020, they sold off the last of their stock. So let's just look at the profits from that safe part of the deal. Over just 2.5 years, Berkshire collected $1.1 billion in those guaranteed dividend payments. Then, when Goldman wanted to buy those shares back, they had to pay a penalty, a premium, of another $640 million. That's over $1.7 billion in profit from just one half of the deal. I mean, let's just put a fine point on that. That part of the investment alone delivered a 35% gain in just 2.5 years. That is an incredible return,
especially when you consider it was secured right in the middle of a global meltdown. But remember, that was only part one of the story.
And this is the payoff from part two. This is the home run. After converting those warrants into regular stock back in 2013, Berkshire held on to those shares for years. And when they finally sold the whole position in 2020, they cashed out for a staggering $2.3 billion. That was the profit from the long-term bet on Goldman's comeback.
So when you added it all up, this one single deal made Berkshire Hathaway a profit of around $4 billion. It's a textbook case of brilliant crisis investing. So what are the big lessons, the key takeaways we can pull from this masterclass?
The first, and maybe the most important lesson of all, is this: relations and power matter. A deal this good probably wouldn't have been on the table for just anybody. It was born from decades of mutual respect and shared history. It's a huge reminder that behind every spreadsheet, there are people and relationships.
So this brings us to our final lessons. First, business, at its core, is often personal. Relationships matter. Second, as investors, you have to look beyond the numbers and really try to understand the why behind a deal. And finally, yeah, getting locked into a fixed-price deal when the market's down can be a really bad move for a company, but this case adds a huge asterisk. It's only a bad idea unless you're like Buffett, and you can structure the terms so brilliantly that you're protected no matter what, with a massive upside.
And that really leaves us with a final question to chew on. The Goldman Sachs deal was, without a doubt, a numerical triumph. But it was also a story about trust, reputation, and having the courage to show confidence when everyone else is consumed by fear. It makes you ask, when is a business deal about something more than just the numbers on a spreadsheet? Thanks for joining this explainer.
You know, when you think of Warren Buffett, you think of these legendary investment wins, right? But what about his mistakes? Well, today we're going to dive into one of them, and this is a wild one. It's a deal where his company made over $6 billion in profit, and he still called it a massive error. It's a fascinating story about what he called a costly financing, and trust me, it reveals a lesson worth, well, billions.
So that's the big question, isn't it? How on earth can making over $6 billion in profit be a mistake? I mean, you more than double your money on a huge investment and you call it a failure? It sounds completely backward. It defies all logic. But the answer gets at a really fundamental truth about investing, something you're just not going to find in a balance sheet.
All right, so let's get into it. Our story starts with a deal that was, literally sweet. We're talking about two absolute giants in the candy world, Mars and Wrigley, and how they decided to team up in one of the craziest economic times we've ever seen.
Okay, so let's set the scene here. You've got the Wrigley Company. They've been an icon in chewing gum since, 1891? And then you have Mars Incorporated, this super secretive, family-owned giant. But the timing is everything. It's the middle of 2008. The entire global financial system is basically teetering on the edge of a cliff. And right then, in the middle of all that chaos, Mars drops this bombshell, a massive $23 billion proposal to buy Wrigley.
Now, you can imagine a deal this big, especially during a financial crisis, that's not easy to pull off. The banks were freaking out, they were locking up their money, cash was king. So for Mars to make this historic merger happen, they needed someone with seriously deep pockets and a rock-solid reputation. They needed an Oracle.
And that's when they turned to Warren Buffett. I mean, it makes sense, right? He got the business. It was simple, it was stable, and it had a brand that everybody knew. So alongside Goldman Sachs and JP Morgan, Buffett's company, Berkshire Hathaway, stepped right in. They put together a huge $6.5 billion financing package to make this whole thing a reality.
And let's just stop and think about that number for a second. $6.5 billion in the middle of a global market meltdown. Buffett throws this enormous pile of cash at a deal for one candy company to buy another. On the surface, it looks like a huge vote of confidence, a classic Buffett move. But was it really?
So the way this financing was set up was just classic Buffett. It wasn't some plain old loan. Oh no. It was this really clever two-part deal. First, Berkshire bought $2.1 billion of what's called preferred stock. That gave them a 10% stake in Wrigley, plus a guaranteed 5% dividend every year. Then, the bigger part of the deal, a $4.4 billion loan to Mars, set up as bonds that paid this ridiculously high interest rate. We're talking 11.45% a year.
Okay, so the deal is done, the money is in. Let's fast forward a bit and see how it all turned out. Let's look at the returns.
And you can probably guess, with terms this good, Berkshire Hathaway was about to have a very, very good payday.
Let's break down just how good this payday was. We'll start with that preferred stock. By the time Berkshire sold its stake in 2016, they had made a cool $2.5 billion in profit, plus another $840 million in dividends. You add that up, and that's over $3.3 billion in profit from just that one piece of the deal.
And then you've got the debt part of the deal, which you could argue was even better. So Mars actually paid the loan back early, in 2013. But in those 5 years, Berkshire collected $2.5 billion in interest, and they got a nice hefty fee for that early repayment. So the total profit from just the loan, almost $3.2 billion.
So here's the bottom line. You take the profit from the stock, you add the profit from the debt, and Berkshire's initial $6.5 billion investment generated over $6.5 billion in pure profit. They literally doubled their money. By any measure, that is an absolutely incredible result.
And, as one of the sources for this explainer put it, the deal looks decent on an average day in the market. It was solid, it was super profitable, and it was a pretty safe bet on a stable company in the middle of total chaos. So, if it was so great, where in the world is the mistake?
And this, my friends, is where the story takes a fascinating turn. We've already established that the deal was a huge financial win, right? But to really get a handle on the mistake, we have to look past the profit. We need to look at what Buffett didn't just gain, but what he had to give up to make it happen.
And that hidden price tag? It has a name: opportunity cost. It's one of the most powerful ideas in all of economics and investing. It's pretty simple, really. It just means that for every single choice you make, there's another choice you didn't make. The opportunity cost is the value of that other path, the potential profit you missed out on because you chose to do something else.
So that $6.5 billion in cash, where did it come from? This is the absolute core of the issue. It wasn't just sitting in a bank account, no. To get the money for the Wrigley deal, Berkshire had to sell shares of other companies it owned. And we're not talking about just any old stocks. We're talking about absolute powerhouses, what Buffett calls wonderful companies, like Johnson & Johnson and Procter & Gamble. And the timing? He sold them at the absolute worst possible moment, right at the bottom of the 2008 market crash.
And this is where the big contradiction comes in. I mean, what's Buffett's most famous saying? Be greedy when others are fearful, right? That means you should be buying fantastic companies when everyone else is panicking and prices are in the toilet. But to fund this safe Wrigley deal, he did the exact opposite. He was selling wonderful companies while everyone else was terrified.
And this really lays out the strategic error perfectly. You've got the Wrigley deal, which was a guaranteed high-return investment. It delivered that huge $6.5 billion profit. But then there's the opportunity cost, and it was just immense. If he had just held on to those shares of Johnson & Johnson and Procter & Gamble, their value would have doubled, and in P&G's case, even tripled over the next few years. And that's not even counting the dividends. The safe money he took was almost certainly way less than the potential profit he left on the table.
There are still some really fascinating unanswered questions about all this. Like, why did a super stable company like Wrigley agree to pay such a high interest rate, 11.45%? Think about it. During that exact same crisis, Buffett made deals with much riskier companies like General Electric and Goldman Sachs, and they only paid 10%. It's a really curious detail that just adds another layer of mystery to this whole thing.
So after all that, what are we supposed to learn from this? It's so easy to look at a legend like Buffett and just assume they never mess up. But this Wrigley deal, it actually gives us some of the most valuable lessons an investor can possibly learn, and it's because it comes from a moment when he wasn't perfect.
So, what are the big lessons from this billion-dollar mistake? Well, first, a bear market isn't the time to be selling great companies. It's that rare, golden opportunity to buy them at a huge discount. Second, the profit number you see on paper, it's not the whole story. You always have to think about the hidden cost, the opportunity cost of what you gave up. And finally, that warm, fuzzy feeling you get from securing a good deal or a sure thing, it can't hold a candle to the cold, hard facts. The real value is found not just in the deal you close, but in the even better ones you might be passing up.
And that leaves us with one last really big question to think about. That Wrigley deal, it was a sure thing, right? It was safe, it was stable, and it was guaranteed to make money. But as we've seen, that certainty came with an absolutely enormous hidden price. And it kind of makes you wonder, not just in investing, but in life, what's the true price of a sure thing?
We all know Warren Buffett as one of the greatest investors, ever. But what happens when the Oracle of Omaha gets it wrong? And I mean really, really wrong. we're not talking about a small miscalculation. We're talking about a $217 million blunder, one that he personally called a major failure. So let's dive into the fascinating story of Buffett's disastrous bet on Irish banks. Here's how we're going to break it down. First, we're going to look at the shocking result, just how much money was lost. Then we'll hit rewind and see how the bet came about in the first place. We'll explore why Buffett himself called it an unforced error, and then we'll pinpoint the one tiny critical detail he missed. And finally, we'll pull out two huge lessons we can all learn from this very expensive mistake.
Okay, let's just start with the aftermath because honestly, the final number is absolutely jaw-dropping.
Yeah, that's a minus sign. A loss of 89%. You know, this is the kind of number you might see from a first-time trader, not from one of the most careful, disciplined investors on the planet. The question just immediately pops into your head. How on earth did this happen? And that percentage, well, it translates into a whole lot of cold, hard cash. Look at this. An initial investment of $244 million was just hammered down to only $27 million. That's a net loss of $217 million. The gap between those two bars says it all. It was a brutal, brutal loss. And this really is the central mystery, isn't it? This wasn't some complex, crazy new technology. It was banking. I mean, this is supposed to be Buffett's bread and butter. So how did the master himself get it so completely and utterly wrong? Let's dig in. To really understand the mistake, we have to jump in our time machine and go all the way back to 2008, right when this whole thing started. So, picture it. The year is 2008. The entire global financial system is teetering on the brink of collapse. Markets are in a free fall, and fear is absolutely everywhere. And you know, this is exactly the kind of environment where Buffett thrives. As he always says, you have to be greedy when others are fearful. And he thought he found the perfect opportunity in Ireland. And he didn't just dip a toe in the water. No, he went in big. He invested a staggering $244 million across two different Irish banks. For anyone, even for Berkshire Hathaway, this was a major, confident bet. So what was the thinking here? Well, it was classic Buffett. The panic in the market had crushed the stock prices of these banks so much that on paper, they looked incredibly cheap. You know, it's his signature move, buying what he thought was $1 for just 50 cents. But, and this is a huge but, here's a piece of the puzzle he later admitted he completely misjudged. Ireland is a small country. At the time, its population was less than 4.5 million people. This meant that the entire property market, and therefore the banking system, was super concentrated. The risk wasn't spread out at all, like it would be in a much larger country. So the investment goes south. Badly. But you know, what's maybe the most remarkable part of this whole story is how Buffett himself described what happened. He didn't blame the economy, he didn't blame bad luck. He took all of the blame himself. He called it an unforced error. Now, if you're a sports fan, you know exactly what this is. It's not when your opponent hits some incredible, once-in-a-lifetime shot. No, an unforced error is when the ball comes to you perfectly, you've got an easy shot, a total sitter, and you whiff it. You hit it right into the net. It's a mistake that is 100% your own fault. And look, here it is, from the man himself. This quote is just incredible. I simply didn't understand. I just plain wasn't paying attention. Think about that. The honesty there is just astounding. He's openly admitting that the clues were all there, right in front of him. He just missed them. Okay, so he said he didn't understand. Well, what was it? What was the one single detail he wasn't paying attention to? This right here. This is the absolute core of the $217 million mistake. Here it is. This is the crucial distinction he just flat out missed. You see, on the surface, these companies were banks, but Buffett didn't realize that they weren't your typical banks making loans for finished houses. No, their books were jam-packed with something much, much riskier: land development loans. This was money they were lending out for speculative projects on empty plots of land. One is a loan on a real physical house. The other is basically a gamble that the future will be bright. They are two completely different businesses with totally different risks. And boom, there it is. Buffett broke his own #1 rule: never invest in a business you don't fully understand. He thought he was buying a simple, boring bank, but what he actually bought was a highly speculative real estate company that just happened to look like a bank. So the mistake was huge, and a reason is crystal clear.
But the real value for us today, looking back at this, is what we can learn from this very expensive failure. Two giant lessons really jump out. First, and it seems so obvious now, you have to understand the specific business model. Saying you understand banking isn't enough. The devil is always in the details. And second, making a mistake during a huge market crash, like in 2008, well, that's extra painful because of something called opportunity cost. So what's opportunity cost? It's really simple. It's all the other great things you could have done with your money. Think about it. During the 2008 crash, some of the best companies in the world were on sale at massive discounts. That $244 million could have bought a piece of a truly incredible business for a bargain. But it couldn't, because it was stuck in this losing Irish bank bet. The real cost wasn't just the $217 million he lost. It was all the money he could have made somewhere else. And that really brings us to the final thought here. Buffett's huge mistake wasn't about some complicated algorithm or secret formula. It was a failure to understand the absolute basics of the business. So it's a great question to ask yourself. What business model in your own life, maybe an investment, a career path, or project at work, do you think you understand, but maybe you don't? What's the one critical distinction you might be missing? Because figuring that out could be the difference between your own unforced error and your next big success. Today, we're going to decode one of the boldest, most mind-bending financial plays in modern history. We're talking about how Berkshire Hathaway bet billions on the stock market at the very moment the entire world thought it was about to collapse. We're going to break down how they did it, the mindset behind it, and what this whole thing tells us about that super fine line between genius-level skill, pure risk, and just plain old luck. All right, so picture this. The year is 2008. The global financial system is, well, it's on fire. It's teetering right on the edge of a total collapse. You've got banks failing, markets are in an absolute freefall, and the only thing anyone is selling is fear. While pretty much every investor on the planet was running for the hills, just trying to salvage whatever they could, Berkshire Hathaway did the complete opposite. Right in the middle of all that chaos, they calmly collected a staggering $4.2 billion in cash premiums. How? By making a massive long-term bet on the future of the markets. It was a move that, to just about everyone else at the time, looked incredibly audacious, maybe even a little crazy. Okay, so let's really dive into the nitty-gritty here. How in the world did this bet actually work? What were they buying, and what kind of opportunity did they see that seemingly nobody else did? So here's the breakdown. Berkshire wrote 251 derivative contracts. Now, these were a very specific type called equity puts, but what's really key here is how Berkshire thought about this deal. They saw that $4.2 billion premium not just as a fee, but as float. Now, if you know Berkshire, you know this is a core concept from their insurance business. It's brilliant. They get all this cash up front, and they get to invest that money for themselves for years, sometimes decades, before they might have to pay anything out. It's basically a giant interest-free loan. And the real insight from Warren Buffett himself, he was convinced the market was so panicked that these contracts were fundamentally, dramatically mispriced right from the start. So what exactly is an equity put contract in plain English? Think of it this way. Berkshire was basically selling insurance on the stock market. They were paid that huge premium up front, and in exchange, they promised to pay out only if major stock indexes, like the S&P 500, were below a certain level 15 or even 20 years into the future. It's a long-term bet. If the markets recovered and just stayed above that line, Berkshire would owe absolutely nothing and keep the entire $4.2 billion. You know, to make a bet of this size, you need way more than just guts. You need a deeply, deeply held investment philosophy. So now let's get inside the mindset, what we're calling the Buffett doctrine, that made this whole monumental bet even possible. This quote right here, it tells you everything you need to know. Buffett knew from day one that the value of these contracts would jump all over the place on paper from year to year. But he's telling us flat out, those swings are just accounting noise. They don't touch the actual cash they got, and they sure don't change the long-term logic of the bet. It's why he says that he and Charlie Munger just weren't bothered by it, not one bit. And here's the second crucial piece of that doctrine. First, you have absolute conviction. Buffett wasn't guessing. He believed these things were bargain because they were priced based on short-term fear, not long-term reality. And second, total accountability. He didn't just hand this off to some trader. He personally initiated and monitored these positions. And this is the powerful idea that underpins it all. For a decision this big, the buck has to stop at the very top.
The person in charge can't just be a manager. They have to be the ultimate guardian of the company's capital and its exposure to risk. Buffett was essentially saying, if this goes wrong, it is 100% on me.
Okay, so let's get back to those wild swings that Buffett mentioned. Because even if you know in your head that they're just on paper, the numbers are so huge, so absolutely staggering, that they could test the conviction of just about anyone. I mean, just look at these figures. In one period, Berkshire reported a paper loss on these investments of almost $68 billion. But then, in another period, a paper gain of nearly $75 billion. That is a truly mind-bending swing in reported earnings, and it leads to a very obvious question. How on earth is this possible, right? How can a company's fortunes seem to swing by over $140 billion from one year to the next? Is this real money just flying in and out the door? Well, the answer comes down to a single, and often really misunderstood, accounting rule.
And this right here is the answer. It is all about an accounting rule called mark-to-market. Basically, every year, companies have to report the current market value of their investments, even if they have zero intention of selling them. So when the market dips, they have to report a paper loss. When the market goes up, they report a paper gain. But for Berkshire, and this is the crucial part, none of it actually matters until the contracts expire way, way down the road. It's just noise. So after navigating the bet, the philosophy, and that crazy paper roller coaster, what's the final verdict on this whole thing? Well, the success of a bet like this really boils down to a fascinating mix of two very different forces. First, you have skill. The source calls this a comparative advantage. This was Buffett's unique, almost legendary ability to stay rational when everyone else was panicking, and to see that these long-term contracts were being sold way too cheap. But then, there's the second element, pure unpredictable luck. Now, the source makes a really great distinction here. This isn't just the kind of luck where preparation meets opportunity. No, this is what it calls the second type of luck, when a totally unexpected and unknown event brings positive surprises. We're talking about things no one could have possibly predicted back in 2008, like massive government stimulus packages or unforeseen tech booms that sent the market soaring. So what is the big lesson here? What's the takeaway from all this? It's that even with incredible skill and a healthy dose of good luck, the absolute foundation of it all is risk management. Berkshire structured these deals perfectly. They could never face a surprise cash call, they got all the premium up front, and the expiration dates were so far off in the future that they gave the economy plenty of time to heal. They managed the risk first, and that's what gave them the freedom to make the bet. And that brings us to the final and, I think, fascinating question posed by the source material. A bet like this required a really unique combination of Warren Buffett's personal conviction, his reputation, and his willingness to put his name on the line. So as Berkshire transitions to new leadership, will they, or maybe more importantly, can they, continue to make these kinds of complicated, contrarian, truly legacy-defining bets? Well, that's a question that only time will answer.
All right, welcome to The Explainer. Today, we're digging into a huge, and I mean massive, mistake that Warren Buffett himself admitted to. And what's wild is, this isn't a story about a bad investment he made. No, it's about the absolutely mind-blowing cost of doing nothing at all. Okay, so let's just start with a number, a big one, that kind of sets the stage for this whole thing. $1 billion. That's the estimated earnings lost from one single moment of just not doing anything. A decision to just let an opportunity pass by. I mean, think about that. For anyone, that's a staggering figure, but for an investor like Buffett, it's almost hard to wrap your head around. So this really puts the scale of that miss into perspective. Back in 1974, the offer on the table was for $35 million. Fast forward just over 30 years to 2007, and its value was estimated at a cool $800 million. And get this, that doesn't even count the absolute river of cash it was spitting out that whole time. Which brings us to the big question, right? How in the world does Warren Buffett, a legend known for his super detailed analysis and, being decisive, how does he make a billion-dollar blunder? Like, what actually happened there? Well, that's exactly what we're going to get into. Okay, so to really get how big of a mistake this was, we got to go back to the beginning. Back to when what looked like the perfect pitch landed right in his lap.
All right, so this TV station had actually been chugging along since 1948, but the really important year for our story is 1974. That's when a government ruling kind of kicked everything off. And then the whole thing comes full circle in 2007 when Buffett himself spills the beans, laying out all the painful details for his shareholders. So what was the big catalyst? Well, it was a change in the rules. The FCC came out with a ruling on what they called cross-ownership. Basically, you couldn't own both a newspaper and a TV station in the same city anymore. This rule forced the owner's hand, and just like that, this incredibly valuable, super profitable business was suddenly up for grabs. And this wasn't some cold call from a random broker. Nope. The offer came straight from Tom Murphy, the CEO of Capital Cities, a guy who was hugely respected. And Murphy wasn't just some business acquaintance. Buffett really, really admired him. He was a friend. He knew exactly how Buffett liked to invest, and he basically gift-wrapped this opportunity and handed it to him for just $35 million. I mean, this just shows you how personal and direct this whole thing was. It wasn't a subtle hint or anything. Buffett himself said it. In effect, Murph whispered "buy" into my ear. It was like a friend you trust completely just leaning in and telling you the answer. The ultimate insider tip, but totally legal. So it wasn't just about who was selling it, it was about what he was selling. Because the TV station itself, it was a tailor-made, absolutely perfect fit for Berkshire Hathaway. See, Buffett knew this industry like the back of his hand. He even had a name for businesses like these. He called them See's-like. That's a nod to his super successful purchase of See's candies. And what he meant by that was it was his ideal kind of business, a brand people loved, that had pricing power, and you didn't have to keep dumping tons of money into it just to keep it growing. Just like See's Candies, this TV station was a simple, easy-to-understand business that was basically guaranteed to be a cash-printing machine. Okay, so let's just recap for a second. You've got a perfect asset, right? Check. It fits your investing style perfectly. Check. It's offered at a great price by a trusted friend who happens to be an expert. Check, check, check. I mean, every single box is ticked. So, what does the master investor do next? It seems like a no-brainer, right? Well, the answer is the whole point of this explainer. And it's not some complex 4D chess move. It's not nuanced at all. Actually, it's shockingly, and for him, I'm sure, painfully, simple. He ignored it. That's it. He just ignored it. He didn't make the deal. He didn't even come back with a counteroffer. He didn't really even dig into the numbers. He just let one of the absolute best opportunities of his entire career just, poof, slip right through his fingers. And honestly, this might be the most incredible part of the whole story. You'd think there was some big reason, right? Some hidden risk he saw. Nope. Years later, he looked back and basically just shrugged. His own words were, "The only explanation is that my brain had gone on vacation and forgot to notify me." He had no complex reason. It just points to something so human, right? Maybe it was just easier to do nothing than to do something new, even when that something new looked like a sure thing. And that right there, that simple act of inaction, it's not even a bad decision, it's a non-decision. That's where we find one of the most powerful lessons in all of investing. And honestly, in pretty much any kind of big decision in life. So let's circle back to the actual hard numbers. What was the real cost of that moment his brain went on vacation? Well, by 2007, the station was worth $800 million. But wait, it gets crazier. In the time since he said no thanks, it had already generated about $1 billion in pre-tax earnings. $1 billion. This chart really just lays it all out, and it's stunning. Look at that first little bar. That's the $35 million offer. Now look at the second bar. By 2007, the station was making $73 million in 1 year. That's more than double the entire asking price every single year. And then that last bar, the $800 million valuation, it just completely dwarfs the original offer. It's not even in the same ballpark. So what's the lesson here? This whole billion-dollar story really just boils down to two super simple things. First, when a golden opportunity comes knocking, you have to actually get up and answer the door. You gotta fight that little voice that says it's safer to just do nothing. And second, when someone you trust, someone who's a real expert, tells you to do something, you should probably listen, like really listen. And that really leaves us with one final thought to chew on. Because this story, it isn't just about stocks and finance. It's about recognizing a great opportunity when you see one, and then having the guts to actually act on it. So the question for all of us is, what's our TV station? What's that perfect, obvious opportunity, big or small, that we might be ignoring right now, just because our brain decided to take a little vacation?
All right, welcome to The Explainer. Today, we're going to break down one of the biggest what-ifs in modern investing history. I'm talking about how Warren Buffett, arguably the greatest investor ever, made not one, but two massive billion-dollar mistakes with Walmart. And this story, it isn't just about a stock. It's really a masterclass in psychology, in decision-making, and what we can learn from it.
I mean, think about that question for a second. How do you make a $10 billion mistake twice? It sounds almost impossible, right? Especially when we're talking about a legend like Warren Buffett. But, this story is really a two-act tragedy. It's all about human psychology, it's about missed opportunities, and most importantly, the powerful lessons we can all learn when even a genius gets it wrong. All right, let's get into it.
Okay, so let's start with mistake number one. This is what you'd call a sin of omission. Our story kicks off way back in the 1970s. Sam Walton is just methodically, piece by piece, building this absolute retail empire from the ground up. And over at Berkshire Hathaway, Warren Buffett and his partner Charlie Munger, well, they weren't just aware of it, they were watching, and they were watching closely. They saw this brilliant, seemingly unstoppable business model. But here's the thing they were about to learn the hard way. Seeing a winner and actually betting on that winner, totally different ballgame.
So on paper, the plan was perfect. Buffett and Munger, they'd spotted the opportunity, they had the cash ready to go, their target price, $23 a share. But then as they actually started to buy, the stock ticked up just a tiny bit. And in that moment of hesitation, Buffett hit the pause button. He decided to wait for the price to fall back down to his exact target. Well, it never did. And just like that, he let a multi-generational opportunity, a truly massive one, slip right through his fingers, all over a matter of pennies.
And you know what? There's actually a name for this exact behavior. It's a cognitive bias called price anchoring. See, Buffett got so fixated on that initial $23 price that it became this mental anchor, and it completely overrode his own brilliant analysis of Walmart's future. He knew the company was going to be huge. He knew it was destined for greatness, but his brain just got stuck on that one number. It's a classic mental trap that, as we see here, even the absolute sharpest minds can fall right into.
And look, this isn't just me speculating here. Decades later, at one of his famous annual shareholder meetings, Buffett himself admitted just how big this error was. His words, a $10 billion mistake of omission. Now, you'd think a lesson that expensive would be burned into your memory forever, right? Well, as you're about to see, the story is far from over.
So, that brings us to Act 2, mistake number 2. This one is what's called a sin of commission. So decades have passed since he first let that opportunity slip away, and what happens? Buffett gets a second chance. A chance to own a really significant piece of Walmart. And this time, you better believe he vowed not to miss out. He decided to act, and act decisively. But in doing so, he ended up making a totally different and, just as costly kind of mistake.
And he didn't just dip his toe in the water this time. No way. He went big. Over almost a decade, he built up a multi-billion-dollar position. Walmart became a top 5 holding for all of Berkshire Hathaway. But then, 2015 happens, and Walmart does what good long-term companies are supposed to do. They invested in their future. They announced they were raising wages, and they were going to spend a ton of money on e-commerce to fight off a new threat. Well, the market completely freaked out. The stock plunged. And right at that moment, at the absolute peak of pessimism, Buffett sold. He sold every single share. Now, his reasoning, it was clear. And honestly, on the surface, it sounded totally logical. He just saw the whole retail business getting way, way tougher. And the number one threat? Well, that was obvious to everyone, Amazon. Buffett really admired Jeff Bezos, how relentless he was, and he just felt that Amazon was too far ahead in the game. He basically decided it was time to pack it in and find an easier game to play. So, okay, that brings us to the aftermath. What happened next? What happened after the world's greatest investor decided the game was just too hard? After he dumped his entire multi-billion-dollar stake right at the bottom? Well, Walmart started to fight back.
Just look at that number. That kind of says it all, doesn't it? The stock didn't just recover from the $60 price where Buffett sold out. It tripled. Think about that. The exact same investments that spooked the market, the ones that spooked Buffett himself, turned out to be the seeds of an absolutely incredible corporate turnaround.
He miscalculated. Simple as that.
He was so focused on the threat from Amazon that he completely failed to appreciate Walmart's own incredible strengths, its operational power, its deep-rooted ability to adapt and fight. He sold way too soon. He didn't give Walmart's management the time they needed to actually execute their comeback plan against the very competitor he was so afraid of.
In this comeback, it was absolutely real. I mean, look at the numbers. Yeah, profits took a short-term hit because of all that spending. But the top line, the revenue, it just exploded. It grew by over $120 billion in just 7 years. The strategy was working. It proved that Walmart couldn't just survive in the age of e-commerce, it could actually thrive.
So, this brings us to what I think is the most important part of this whole story, the lessons. What can we actually take away from this incredible saga of two giant billion-dollar mistakes? I mean, it's easy to sit here and point fingers, right? But the real value is in pulling out the timeless principles that apply to all of us anytime we have to make a big decision.
And it really boils down to a simple but super powerful checklist. Mistake number 1, that teaches us about buying. You have to focus on the long-term potential of the business, not get hung up on a tiny little price point. And mistake number 2, that's all about selling. Don't just react to fear and short-term headlines. You have to analyze the decision to sell with the exact same clear-headed thinking you used when you decided to buy. And you've got to give good management the time they need to work through the tough stuff.
You know, Charlie Munger's words here, they just really drive home the pain of that first mistake. He called it a total cinch. I mean, think about that. They knew it was a guaranteed home run, and that's what makes their failure to even swing the bat so frustrating. This wasn't a failure of intelligence. They were smart enough to see it. It was a failure of temperament.
But if you look beyond all the financial rules about buying and selling, there's a deeper, more profound lesson in all of this. It's not really about the mistakes themselves. It's about what Buffett and Munger do after they make them.
And this is it. This quote right here is the ultimate lesson. They are absolutely relentless in their self-criticism. They get up on stage in public and they pick apart their own errors year after year. Think about it. Most of us, we try to forget our failures, right? We bury them. Buffett and Munger, they study them. So the most crucial insight here isn't just about avoiding price anchoring or panic selling. It's about developing the raw intellectual honesty to confront your own errors, to really learn from them, and to make sure that not learning from a mistake is the one mistake you never ever make.
So, what if I told you that the world's greatest investors, we're talking Warren Buffett and Charlie Munger, looked one of the most profitable companies in history right in the eye and just walked away? Yeah, this isn't some hypothetical. This is the real story of a multi-billion-dollar blunder. It's a moment where these titans of investing saw the future, they understood it perfectly, and then they just let it slip right through their fingers.
You know, it's so easy to put investing legends like them on a pedestal, to think they're infallible. But this story, it's the ultimate proof that everybody has blind spots. And look, this wasn't just some small misstep. It's a mistake that both Buffett and Munger have publicly talked about and regretted for years. It's this powerful, fascinating lesson in how even the most brilliant minds can get trapped by the very rules that made them successful in the first place.
So that's the big question we're going to dig into. How on earth could Warren Buffett, a guy whose entire legacy is built on understanding businesses better than anyone, have a front-row seat to the rise of Google, trust its founders, see its incredible power with his own company's money, and still decide to do nothing? Let's get into it. Okay, so to really get the scale of this missed opportunity, you have to understand that back in 2004, Google wasn't some tiny speculative startup. No way. It was already a dominant force, basically a giant hiding in plain sight that was completely rewiring how the world found information and how businesses found customers.
I mean, think about it. The company was already so powerful that its name had literally become a verb, right? Just Google it. It was the undisputed king of search. And more importantly, it was building this revolutionary advertising machine that was fast becoming the economic engine for the entire internet. This wasn't just another company, it was becoming essential infrastructure for our digital lives.
Now, here's where it gets really interesting, the personal connection. This wasn't just some random tech company on Buffett's radar. Google's founders, Larry Page and Sergey Brin, were huge admirers of his whole philosophy. They were so inspired by Buffett's famous owner's manual for Berkshire Hathaway that they modeled their own letter for their 2004 IPO directly on his principles. They were literally speaking his language right from day one.
And that connection, that was just the beginning. The evidence for Google's massive potential wasn't some abstract theory for Berkshire Hathaway. They weren't just watching from the cheap seats. They were practically on stage, seeing exactly how the magic trick worked from behind the curtain.
Let's just walk through the undeniable first-hand proof they had. First, like we said, they knew the founders basically shared their business DNA. Second, and this is the absolute killer detail, one of their own major companies, the insurance giant Geico, was a huge Google customer. Berkshire was literally writing massive checks to Google every single month for ad clicks. Third, they could see right there in their own financial statements that these ads were working incredibly well. And fourth, Buffett is a master at spotting great business models, and he knew this was an all-timer. A business that was printing money with almost zero cost to scale up. It was, for all intents and purposes, a perfect business.
And hey, don't just take my word for it. These are Warren Buffett's own words from the 2004 Berkshire annual meeting. He was publicly, on the record, endorsing the character and the principles of Google's leadership. He got the people, he got the shareholder-friendly attitude, and he definitely got the business model. I mean, every single box was ticked.
All right, so let's just recap for a second. You've got an incredible business, founders who are basically your ideological disciples, and direct, tangible proof from your own portfolio that the product is a massive success. So, what happened? Well, this brings us to the moment of the billion-dollar decision, or maybe more accurately, the billion-dollar indecision. The reason they passed is almost shockingly simple, and it's a huge lesson in how our own minds work. For decades, Buffett's golden rule was to stay inside his circle of competence, and for him, that meant avoiding technology companies. He just felt their futures were too hard to predict. Now, this principle made him a legend, right? But in this one case, it became a mental prison. It's a classic example of bias. The comfort of sticking to what you know was so strong that it blinded him to this extraordinary opportunity, even though it fit all his other criteria perfectly.
I mean, the disconnect is just staggering when you lay it out like this. On one side, you have this mountain of overwhelming, positive, first-hand evidence. And on the other side, zilch. Nothing. Complete inaction. Just an unwillingness to challenge a rule that had worked for a long, long time. As Charlie Munger would so memorably say years later, they just sat there and sucked their thumbs.
And there it is, that incredible quote from Munger himself. You just have to admire the brutal honesty, right? There's no corporate jargon, no excuses, no spin. It's just a raw, blunt admission of seeing a world-changing opportunity up close, understanding it perfectly, and doing absolutely nothing about it.
And this wasn't a mistake they just kind of brushed off and forgot. In fact, it's something that seemed to follow them for years. The decision to pass on Google became this recurring ghost at their famous shareholder meetings, a topic they would come back to again and again for over a decade.
This timeline of their own public comments really shows you how much this weighed on them. It starts in 2011 with Munger being kind of fascinated by it, but by 2017, that fascination has turned into full-blown regret, calling it their worst mistake. A year later, Buffett himself formally admits his failure to pull the trigger, and then in 2019, we get that all-time classic, sucking our thumbs quote. It's really a masterclass in self-criticism, but it also just highlights the mind-boggling scale of what they missed.
So, what's the big takeaway here? What does this story of a massive error by the best in the business actually mean for us today? Because this isn't just a history lesson, it's about pulling out a timeless practical lesson that every single one of us can use.
At its core, this whole story is a lesson in just paying attention. It's about recognizing the huge shifts happening right under your nose. In your own house, in your own bank account, in your daily habits. It's a principle that another investing legend, Peter Lynch, built his entire career on with a really simple idea. Invest in what you know and what you see around you. Buffett and Munger knew Google. They saw it. They just didn't connect those dots back to their own investment portfolio.
So what does that actually look like in real life? Well, it means being an observer of your own world. Notice the brands you're loyal to, the services you truly can't live without. Seriously, take a look at your credit card bill. Where does your money go almost automatically every month? When you spot a business that seems to be just printing money with a brilliant model, don't dismiss it just because it's new or outside your usual comfort zone. You don't have to bet the whole farm on it, but putting even a small amount towards these ideas that you genuinely get from personal experience, well, that can be a game changer.
And that brings us to the final, critical question, the one for you to take home. Buffett and Munger missed the obvious because it was in a category, tech, that they had a rigid rule against. So, what are the rigid rules and the blind spots in your own thinking? What revolutionary product are you using every single day? What company are you personally funding with your own wallet? What is the Google that you see so clearly in your own life but are still ignoring?
All right, today we're going to dive into a pretty incredible story. It's all about how the world's most legendary investor, Warren Buffett, openly admitted to completely missing the boat on Amazon. And we're getting into it because, trust me, the lesson here isn't just about stocks. It's about how the very definition of value is being rewritten right before our eyes. And yeah, this isn't just some rumor or speculation. This comes straight from the Oracle of Omaha himself. Back in 2016, he was brutally honest about what he saw as a huge mistake. And this one quote, man, it just sets up the whole mystery we're going to unravel today. Why? Why did one of the sharpest financial minds on the planet miss this? What exactly was Jeff Bezos building that Buffett's proven, time-tested model just couldn't see? So to really get what happened here, you've got to picture it as this epic collision of two completely different worldviews. We're talking two brilliant, but totally opposing ideas about how you build a business and create value in the 21st century. And this just lays it out perfectly. On one side, you have Warren Buffett's mindset. He's looking for businesses that are like these sturdy, predictable oak trees, you know? They produce consistent profits you can count on, year in and year out. But on the other side, you've got Jeff Bezos, and his approach is more like building a rocket ship. It's all about disruption, scaling up at any cost, and grabbing total market dominance, even if that means you don't show a profit for years. Two geniuses, two totally different playbooks. And man, did Bezos' playbook work. The company just moved at warp speed. I mean, it starts as an online bookstore in a garage in '94. A few years later, boom, it's the everything store. And just when you think you've got them pegged, bam! In 2006, they launched AWS, basically inventing the modern cloud industry out of their own internal tech. By the 2010s, they're an absolute monster in almost every part of the digital world. They weren't just growing, they were shape-shifting. And make no mistake, Buffett saw all of this happening. This wasn't some company flying under his radar, not at all. He was watching closely, and he's on the record saying he was impressed with Bezos right from the start. The problem was, every time he looked at the financials, the numbers they didn't make sense. They didn't fit his definition of a good investment. And this right here, this brings us to the absolute heart of the problem, the valuation dilemma. It was a classic square peg in a round hole situation. The old, trusted tools that investors use to measure a company's worth, they just weren't built for a company like Amazon. You see, Buffett's entire philosophy is built on the ideas of his mentor, Benjamin Graham. And those methods are absolutely brilliant for valuing predictable companies. You look at their assets, you project their steady, stable cash flows out into the future, and you figure out what the company's worth today. The whole system is designed to find and reward certainty. And that right there is the trillion-dollar question. It's the one that stumped not just Buffett, but an entire generation of investors. How on earth do you put a price on a company when its main goal isn't making a profit today, but achieving total domination of an industry tomorrow? The standard toolkit just completely breaks down. And this slide shows you exactly why. Amazon was just a different beast. It wasn't just selling stuff. It was building this massive, self-fueling ecosystem. Every single dime of potential profit was immediately plowed right back into growing the company, building new warehouses, creating AWS, developing new devices. So the thing is, its real value was never on the balance sheet. It was in the power of that relentless growth model. To a traditional investor, it just looked like a company that never made money, with a stock price that was just completely disconnected from reality. Okay, so let's get to the real payoff of this story. Let's hear from the man himself. Because when Buffett talks about this, it's not just him admitting he made a mistake. It's really a masterclass in how to stay humble and adapt to a world that's constantly changing. So we're back to that 2016 quote, but let's listen really closely to his words. I didn't understand the power of the model. That's everything, right there. He's not saying his math was wrong. He's admitting his entire framework for understanding value was missing a piece. He could see the crazy high stock price, but he couldn't see or couldn't properly value the incredible engine that was driving it. And you know, his thinking on this just kept evolving. It wasn't a one-and-done thing. Over the next few years, he watched Amazon's insane expansion continue, especially the mind-blowing growth of AWS, which was turning into a profit machine the world had never seen. His assessment of his own mistake didn't just get confirmed, it deepened into a real sense of awe. And then, 2 years after that first quote, his tone changes from just regret to, well, to outright wonder. Listen to this. He calls what Bezos built a miracle. Just think about that word, miracle, coming from one of the most rational, numbers-driven people on the planet. And maybe the biggest lesson of all is in that last line. Even though he already had a sky-high opinion of Jeff Bezos, he still underestimated him. Wow.
So why are we talking about all this? Why does this one story matter so much? Well, because Buffett's miss basically gives us a blueprint for understanding how value works in the modern world. It's time for a new playbook.
So let's break it down into 3 big lessons. First, you have to know the limits of the old tools. A traditional cash flow analysis is perfect for a stable, predictable company, but it just can't price in a truly game-changing vision. Second, you have to value the whole ecosystem, not just one product. Amazon's power isn't just selling you a book. It's the network of Prime and AWS in the marketplace all working together to create this flywheel that gets stronger and stronger. And third, in a world that moves this fast, you've got to bet on the leaders. The ability of a CEO to pivot and execute like Bezos did over and over, that might be the most valuable asset a company has, and you're never going to find it on a spreadsheet.
At the end of the day, here's the bottom line. The game is changing. The rules are more complex. It's not enough to just be an accountant anymore, looking at a company's past. You also have to be a bit of a futurist. You've got to be able to see the potential in a disruptive idea and the vision of the people leading it. And that leaves us with one final, pretty mind-bending question to chew on. If a mind as sharp as Warren Buffett's could miss something as huge as Amazon, that forces us all to ask, what's out there right now? What company, what new technology, what crazy new business model looks too expensive, or too weird, or too unprofitable by today's rules? What's going to be the big miss of the next 10 years?
Welcome to The Explainer. Today, we're digging into the chapter on pharma companies to deconstruct a massive mistake from one of the world's greatest investors. And look, this isn't about pointing fingers. It's about uncovering some seriously timeless lessons that you can actually use. You know, it's funny. We spend so much time studying success stories, right? But sometimes the most powerful, the most useful lessons, they come from the screw-ups, especially when they're made by a legend like Warren Buffett. It's in these moments, these errors, that we find the clearest, most practical principles for our own decisions. All right, so here's our game plan. First, we'll dive into the perfect storm of 1993 that set all this up. Then we'll get into the big dilemma Buffett was facing. After that, we'll pinpoint the exact mistake he made. We'll hear him confess it himself. And then we'll wrap it all up with the key takeaways for you as an investor. Okay, let's start by jumping in our time machine and heading back to 1993. Now, this wasn't just any old year. This was the year a perfect storm brewed up in the stock market, creating what should have been a monster of an opportunity. So here's where things get really interesting. You have a huge political event that creates this massive dislocation in the market. Bill Clinton gets elected, and his administration gets to work on this big healthcare reform plan. Well, this just sent a tidal wave of fear through Wall Street. Everyone was terrified that drug prices were going to get regulated into the ground and that profits would just vanish. And the result? The entire pharmaceutical sector got absolutely hammered. But while most investors were sprinting for the exits, what did Warren Buffett and his partner Charlie Munger see? The complete opposite. They saw an entire industry, one that's totally essential to humanity, by the way, filled with companies that had unbelievable research pipelines and pricing power, all of it being sold off at a huge discount. They figured, hey, looking out a few years, these companies were set up for much, much higher returns. And that leads us straight into the core conflict that Buffett was dealing with. And it's a classic. Man, it's a dilemma that basically every single investor faces at some point. The difference between knowing an entire industry is a great bet and trying to pick the one single winner out of the bunch. And this just illustrates the problem perfectly. Buffett was totally certain the entire forest, the whole pharma industry, was incredibly valuable. He knew it was a winning sector, no doubt about it. But he felt like he couldn't, with any real confidence, point to the single tree that was going to grow the tallest. I mean, he said himself it was way harder than knowing that Coca-Cola was the soft drink company to own. So with that dilemma in mind, let's take a look at the specific action and really the inaction that Buffett himself would later call a terrible mistake. Now, he didn't just sit on his hands. He actually started to make a move. He saw all this value just sitting there, and he started building a position in Johnson & Johnson, a giant in the field. But then, almost as fast as he started, he stopped, cold. And this is the absolute heart of the lesson. Why in the world did he slam on the brakes? Was it because his whole analysis changed? Did some bad news about the company leak out? Nope. The reason is, it's almost unbelievable, and it is a trap every single one of us can fall right into. That's it. That's the reason.
The stock price ticked up by 1/8 of a dollar. That tiny, tiny little movement was enough for him to pull the plug on what could have been a multi-billion-dollar investment. A change that was basically a rounding error caused him to completely reverse course. It's a classic, powerful, and way too common psychological trap.
You know, this behavior actually has a name. It's called price anchoring. It's a cognitive bias where our brains get totally fixated on an initial price, like the price where we first bought a stock. And because of that, we fail to reevaluate the company based on its future value. The business case could be getting stronger and stronger, but our brain is stuck on that old number, and we're hesitant to pay even a tiny bit more.
Okay, so let's fast forward a few years to the 1997 Berkshire Hathaway annual meeting. Now, Buffett didn't try to sweep this under the rug. Nope. In front of thousands of shareholders, he laid it all out with total honesty. And just hearing it in his own words is so powerful. He just says it, plain as day, a terrible mistake. He admits that his hesitation to follow the price up was the big error, and that the real move, the smart move, was to just buy a basket of the whole industry when it was on sale. And Charlie Munger's take here, wow, it's just as powerful. He points out that it wasn't just about missing out on the money. They missed the chance to be part of what he calls one of the glories of American civilization, an industry that has done so much good for people. They just admired it from the sidelines, but they never got in the game. Okay, so now we get to the most important part of all of this. What's the takeaway for us? How do we take Buffett's billion-dollar mistake and turn it into our advantage? The number one solution to Buffett's big dilemma is what's called the basket approach. It's so simple, but it's brilliant. If you are totally convinced that a whole sector is going to be huge, but you just can't confidently pick the one company that's going to crush all the others, then don't. Instead, you just buy a basket of the big, dominant players you believe in. You're basically creating your own little private industry-specific index fund. I mean, this one story is just a masterclass in so many key investing ideas. It shows us you gotta seize opportunities decisively when they show up. You have to size them up correctly. Buffett saw the value, but his actions didn't match the scale of the opportunity. It proves you have to actively fight that price anchoring bias, especially if your belief in the business hasn't changed a bit. And finally, it teaches us to just tune out the short-term noise when we see clear long-term value. So we'll leave you with this question to chew on. Thinking about Buffett's pharma mistake back in '93, what's a major industry or a big trend today that you are absolutely convinced is going to be massive, but you're just sitting on the sidelines because you're stuck trying to pick that one single perfect winner?
Have you ever wondered how something can be a perfect investment on paper, but also a total moral minefield? Well, today, we're diving deep into one of the best examples of this, Warren Buffett's really complex and honestly contradictory relationship with the tobacco industry. It's a fantastic story that pits a flawless business model against some very, very messy ethical questions. Okay, let's jump right in.
First, we're going to look at what made tobacco so incredibly attractive from a purely financial standpoint. Then, we'll see how Buffett put that exact theory to the test with a huge bet that paid off big time. From there, we'll get into the real heart of it, the paradox of profit versus principle, and try to uncover the philosophy behind his decisions. And we'll wrap up with what all this means for you, for any investor trying to figure this stuff out today.
All right, so let's start with the basics. What was it about tobacco that made it so irresistible, especially to a value investor like Warren Buffett? Well, from a pure numbers perspective, the tobacco business back in the late 20th century was, for lack of a better term, a cash-printing machine.
I mean, this quote from Buffett himself just says it all, doesn't it? It's not just some clever line. This was his actual investment thesis. Think about it. Incredibly low costs to make the product, super high prices to sell it, and a customer base that was fiercely loyal, you could even say addicted. For an investor, it was just the perfect recipe for massive profitability.
And this wasn't just some abstract theory, you know? This powerful business model was the engine behind one of the biggest, most dramatic corporate shakeups in history. In the late 80s, the entire financial world was watching a giant in the industry called RJR Nabisco.
$25 billion. That was the price tag, a new record at the time. This leveraged buyout of RJR Nabisco was so wild, so legendary, it actually inspired the book and the movie Barbarians at the Gate. And the whole thing was fueled by that simple, powerful idea. Make it for a penny, sell it for $1.
Now, all of this corporate chaos, all this drama, well, for someone like Warren Buffett, it created the absolute perfect entry point. He looked at all that turmoil not as a risk, but as a classic textbook value opportunity. So here's the play-by-play of how Buffett handled it. He didn't try to buy the company itself, no. He did something way smarter. He bought its debt. See, after that massive buyout, RJR Nabisco was swimming in debt, and the market totally panicked. The value of its bonds just plummeted. But Buffett saw the real value there. He swooped in and bought $440 million worth of those bonds for pennies on the dollar, and just 2 years later, he cashed out. And the result of that move? A staggering $150 million profit. This was Buffett 101. He saw value where everyone else saw fear, he held his nerve, and he walked away with a massive gain. It was the ultimate proof that his thesis on the financial power of tobacco was absolutely correct. So, okay, Buffett clearly knew this business inside and out, and he just proved he could make an absolute killing from it, which brings us right to the central paradox of this whole story.
Right, this is the question, isn't it? Why just play around with the bonds? Why not just buy a whole tobacco company and collect those incredible profits year after year after year? Well, this is the exact point where the clean, simple math of investing collides with the messy, complicated world of personal ethics.
And this is where you can really see Buffett's internal tug-of-war. On one side, you've got the hardcore capitalist who just made a fortune on that bond trade and whose other businesses, like Walmart and Costco, were profiting from tobacco sales. But on the other side, you have the ethicist, the guy who flat out said he wouldn't want to own an entire tobacco company because of moral issues. He even passed on other hugely profitable tobacco deals.
So to really understand this split personality, we have to look past the spreadsheets and get into the personal philosophy of Buffett and, of course, his longtime partner, Charlie Munger. Here's Buffett, in his own words, back in 1997. He makes it really clear it wasn't some formal, official boycott. It was a feeling, a discomfort. Now, he tried to frame it partly in business terms, questioning the long-term future of the industry. But that one word, uncomfortable, that hints at something much deeper, something way more personal than a simple financial analysis.
And then Charlie Munger, speaking at the very same meeting, just hits the nail on the head. This right here is the core of their whole philosophy. There's no simple rule book. Ethics for them isn't a checklist. It's a messy, personal calculation that everyone has to do for themselves. And Munger doesn't just put up with this complexity, he says he actually likes it.
So, what can we take away from all this? The Buffett tobacco paradox isn't just some old story from business history. It's a really powerful framework for every single investor who's facing these kinds of questions today.
This quote from Abraham Lincoln, which was in our source material, just frames the final lesson perfectly. Investing in tobacco was, and still is, 100% legal. But as Lincoln reminds us, legality isn't the only standard we can, or maybe even should, hold ourselves to.
So what's the playbook here? Well, first, it's about just acknowledging that this tension between making money and doing good exists. It's real. Second, just like Buffett and Munger, you have to decide where your own personal line is. It's not about a black and white rule. It's about your own nuanced judgment. And finally, and this is a big one, if an investment just doesn't feel right to you, remember, there is thousands of other places to put your money.
At the end of the day, this entire fascinating case study boils down to this one single powerful question. Buffett and Munger, they drew their own messy, complex line in the sand. The real takeaway here is to think about your own principles, your own comfort level, and to decide for yourself. Where do you draw the line?